everyone, and welcome to the first trade on Yahoo Finance for this Tuesday, October 6th. August, where are we? I'm Alexis Christophorous, along with my co-host, Brian Sazi. Investors are waiting to hear from Federal Reserve Chairman Jerome Powell this morning. He's going to address the National Association for Business Economics annual meeting at 10:40 Eastern. We'll be carrying that speech for you live here on yahoofinance.com. Ahead of that speech, we've got stocks mixed after yesterday's strong rally. We've got the Dow futures up 142 points, but NASDAQ futures are down 24 and S&P futures up about 6. With President Trump out of the hospital and back in the White House, investors are also trying to assess what his health means to the election as a growing number of top White House staff and senators test positive for coronavirus. Joining us now is Yahoo Finance's Emily McCormick. Good morning, Emily. So what do you see as moving the markets this morning?
Well, Alexis, taking a look at contracts on the three major indices, as you mentioned, they are trading mixed this morning, but have pushed up into more positive territory, especially on the Dow. Now, we did see a strong rally across the three major indices yesterday, with both the S&P 500 and NASDAQ rising by the most in nearly 1 month as of yesterday's close. Now, taking a look at the Dow, those gains in turn being led by financials, similar to the gains that we saw yesterday coming from that cohort. We have Dow components JP Morgan and Goldman Sachs each higher by a bit under 1% this morning. Now, also want to highlight that Treasury yields are again rising and adding to yesterday's increase. We have the yield on the 10-year note up 2.1 basis points to about 78 basis points here. So again, pushing higher and helping actually boost that financial sector overall as well, since that, of course, is constructive for those names. Now, as you mentioned, coming ahead today, we do have Federal Reserve Chair Jerome Powell slated to give a speech at the National Association for Business Economics later today on the outlook for the economy during the pandemic. So that's something investors will be watching this morning as well, Alexis.
And Emily, clearly this market is going higher on this notion we are nearing a stimulus deal. What's the latest here?
Well, Brian, taking a look at the stimulus talks, we do have House Speaker Nancy Pelosi and Treasury Secretary Steven Mnuchin set to resume negotiations today after reportedly speaking by phone for about 1 hour yesterday to discuss spending amounts. Now, the two have regularly been speaking over the phone for the past week or so. Both sides have reported making progress, but there's still a large gap in dollar sums between these two plans. We had the House of Representatives last Thursday voting to advance a $2.2 trillion package, still well above the $1.6 trillion proposal that Mnuchin had put forth. So really trying to narrow the spread there between what House Democrats and the Trump administration officials have been willing to push ahead with in terms of the stimulus sum. So something to keep watching here as we get headlines out of that meeting, reportedly happening later today. Brian and Alexis.
Emily, something President Trump has been working to do or has said he wants to do is to narrow the gap with the trade deficit, but that did not happen. We got figures out this morning that showed that deficit widened in August to a 14-year high.
That's right. So that trade deficit coming in at $67.1 billion in August. That was up from $63.4 billion in July and marking the widest level that we've seen since August 2006. Now that coming as the pandemic weighed heavily on global trade, and we have seen imports start to recover more quickly than exports in the wake of this. Now we had imports up 3.2% month over month to $239 billion, according to that Commerce Department report this morning. We had exports up 2.2% to about $172 billion. Now, as you mentioned, Trump, of course, trying to narrow that trade deficit, specifically with one country in particular, and that's with China. We actually did see that deficit decrease during the month. That was down $1.9 billion to $26.4 billion in August. Exports there increasing $1.7 billion and imports decreasing $0.2 billion. Brian and Alexis.
All right, Emily, thank you. President Trump is waking up at the White House this morning after returning from the hospital last night and shocking many public health experts by removing his mask even before walking inside. Our healthcare reporter, Anjali Kamlani, is with us now. So, Anjali, the president is still likely infectious, right? So what are the risks that this poses, his taking his mask off in the House, to staff and family members?
Well, what we saw was him taking his mask off outside the residence in an outdoor space. So there he poses no risk. But once he gets inside, if he continues to keep his mask off and is in continuous contact with staffers and other individuals who are roaming about the White House without his mask on, that's where he poses the greatest danger. And that's something that we've already seen reports where staffers are not only fearful, but also frustrated to see that behavior. And it's frustrating health experts as well. Absolutely all over social media last night. That was pretty much the first thing that captured everyone's attention, is that despite going through this and despite experiencing the virus, he continues to sort of hold his stance on, sort of the dangerous public health messages, including not to be afraid of COVID, as we saw him both tweet and say in a video following.
Anjali, a new report this morning that the White House is blocking new FDA guidelines for releasing a COVID vaccine. What are the details here?
That's correct. So as we know, the FDA has been trying to get an additional observation time in these late stage vaccine trials, in part to do with the fact that the two frontrunners are newer technology. So they're waiting to see, if those companies can in fact commit to. We've heard that some of them have, but the White House is now saying that they will not approve that. And that's something they have said before, that they're unlikely to, because it pushes the potential, not the actual, but the potential of a vaccine to at least indicate that it is working before election day out to Thanksgiving Day instead. So that's something that it seems to be on the table right now. We've heard that the White House is citing pharma companies' pushback as the reason why they are not supporting this.
All right, Anjali Khemlani, thanks so much.
Okay, some developing Brexit news out of the UK this morning. Here with those details is Yahoo Finance contributor Kumita Ramanathan. Kumita, good to see you this morning. What are the details here?
Absolutely. Nice to join you as well. Now, the talks that we've been discussing between the UK as well as the EU could actually have just reached an inflection point. That's because there's reports out that are saying that the EU is actually betting that the UK is going to back down on all of its previous demands. Now, this means that the bloc has no plans to offer any concessions ahead of next week's Brexit meeting that takes place on October 15th. It's been highly anticipated by the markets, and the bloc is actually basically calling the Prime Minister of the UK's bluff, saying, we do not necessarily want to support all of the things that you've staked your claim in over the last few months as the negotiations have been rolling on. Now, we saw instant reaction to this news. We saw the pound tank just about an hour ago, even against the US dollar, as well as the euro, down as much as 0.3%. Now, the report also says that the EU intends to allow the Brexit talks to drag on as long as is needed. That could be well into November, even December. So clearly, this is a very high stakes strategy that the bloc is involved in.
And I know all morning long you've been diving into some new UK construction data.
Yes, exactly. And looking at the data, what we've seen is that the UK construction market has actually rebounded. Now, this is surprising for the IHS market survey conductors. They were not expecting September to bring back such positive gains, but this is a market that has been really hard hit by COVID and the looming lockdown fears that have passed. And in various pockets throughout the UK, there have also been fears that a full-blown lockdown could come into place. So while the news for this particular segment today is good, really, we just have to wait and see what happens. The UK economy as a whole is kind of holding its breath as they find out how many more job losses are coming and what that's going to mean for construction, people willing to buy houses and renovate their homes as well. So lots to watch out for.
And of course, welcome to the Yahoo Finance family. It's great to have you on the team.
Thank you so much.
All right, Kumita Ramanathan, good to see you.
All right, thanks, guys. Still to come here on the first trade, Apple is going to stop selling third-party speakers and headphones. What does that mean for companies like Sonos and Bose? We'll talk about it right after this. Welcome back to the first trade. We have got ourselves a mixed picture here in the futures market. Dow is rallying up better than 130 points now. In the broader market, S&P futures up 6, but NASDAQ coming under a little bit of pressure here, down about 20 points as tech stocks take a breather after yesterday's big rally. And we could be one step closer to the government breaking up big tech. A House committee is reportedly set to propose some sweeping reforms that could force companies like Apple and Amazon to give up their marketplaces. Our tech editor, Dan Howley, is here with the details. Good morning, Dan. So what do we know about this, what this proposal is, and what could it mean for these companies?
Yeah, basically what the proposal looks like right now, which is still in draft, is that companies wouldn't be able to operate and compete with the same marketplaces that they operate. So, for instance, Amazon sells its Amazon Basics brand and operates Amazon's e-commerce store, obviously. They then wouldn't be able to sell those Amazon Basics products that compete directly with third-party sellers on the platform. And that also goes for the likes of Apple and Google. They wouldn't be able to operate their own marketplaces and then sell products that compete with other apps. So think of something along the lines of perhaps an Apple productivity app or a Google productivity app, maybe Apple TV Plus, things along those lines that come out of the App Store and then compete with something like a Netflix or even a Spotify. So that's really what the draft is looking like right now. This, according to Bloomberg, there's Republicans on the panel. However, this is the House Judiciary Committee Subcommittee on Antitrust, Administrative, and Commercial Law. The Republicans on the panel seem to disagree with that kind of remedy. They believe that that's tantamount to breaking up the companies. Obviously, it's not really the same. Sorry about that. Lost you for a second. Obviously, that's not exactly the same, but it's a little bit of a kind of beat on what the companies are looking for exactly, as far as, they don't want to be broken up. They still want to be able to operate. And so the Republican side would definitely help them as far as that goes.
Dan, we really need to dive into Apple this morning. I'm looking at shares of Logitech getting creamed in the pre-market, Sonos under pressure here. Apple's decision to pull some of these third-party products from the site, Logitech, Sonos, how big an impact is it to these companies?
It could be a pretty big impact. So what we're seeing here is something like Sonos, as you said, Logitech, being pulled from Apple's online and physical retail stores. The products are audio products. So you're thinking headphones, speakers. Sonos' new speaker is not showing up on Apple's online or retail store. And the reason being is Apple is likely to introduce 2 new products coming up. Those are over-the-ear headphones. We're thinking they're going to be called the Studios, the AirPods Studios, or something along those lines. And then another kind of HomePod, but a smaller HomePod. You'll remember the HomePod was that speaker that Apple had that sold for around $300, $400. Didn't perform well as far as sales go because it was really restrictive in terms of what apps could be used with it. And so it just didn't take off. Apple is supposed to be working on a smaller version of that that could be more competitive. But Apple has done this before, where they've stopped selling competing products when they introduced their own kind of product. Fitbit was one of them before they introduced the Apple Watch. You'll remember that Fitbit was huge for a while, and then the Apple Watch came out and kind of took it over. And now Apple is the largest fitness tracker, or rather wearable seller in the world, whereas Fitbit now is being purchased, or in the midst of being purchased, by Google parent Alphabet. So this could be a big deal for these companies. I do still think, obviously, Apple has a huge amount of market share in the U.S., but internationally, that's not the case. Android is by far the leader. So anything that would work with the Android platform would still have robust international sales, one would expect.
Hey, Dan, since we have you, what's the latest on the iPhone 12? When can we expect that to hit stores?
So there's been some rumors that we could get them perhaps next week along that timeline. Usually when Apple announces products, it's in close to the second or third week of a month. I may expect to get some kind of notice this week, perhaps, about the next iPhone coming. That's going to be the iPhone 12. And again, the big issue there would be the 5G capability for that phone, as well as a redesign for the phone. So it would be a big event. There's a lot of kind of talk about a super cycle going on where Apple sells more than what they normally sell for the year of iPhones, and that could really boost sales for the long term for them for as much as 2 years. But then there's the kind of rebound effect that happens. The last time we saw something along these lines was when the iPhone 6 came out, and that was a full redesign of the phone. Introduced those two sizes, the 4.8, 4.7 inch, and the 5.5 inch displays, and that really kind of gave us where we are now with different types of iPhones. There could be 3 versions of the 12 here, maybe as many as 4, depending on what Apple goes along with here. But expect the 5G to definitely be part of the equation.
Dan, why does Apple even sell third-party products? I was just in the Apple Store in New York City about a week and a half ago. It's not just speakers. They have whole entire walls devoted to products that they don't sell. Are they just using these products as tests to see how they do and then ultimately go ahead and launch products of their own?
It could be. I think mostly it's because they want to show that you don't have to be locked specifically in Apple to be able to use different products. I think that's one of the big complaints that consumers have, is that you have to use Apple products with other Apple products. And so showing that you don't necessarily have to do that across the board is a good way for consumers to kind of feel comfortable using Apple products in the long run. I think, that's something where you can go in and get a keyboard that'll work with an Apple product. You can get a mouse that'll work with an Apple product, cases galore. So it really, I think, just has to do with Apple trying to show that it is kind of agnostic in certain areas of sales. But then obviously when they do see something perform exceptionally well, like you think the Fitbits again, they are going to dive into that market. And, now they dominate, as I said, the wearables market. Fitbit's trying to be purchased by Alphabet. And, Samsung is there, but they only work really with Android. Huawei, not having a presence in the US, more international, they're there as well. But it really is Apple that dominates wearables. And, if they look to another category and they can produce products as good as the Apple Watch and the AirPods, they'll continue to dominate.
All right, Dan Howley, thank you. This is Hispanic Heritage Month, and Yahoo Finance is spotlighting Latinos and Hispanics making a difference in the business world. I want to bring in Inez Ferre now. Hey, Inez, I know you had a chance to sit down with Jesus Mantis. He's a senior managing partner at IBM Services. What did you guys talk about?
Well, we talked so much about the pandemic and the effects of the pandemic on businesses, and IBM had conducted a survey with some 50,000 people about consumer behaviors. And this is really important because, of course, consumer behaviors dictates the way that companies operate eventually and their offerings. And some of the behaviors that have been seen during the pandemic are likely to be changes that would be permanent. Take a listen.
And we have been trying to detect what are the more permanent changes in behavior, because those more permanent changes in behavior basically inform the changes that the companies need to do. And some of the trends you would not be surprised about. Obviously, with COVID-19, a lot of the digital interaction has skyrocketed in every area. But the interesting thing is some of those trends are becoming permanent. So we have seen trends, for example, in healthcare, where telemedicine is now becoming the norm. And even after the pandemic, that will probably stay. We've seen changes to the sharing economy. It's like if we would be having this interview at the beginning of the year, we would all be talking about the challenge of ownership, whether it's property or cars, because of the sharing economy. Everybody is using Uber or Lyft or something like that. And what has happened with COVID-19 is that has reversed the other way around. So some of the points of the survey say that half of the people that used to use rideshare, they're saying they're not comfortable using rideshare. And over 20% of the people saying they're going to start using their own vehicles as the exclusive mean of transportation.
And of course, these are some of the trends that we have seen during the pandemic and that we've seen also with companies. And we've also talked about, of course, the digital transformation of companies and the acceleration of those changes at companies. So some of the interesting topics, of course, surrounding the pandemic and, of course, surrounding Hispanics as well and Hispanics in technology.
Yeah, Inez, what did he have to tell you about getting more Latinos and Hispanics into STEM careers?
Well, IBM has an initiative for mentoring Hispanics and also for giving internships to Hispanics and getting them really early, because Jesus had mentioned that by the time that a teenager is around 13 or 14 years old, he pretty much knows if he or she wants to go into a sort of STEM career. So making sure that they see people that look like them, that talk like them, that are involved in STEM careers, that they can also do internships with, is really important. And and Jesus's story is so interesting because he came from Spain, from southern Spain in 1994 when he came to this country as a consultant. He was told that he would be better off by changing his name, perhaps, that they would be some way of fitting in more. And we talked about the fact that Hispanics sometimes feel like they need to fit into the norm. And he said, do you want to fit into the context or do you want to be authentic? He says, long term, it's much better to be authentic. And trying to get more Hispanics into STEM careers, into technology, engineering, math, science, that's really the goal that he has personally, and one of the initiatives that IBM has as well.
All right. Well, really great conversation. Lots of insights there. And as thank you. And for the full interview with IBM's Jesus Mantis, just head over to yahoofinance.com/presents. We're closing in on that opening bell this Tuesday morning. What's driving the markets? What to look out for? What's making headlines? Jared Blickery has it all for us when we come back. All right, looks like Dow futures are holding on to those early gains. NASDAQ, though, still in the red. Let's check in with Jared Blickery for a look at what's going on. And Jared, I see a trend here, financial and energy stocks higher for the third straight day.
That's right. And we are seeing some weakness in tech. We'll get to that in a second, but we got to check out the energy sector here. And that's as Hurricane Delta, a Greek letter of the alphabet, because we ran out of named storms quite a while ago. Delta is a category 2, and we also have named storm Gamma in the Caribbean as well. So we're expecting some turbulence in the northeastern Caribbean. About Wednesday, Thursday, it should pick up, and probably going to have to close some oil wells and energy rigs, et cetera. And we're seeing the price action here. Exxon, which was up over 2% yesterday, is up 1% in the pre-market, and the foreign majors doing even better. Royal Dutch Shell and Total each up about 2.5% here. And looking at the commodities, our heat map, we can see heating oil is up over 4%. Gasoline, that's up nearly 4%. Crude oil, WTI, that's up 3.67%. And Brent, up 3.39%. Over the last 5 days, up 8%. And we had some really rocky action in crude oil. We've now recovered all those gains or all those losses that we had last week. Also checking out the banking sector. As you said, that's been on fire for 3 days. JP Morgan up 2% yesterday, up another 1.27% in the pre-market. Citi up more than 2% yesterday, up nearly 1.5%. And just looking at the NASDAQ now, we're going to get to the 10-year T-bond yield in a second. We found that when it has a dramatic move to the upside, tech kind of flags a bit. Didn't yesterday, because we saw Apple was up 3% yesterday, but down Friday big, and also down this morning, down about 4% in the pre-market. Amazon and Microsoft each off about 0.6%. We'll throw Alphabet in there as well. Looking at the sector action, we can see, if this catches up with me, there we go. We can see that energy and financials are in the lead, 1.4 and 1.01% respectively, followed by materials and utilities. And now here is that bond market, just seeing that 10-year T-note yield surge quite a bit.
All right, lots to cover there. Jared Blickery, thank you, and stay with us. We've got the opening bell live from the New York Stock Exchange in a moment. A new trading day has begun on Wall Street with the opening bell at the New York Stock Exchange. We saw some strength among the 30 Dow stocks heading into the session. Going to hang on to it as we start the new trading day. The Dow up 75 points. And now for a look at today's front page headlines. President Trump is waking up in the White House for the first time this week. He returned after being treated at Walter Reed Hospital for COVID-19 since Friday. There are still concerns about the health of the president. After he removed his mask from the balcony of the White House, he seemed to be gasping for air for about 20 seconds. The commander-in-chief did have a message for the American people. Don't let the coronavirus dominate your life. Well, many of those same Americans are heading to the polls early. With 4 weeks to go before the election, over 3.8 million Americans have already cast their vote. Many of those votes came via mail-in ballots. At this rate, one analyst believes that 65% of eligible voters will be voting this election. That would be the most since 1908. And three more scientists have been awarded the Nobel Prize. They received the award in physics for advancing the understanding of black holes, which are regions of space where gravity is so strong, not even light can escape from them. The secretary for the Royal Swedish Academy of Sciences said the prize was about, quote, the darkest secrets of the universe. By the way, one of the three winners, Andrea Ghez, she is only the fourth woman to be awarded the Nobel Prize in physics. All right, let's get back to the markets now. And Art Hogan, Chief Market Strategist for National. Art, good morning to you. What do you make of the market action today? I mean, we had pretty nice rally yesterday. What do you think is driving momentum today?
I think in general, what is driving momentum is clearly the ongoing possibility that we may get more fiscal stimulus. And I think that we spent most of the summer assuming that we'd get about $1.5 trillion in additional fiscal stimulus. And then we spent most of the month of September disappointed that that wasn't happening, and it wasn't happening very quickly. But I think with both Nancy Pelosi and Steve Mnuchin, ongoing discussions and continuing to try to get closer to an agreement, the market senses there may be a deal in the offing here. And I think that's what's desperately needed. When we look at last week's jobs report, clearly a disappointment. Next month is going to be much worse with all the layoffs we've heard about. So I think there's never been a time where we needed something to get out of gridlock more than right now. And I think the markets are sniffing that out.
All right, we've heard this narrative start to emerge here on the street that a blue wave come November would be good for the markets. Do you agree with that?
I do. Look at it this way. So, while you'll have an increase in spending, you'll certainly have an increase in revenues. So when you do the math on that, I think that lays out to be stimulative for the economy. I think whoever wins in 2021 is going to experience a lot of economic energy that gets released, both in the form of pent-up demand for goods and services that we haven't been able to consume over the course of the pandemic. But on top of that, we've got a lot of companies that have been hoarding cash and keeping a war chest of cash that can now be used in shareholder-friendly fashions like buybacks and dividends and accretive acquisitions. So I think there's a lot of economic energy that's going to help propel the economy for whoever resides in the White House. But when we think about in particular what happens with the Democratic sweep, you'd certainly think that the fiscal policy would be larger than what we're pricing in right now. So, $1.5 trillion probably turns to something with a 2 handle. That would certainly be stimulative for the economy. When you think about, the fact that we're entering a new year with likely to have about 11 million people unemployed, you're likely to see some pro-business, economic policies move forward. You're not going to rush to make any major changes until we get the labor force back to where it needs to be. So I think there's a lot of arguments to say that that's a narrative that makes a great deal of sense.
We're talking a lot about fiscal policy, the need for more stimulus, but what about the Federal Reserve? We got Chairman Jerome Powell going to be speaking later this morning. We're going to be covering that live here at Yahoo Finance. Is there anything that Powell might say today that would be market moving? And do you think we need to see even more action come from the Fed to prop up the market and the economy?
I think the Fed's doing exactly what they need to do right now. And I think that acknowledging that they're going to keep interest rates where they are for an extended period of time, continuing to increase the size of the balance sheet will clearly be the consistent message that Jay Powell will move forward with today. What he's also going to lean into, and this is something he's been fairly consistent of since August, is that monetary policy can't do this alone. There's clearly a need for more fiscal policy, and I suspect we're going to hear about that as well. I think that the fact that they are sort of at the limit of what they can do in terms of interest rates, they can continue to grow the size of the balance sheet. But I certainly think that what they need to do is be in partnership with fiscal policy, and I think Jay Powell's been very clear about that.
All right, why do you think the market is ignoring President Trump's erratic behavior?
This week or the last 3.5 years? I mean,
well, let's start with this week.
The market has been able to sort of look through, all sorts of interesting behavior coming from the administration, and I'm not exactly sure why, but I would point you to what has changed over the last week or two in terms of polling. Clearly, the challenger is increasing his lead. You can certainly point to whether it's national polls or state-by-state polls, or look at some of the gambling sites that look at the election process, and the challenger continues to increase there. So while the market may well be sort of getting sick of some of the erratic behavior, I certainly think that the market is also looking at, hey, maybe there's going to be adults in the room at the end of this election cycle. Maybe if the gap is wide enough between the two, we won't have a contested election, and perhaps that's the best thing for the markets and the economy moving forward.
Art, I want to ask you about the bond market, and you were talking before, kind of alluding to some of the changes underway, stimulus getting priced in, what have you. Maybe this is an artifact of that. We've seen the yield curve expand over the last few days. We got the 10-year sitting at about 77 basis points right now. At what point does this become a little bit disorderly, or do you have any concerns about that? Any levels you're watching?
Yeah, I'd get concerned if the yield on the 10-year had a 3 handle or any integer in front of it, but a 3 handle is probably where we start to get worried that safety investment is more attractive than your average return on equities. I think when you think about the yield curve, what's been interesting is there had been some speculation in July and August that the Fed would talk about yield curve control, and they shelved that. So not doing that, the back end of the curve has actually moved up faster than the front end of the curve. And that's good for financials. You just talked about JP Morgan being up over the last couple of days. I think that continues. I think the financials are beneficiaries of that in terms of net interest margins. But I certainly think that when we think about what does it take for the U.S. 10-year to take equity money out of the market and put it into fixed income, and we're nowhere close to that right now.
Art, what are you seeing right now? Are investors holding on to more cash? Are they in this sort of wait and see mode, waiting for the election to come and go and then make a move?
Well, it depends on what type of investor you're looking at. If you look at the surveys of institutional investors, the cash levels are higher than normal, and that's not unusual coming into the volatility of September and October. Last week's reading showed that level of cash was the highest we've seen so far this year. But when we look at the sort of Bank of America Merrill Lynch, the survey of retail investors or individual investors, their cash levels haven't changed at all. So their participation in this market has actually been pretty consistent throughout the entire cycle here. So it just depends on which type of investor you're looking at. Certainly a little more caution in the institutional world and a whole lot less in the sort of retail investor world.
Art, talk of a breakup of these big tech companies has resurfaced. Is that big cap tech trade that has worked so well the past 2 to 3 years, is that dead in the water in 2021?
No, I don't think it's dead in the water unless until you think we're going to go back and use less technology in 21 than we did in 20. I think we pulled forward digital adoption about 5 years in the span of about 5 months. So I think that our use of technology writ large is going to only increase from this point forward. So when you think about, does that trade need to continue to have its parabolic move higher? Certainly not. So I don't think you're going to see that outperformance that we saw in 21, that we saw in 20 in 2021. But you're certainly going to see companies that are growing their earnings and growing their cash flows faster than any other sector. And technology is always going to be leadership. It's just not going to be the kind of order of magnitude moves that we saw in 2020 for obvious reasons.
Sorry about that. Let me ask you about the currency market now, and any effects that movements in the dollar. We had a big down day yesterday in the DXY. Euro appreciated. Any big movements there that you're seeing that would also influence sector selection here?
Yeah, we thought we were going to see some firming in the dollar. We did for a bit in September, and that seems to have peaked, and now we're rolling over the other side. I think it makes sense when you sort of track the path of this virus and who's doing better. And what geographies are doing better. So obviously the Asia Pacific is doing much better than North America. North America is doing slightly less, having slightly less positive movement around the virus, and therefore the economic recovery than parts of Europe. So I'm not surprised in the current new wave of cases that we've seen in the United States to see that have an effect on the currency markets. In general, though, I think that when we think about the value of the dollar, it is actually a positive for a majority of the S&P 500. Manufacturing things in dollars and selling them in other currencies certainly helps with a weak dollar. It certainly helps our exporters. It helps our multinationals. So I don't think we're at a point right now where we're sending up. I don't think we're at a point where we're sending up a lot of alarm flares. But I think what we'd like to look at is, does that currency improve as the economic recovery improves on the other side of this pandemic? And we likely think that that's going to happen. So while we're seeing some softness in the dollar right now versus the basket of other currencies, we probably see that firm up in the first half of next year as we likely get better economic data coming into the second quarter.
All right, Art Hogan, Chief Market Strategist at National. Always good to see you.
Thank you.
Coming up next, we're going to take a closer look at the municipal bond market during this pandemic. Where are the opportunities? We'll talk about it up next. One of the key sticking points in stimulus talks continues to be money to help state and local governments, which could face severe funding shortfalls if Washington doesn't step in to help. And that could trickle down to the municipal bond market. With us now to talk about it is Sylvia Yeh, co-head of municipal fixed income at Goldman Sachs Asset Management. Sylvia, good to have you here. So look, investors were withdrawing from their municipal bonds pretty aggressively at the height of the virus in mid-March. Has that calmed down now?
Good morning. If you look back to March and consider where we are today, excuse me, some would think, did March ever really happen? Well, we've rallied back in rates, we've rallied in credit, we have wide distribution with respect to investors in our marketplace. The market is open for business, both in two-way secondary flow and new issue market is thriving. So market has come back, cautious, but coming back in action and excited for what is ahead.
Sylvia, we've seen a lot, to your point, a lot of new issuance come to the market. What states are leading in terms of new issuance?
Yeah, they're spread all over the place, and both not only from a state perspective, but sector, and in particular taxable versus tax exempt, which I think is probably the bigger play. But the big states like New York, obviously, California, obviously, Illinois. There are lots of states that need, flexibility in cash in different degrees, and they're accessing the market, big and small.
Sylvia, we've seen some state-specific funds run into problems during this pandemic. Just in the past few weeks or so, we've had Vanguard, Federated Hermes, and Bank of New York Mellon closing smaller at-risk state-specific funds. What's the larger implication to the muni market because of that?
Yeah, sometimes first of all, I think you have to look at the current environment that we're in and the interest rate environment that we're in, and it's very hard to get invested at these absolute low yields, in particular for those states. So closing those funds doesn't necessarily need to be a negative perception for the market, as we're seeing more cash go into the bigger, better distributed, and better diversified national funds. So I don't take that as a negative sign, just repositioning and better opportunity.
Okay, let's talk about those opportunities, because now we've got fewer state money market funds. So where can investors go for tax-free ways to invest their cash during this time?
Yeah, and it's funny, when we talk about investing in the muni market, still very popular are the traditional mutual funds and money market funds. What we don't talk about a lot are the separately managed accounts where individuals are allowed to build their own portfolios. So investors have different ways to access the muni market, whether in fund format or individual portfolio format. The opportunity also comes in a bunch of different flavors. Typically 2 levers that we can pull. It's going to be duration and credit. We have a third this year with the mix of supply. From a duration perspective, if you look at the steepness of the yield curve right now, you can tell everyone is hanging out in the front end because it's safer, it's easier, you can be more nimble. And by the way, we're going to be here for a bit. Let's be nimble for some opportunity that could come up. If you just dip a little bit further out on the yield curve, going from, let's say, 5 years to the 10 or 11-year space, you're being compensated pretty significantly to extend. And if we have the Fed telling us that we're going to be here for a while, why not take a little bit and be compensated for it? So duration and a slight extension is something that we're discussing with clients, one of those levers. The other lever can be credit, and it is credit. We talked about March to today, and I said that credit has rallied tremendously. Yes, and the high quality portion of our market, the AAAs and AAs, those strong quality names were the first to rebound. And then the high yield market, completely separate, a little bit tougher and struggled. But we have that BBB and I would say single A area that kind of was slow because it was a bit of a tweener. And that mix actually provided and still provides extra yield and opportunity for clients too, without a tremendous amount of risk. So from credit just dipping a little bit below the traditional high grade. And then finally, what I think is interesting that we have this year that we haven't had in years past or for a long time are taxable munis. Issuance is up 230%-ish, give or take, year over year. So that additional supply in our marketplace, as it looks to get distributed, as we look for that long-term buyer base, is going to take time to settle. And at the end of the day, it's what you take home as an investor that counts. So after you do your math, all things equal, tax-exempt muni, taxable muni of the same flavor, you want to walk away with as many basis points as you can. That's been an interesting mix, so that the key here in the message is to be flexible from now through the end of the year and as this mix continues to develop.
Sylvia, real quick before we let you go, the Fed has done its part to prop up the muni market. Jerome Powell speaking later this morning. Do you want to see even more support from the Fed for the muni market?
You know, I gotta say, munis get a bad rap, and this market has shown how resilient it really can be. The muni market has tools made available to them through the Fed, the MLF in particular. It is there. It is the borrower of last resort, and a handful of issuers have tapped it. There are probably a few more who will tap it. Is additional fiscal stimulus important to the marketplace in some capacity? I'm sure, but the Fed and others have done what this market needs in order to function. By the way, look at the market; it's functioning.
There you have it. Sylvia Yeh, co-head of municipal fixed income at Goldman Sachs Asset Management. Good to have you here this morning.
Thank you. Take care. Stay well.
You too. Coming up next, a closer look at the real estate market right after this. We may be on the verge of a major population shift from blue states to red states. A brand new analysis from Realtor.com shows buyers in some blue states like New York and California have been searching for homes in places like Florida, Wisconsin, Michigan, and Pennsylvania. Here to talk about it is Danielle Hale, chief economist at Realtor.com. So Danielle, we've been seeing this trend now throughout this pandemic. Why is this? Is this just people trying to flee cities and go to areas with more space?
Yeah, so the trend has certainly gotten a lot more attention during the pandemic, but it didn't start with the pandemic. It was ongoing beforehand. And in fact, this analysis goes all the way back to 2017 and all the way up to now to look at our data to find that we are seeing people moving from these dense urban areas that have tended to vote Democratic into suburban and rural areas that have tended to vote Republican. The reasons we think they're looking, for those moves is extra space and affordability. And people wanted affordability even before the pandemic. Now they want it even more because they want extra space.
Would those moves influence this election, or is this more of a forward-looking indicator?
And that's something that we'll see in the next month or so. They certainly could have an impact on this election. And when the votes are counted, that's when we'll find out. And what we're finding is that the trend shows that it could lead to more blue state voters or formerly blue state voters in red states. But what does that mean? Do people take their political views with them? Are they going to continue to be blue voters? Or is there something about living in the suburbs and rural areas that, causes people to think differently and maybe shift their political opinions? That we can't really know, but something we'll certainly look to after the election is completed.
So this analysis from Realtor.com is looking at searches. People in these blue states are searching for homes in these red states, but is that actually turning into real purchases, or are people just looking at this time?
Yeah, that's right. So historically, these searches have been a very good indicator of migration patterns. So, for instance, we've looked at California in particular, and folks leaving California were doing searches in nearby Western states that were much more affordable, like Idaho, Nevada, Arizona. And we found that actual migration patterns track very closely to those search patterns. In this case, we've just looked at the home search patterns. We haven't looked at the migration patterns. But it's something that we can do further analysis on to continue to see if that continues to hold up.
Anything in the data that would suggest these are permanent migrations, or once the pandemic is over, people migrate back to where they lived?
That's a great question. So these are home buyers. So they're certainly thinking longer term than, say, renters who are migrating typically, because you're going to buy a home, you want to buy for a couple of years in order for it to make financial sense to make that transaction. Additionally, this is a trend that's been accelerated because of the pandemic, but it was certainly ongoing before the pandemic. So as younger buyers age into ages where they're settling down, forming families, starting households, they're looking for extra space, and that has caused them to look to the suburbs and rural areas where homes are more affordable. And we expect that once they're there, that they will stay at least for a few years.
I don't have to tell you that real estate is cyclical, and we've certainly lived through downturns before, and maybe not quite like this. And there has been a lot of talk about, the demise of the big city, like New York City, that it won't be able to bounce back and be what it was pre-pandemic. What are your thoughts on that? I mean, I know Jerry Seinfeld's out with a book talking about New York City and singing its praises and saying we are going to come back from all of this. What's your take, having a bird's eye view of the real estate industry?
I think it's too early to say that New York City is over. It's certainly true that people are looking for more space and affordability and finding it in the suburbs. But the reason that they're looking to the suburbs is because they can't find what they want closer. And even the suburban areas, when we do our hottest zip codes analysis, the suburban areas that are doing well are areas that are typically in close proximity to cities, because job centers are in cities, culture is in cities, nightlife is in cities. There are a lot of amenities that draw people to cities. The pandemic has sort of freed up the way people think about getting to and from work, because since many of us are working from home, if not indefinitely, at least for the foreseeable future. And that has led to a slight shift in preferences. But I don't think that people will move too far away from the cities. And additionally, if a lot of people start to shift out of the cities, that could potentially make prices more attractive. And I think that will certainly help bring people in, because there's still a lot to be said for cities. And at least some of, the culture shift that we've seen right now as a result of the pandemic, I don't expect that to be permanent. That's certainly going to be temporary.
Yeah, well, I agree with that. Danielle Hale, Realtor.com. I'm not giving up on the city just yet. Thanks for being with us.
Of course.
All right, taking a look at the markets now, a bit of a shift here, Jared Blickery. We see markets are mixed, and the Dow starting to lose that upward momentum. What gives?
Yeah, that's right. And the S&P 500 has turned negative as well. NASDAQ spent the entire morning in the red, but just kind of building on some earlier losses here. Here is the Dow Jones heat map that we're looking at. Apple and Microsoft are big drags here. Apple down 1.5%, but the Dow is outperforming today because we're seeing a huge influx of money into energy stocks, and that's as Hurricane Delta makes its way through the Caribbean, about to hit the peninsula of the Yucatan in a day or two, and maybe the upper part of the Caribbean by Friday. Also taking a look at banks, those are outperforming as well. And we see JP Morgan, Bank of America, Wells Fargo, all up about 0.2% here. Citigroup up 2%. But I want to get to some price action in the S&P 500. Here's the Dow over the last 5 days. You can see a nice rally since last Friday. In the NASDAQ, just kind of testing those highs that we saw last Thursday. And the S&P 500, not bad either. We are taking a look at things on a longer term basis, and 3410 is some resistance we're looking for.
All right. Thanks so much, Jared. Coming up next, we're going to take a look at the Trump White House becoming a COVID-19 hotspot, and Fed Chair Jerome Powell going to be speaking later this morning. We're going to be taking that live for you at 10:40 Eastern. We're back right after this.
Welcome back to the first trade. Markets are looking to build off their Monday rally on hopes of more stimulus. The wild card on the rally, though, is, of course, COVID-19 stricken President Trump. He is back in the White House and has had his fingers on the tweet button this morning. All eyes are on his behavior as lawmakers try to hash out fresh relief for millions of struggling Americans. Let's check in on the markets now with Yahoo Finance's Inez Ferre. Inez?
And Brian, we're taking a look at a mixed picture right now. We're looking at Alteryx up 27%. This is a trending ticker on Yahoo Finance, a data analytics company, soaring after raising its revenue guidance and also announcing that board member Mark Anderson will succeed co-founder Dean Stoecker as CEO effective immediately. Now, Stoecker will serve as the company's executive chairman. Wedbush analyst Dan Ives reiterating his buy rating on Alteryx with a price target of $132. We're also watching Pfizer and BioNTech. Health officials at the European Medicines Agency will start a rolling review of the company's COVID-19 vaccine candidate. Now, this is sort of a real-time type of review, starting with data from preclinical trials and early testing on humans, and then it will continue to evaluate more data as it comes in. The vaccine candidate is currently in a global phase 3 study with around 37,000 people around different countries. And we're watching also Southwest of about 0.6%. Of course, year to date, this stock is down 28% as the airlines have gotten hit. But Southwest is asking labor unions now for pay cuts, to accept pay cuts in order to not have to furlough or lay off employees. Southwest CEO Gary Kelly delivering a video message to employees saying domestic travel is at 1970s level. He has already reduced his salary, and that salary will now go to zero through 2021. Senior roles, executive roles, management roles, all of those have had pay cuts. Now, if Congress approves more payroll support, then those pay cuts that the company is asking for from the unions will be discontinued or reversed, Brian.
Thanks so much, Inez. Okay, Momentum Advisors Chief Investment Officer Alan Boomer joins us now. Alan, always good to see you here. Let's start on the market resilience. We've seen this market continue to push higher despite the erratic behavior out of the White House, despite earnings estimates on the street past their peak, so they are flattening out. And despite another few weeks of layoffs from really major companies, do you think this resilience is warranted? And what do you think the next move could be?
Good to see you again as well, Brian. Thanks for having me. I think there's a couple of glimmers of hope here. We saw the ISM Service Index come out with a reading that was better than last month. It was above 50 again, which indicates an expansion. I mean, that's good news. We're seeing this K-shaped recovery. When I say K, I mean there's certain industries that are doing really well, that are recovering well, I should say. And then there's other industries that, like the airlines, which are, continuing to struggle. And so I think, with the prospect of stimulus happening, perhaps after the election, there's some hope that things will be okay.
Alan, I want to talk about some specific stocks you like in this environment right now. And one of them is Target, actually trading at 23 times forward-looking earnings. Sounds a little rich to me. What do you like about Target at this level?
Great. Well, thanks for bringing up that stock. It's a good one. What I like about Target, the market trades at about 20 times earnings. I've never seen a bigger dispersion between the high PE stocks and the low PE stocks. There are stocks in this market trading at 1,000 times earnings. I describe a PE as the number of years it will take for an investor to recoup his investment if the company were to pay all the profits to the investors, right? And so 23 years compared to 1,000 years for other companies seems very, very attractive. So what I like about Target is that there've been a number of major retailers who've closed, and Target is kind of becoming the marketplace for a lot of communities. Like when I look at my town in New Jersey, there were, really 3 parking lots in my town that were filled up during COVID. It was a supermarket, it was Home Depot, and it was Target. And so I like that it trades at a reasonable multiple. I also like the dividend yield on Target as well.
Funny you mentioned Target, Alan. Just yesterday, I tried Target's new shipped same-day delivery service. It's phenomenal. I mean, it's really one of the best services out there. But let's stay on stocks. There's only so much political stuff we can handle here right now. Verizon, it's a company we know very well. It is our parent company. Why bullish on Verizon?
I like Verizon because, again, you look at the valuation. Verizon trades at 12 and a half times next year's earnings. They also have a 4% dividend yield. In an environment where the 10-year treasury yields under 1%, income is really scarce. And this stock has kind of not participated in a lot of the, the big rally that's been going on, that's been dominated by the tech stocks, the mega cap tech stocks. And I think in 2021, in an environment where we might get some stimulus, I just think that value stocks are going to do better. And I look at Verizon and they're really just a staple. I mean, they're in the high end of the wireless business. And I think people really value their connectivity today. They also recently did an acquisition that positions them well at the low end of the business as well. So I think Verizon is a great company to own.
Hey, Alan, what do you like right now in big tech? Because a lot of folks are saying that these big multinational tech companies could get hit hard if we see a blue wave and corporate taxes rise coming out of Washington. You've also got some lawmakers who are still hell-bent on breaking up big tech. Is there anything there that looks attractive at the moment?
Yeah, I agree that there's some regulatory overhang over the big tech market. I also think, there's a secret kind of technical issue that not a lot of folks are paying attention to. You've got mutual funds that are capped at owning, no more than about 5% of their fund in these companies. And today, the top 5 companies are something like 23% of the S&P 500. So with that aside, I like Google. I think Google's a great business to own. They trade at what I'm going to call a reasonable multiple, especially amongst big tech. They're in the low 30s on the PE basis. And I just think they're positioned in every business where you want to be in a COVID world. They're in digital ads, they're in search, they're in enterprise cloud. My kids are at home right now using Google Classroom to communicate with their teachers. So, again, I think Google's a great business. They also are positioned well for 5G. So they've already developed a 5G handset. And, we're just waiting for the 5G spectrum to come out more broadly.
All right, we'll leave it there. Momentum Advisors Chief Investment Officer Alan Boomer. Always good to see him. Appreciate you coming with some stock picks.
Great. Thanks for having me.
There is a growing backlash this morning over the president's seemingly cavalier removal of his mask when he got back to the White House from his hospital stay last night. Health officials are warning not only about the message it sent, but also that he runs the risk of infecting the White House staff with coronavirus. Dr. Anand Parekh is the chief medical advisor at the Bipartisan Policy Center and also a former deputy assistant secretary in the Department of Health and Human Services. Dr. Parekh, good to see you again. Just first off, your response to what you saw when the president took off his mask at the White House. Are we maybe reading too much into that?
Alexis, I think it's very, very important that, particularly over the next couple of days, while the president is infectious, particularly, that he adheres to public health guidance. And that means everything from wearing masks to staying physically distant to having good respiratory etiquette, hand hygiene. There are hundreds of employees who work on White House grounds, and anyone exposed will need to be quarantined. So, in general, it's important that the president follow these public health guidelines, but it's really, really important right now because he is still likely, Alexis, probably in day 6 of his course right now, still infectious. I think he's still not out of the woods yet. For him, I think we worry, particularly at his age and given his risk factors, sort of day 7 to day 10, when the immune phase of the virus kicks in. Now he's on a steroid. Hopefully that'll blunt it, but he's not out of the woods. And certainly everyone around him has to be careful. He's going to need to be isolated and follow public health protocols.
Doctor, let me read this tweet from the president we got about 2 hours ago. Flu season is coming up. Many people every year, sometimes over 100,000, and despite the vaccine, die from the flu. Are we going to close down our country? No, we have learned to live with it, just like we are learning to live with COVID in most populations, far less lethal. Your response to that? Yeah, it's apples and oranges. Totally different situation here in terms of what we know about flu, what we know about COVID-19. Mortality rate for COVID-19 significantly higher than flu. For flu, of course, we have a vaccine. We have a variety of treatments for COVID-19. We still await a vaccine. We still await more treatments.
It is very much an apples and orange comparison. It is an important point that all Americans should be getting a flu shot. We need to take flu off the table, particularly this fall and winter, so the healthcare system is not trying to deal with both COVID as well as flu. So that is an important point. But he still, Brian, doesn't get it. And I think that is the concern. I think we were all hoping that he would pull through, and he is, and it's great to see that he's seemingly feeling better. But I think we were also hoping that he would be much more humbled and sobered after his experience in the hospital, after 210,000 Americans have died, that he would send in the important message that this is not something to be cavalier about. We need to take this seriously. We need to wear masks in public. We need to be physically distanced. We need to do all the things that he hasn't been doing. And so I think it is concerning to read some of the tweets that are coming out.
Doctor, let's stay on this one. The president also said in a video he might be, quote, he may be immune to COVID-19. Have you seen that with any patients anywhere? And is that possible?
He shouldn't be making any scientific statements. I think, the experts have been clear throughout this public health crisis. Sometimes he uses language. He's not quite sure what he is saying. But no, right now he is infectious. He's in day 6 of his bout with COVID-19. These are critical days for him. The rest of the week, he is ill. He is infectious. It's going to be really important to measure and note his oxygenation status. I think for his health, for the health of people around him, he needs to be focusing on recuperating and making sure that this outbreak, which was preventable, doesn't continue to spread across the White House.
And doctor, before we let you go, there's this report today the White House is trying to block new FDA rules over a coronavirus vaccine. What's behind that? Is this because they want to try to rush this vaccine to market ahead of the election, maybe?
These are really non-controversial standards that the FDA has put out there as guidance to manufacturers. They want to make sure that the tens of thousands of Americans who are participating in clinical trials right now are followed for an adequate amount of time. They're saying a median of 2 months to ensure there aren't adverse events and to ensure that the effectiveness of the vaccine is longer than just short term. So they put out this information. I think manufacturers get it. There's going to be an FDA advisory committee that's going to discuss this on October 22nd. This is really not something the White House should be getting involved with. It really seems like sort of the politicization of science. So the White House should just let the FDA do its job. The FDA knows how to do this. The FDA works with manufacturers every day. They work with independent advisory committees. And so hopefully we need to let that process stay out, because Alexis, at the end of the day, it's not just about vaccine approval. It's also about vaccine confidence and uptake. And we've seen some of the polls of the American public. Less and less people are saying that, or are committing to definitely or probably getting a vaccine. So we need to build vaccine confidence in this country. And the way to do that is to let the FDA do its job.
Excellent point, Dr. Anand Parekh. Thanks for your insights this morning.
Thank you, Alexis. Take care. Thank you, Brian.
Coming up, we'll dive into how America's teens are spending what little money they do have. Stay tuned. Welcome back to the first trade. The impact of the COVID-19 pandemic isn't leaving out any demographic or age group. Piper Sandler is out with its annual teen spending survey, reporting that teen spending is at an all-time survey low. But the younger generations are spending their money and time on video games and movies. Joining us now to discuss is Piper Sandler Senior Equity Research Analyst, Young Kim. Young, good to see you. So I guess no real surprise that teens are at home much more than they probably have been ever before, playing a lot of video games. What interested me in this report, why is Call of Duty so popular? Call of Duty put out by Activision Blizzard. You cover Activision Blizzard. Why is this game winning, and why is Fortnite off its peak?
First of all, thank you for having me, and good morning. I think the reason Activision is doing so well, and specifically Call of Duty, is in large part due to their launch of what they call Warzone in the spring. Now, in the spring, we run our survey twice a year, once in the spring and once in the fall. And when we launched this survey in the spring, COVID was still in its early days. Stay-at-home regulations were still early, so we noticed some uptick, but not a significant level. What we're seeing after a summer of staying at home is that, by and large, a lot of these teenagers are playing Call of Duty, and I believe it's likely Warzone that they're playing because it was initially launched in March. And yes, it did overtake Fortnite for the first time in our survey, and I think that's largely due to the new game on the block, so to speak, even though they do have an annual iteration. But I think the Warzone really hit a chord with a lot of these teens, partly because it's free to play, which Fortnite also is, but it's the new free to play game that happened this year, and I think our survey kind of captured that.
Young, let's move away from video games for a moment and talk a little Netflix and lots of streaming services popping up, Quibi among them. Is Netflix sort of losing its mojo with this demographic?
You know, what I've seen so far in the last few surveys that we've done is that Netflix is still, by and large, ahead, the leader in terms of mindshare amongst these teens. Yes, there are new competitors. We did include Disney Plus as well as Apple Plus in our survey, but they actually lost share. Apple Plus and Disney Plus actually lost share from our spring version of this survey, and Netflix continues to lead, which actually came as a bit of a surprise to me because there is no live television component. I was thinking that amid the time of COVID, amid the time when everybody wants to hear or see breaking news, that Netflix would probably take a step back to, like, for example, YouTube or even cable TV. But that's not the case with Netflix amongst the teens.
You know, based on the data that you've found here with regards to Netflix, do you think Netflix is in a position to successfully raise prices in early 2021? And how much do you think prices will be raised?
It's hard to say how much it'll be raised, but I think they are in a position where they can. I think what we've seen in both this survey with teens, but also other surveys that we've conducted, is that, you know, the consumer value proposition of Netflix has only increased amid COVID. I think, especially for an entire household where you have multiple demographics in a household, the subscription to Netflix has become even more important, so that every member of the household has something to watch at any given moment. So I think the possibility of raising prices is there. I think it does raise a very strong value proposition, but it's just hard to say what the timing will be of that, what the actual amount will be. But it seems like there is an appetite amongst the consumers to accept that to a certain degree.
All right, we'll leave it there. Piper Sandler, Senior Equity Research Analyst, Young Kim, really good work here.
Thank you very much.
All right, do stick around. There's much more ahead on the first trade. Welcome back to the first trade. The world is putting more faith in science. This morning, 3 scientists were awarded the Nobel Prize in Physics for their black hole discoveries. Going hand in hand with this, a new study by 3M is out this morning showing that trust in scientists is the highest it has been in 3 years. Joining us now for more details is 3M Chief Science Advocate, Dr. Jayshree Seth. Doctor, good to see you this morning. So walk us through this survey. How does it compare, how the results today compare to pre-pandemic?
Thanks for having me. Yes, science is having a moment in 2020, and we did a survey before the pandemic and one during the pandemic. And we can clearly see that skepticism is down for the first time since we started tracking it. Trust in science and scientists, like you said, is up. People are also more willing to acknowledge the role of science in their lives and the role of science for society. 54% of the people now say because of the pandemic, they're more likely to advocate for science. And get this, 92% of the people say that we need to follow the scientific evidence and science in order to contain the pandemic. So certainly science is having a moment in 2020, as revealed by the 3M State of Science Index.
And no better time to do it, Doctor, smack in the middle of a pandemic. What else did your findings show in terms of where Americans are placing their trust? What are some of the sources that they're trusting right now?
They're definitely most likely to trust science and scientists. And among the least likely is social media. And 47% say they trust company websites. So this is an interesting opportunity for scientists and corporations to step up into this role of advocacy and bolster that public trust in science, because this is a perfect moment when people are more receptive, is what we're seeing.
Doctor, throughout the pandemic, the president has continued to attack science. Has these comments from the president changed how you go about your job, but also those other scientists in your community?
Well, science transcends politics. Science is here to stay. It will be, it has been. And we see what the world is saying. It's 92% of the world saying we should follow the science and 90% of Americans. So the data is very representative. So we are bolstering all our efforts towards science advocacy, because the other themes that emerge in this survey are also very important. People still think sustainable solutions to all the problems we face are important, and science is critical to that. People also see that we need more STEM education. They are willing to now acknowledge that we need that to solve the problems we face as a society. And we're seeing there that there are people who are still discouraged from taking science. And so we need to address that, because this is not an acceptable solution where people say that they have lack of access to quality STEM education, or were discouraged because of their gender or race or ethnicity. So there are issues that we need to address there. And finally, we're seeing that people want government to take lead in solving some of these problems and societal issues, but they also want corporations, NGOs, and academia and individuals to step in. So we all have a role to play.
And it also looks like, according to your survey, that most people want more funding for the science that they are now believing in during this pandemic.
Absolutely. That recognition of the value of science and the way the whole scientific process has played out during this pandemic has really raised that awareness. So it's a great opportunity for all of us to join forces and advocate for science.
Doctor, you have a remarkable story. You started at 3M as a summer intern in 1992. Briefly, how did you get to this position you are now?
Well, I, as you said, started as an intern, and during that time, I got hired in as a full-time researcher. So I joined the area of diaper tapes at that time. And I had never seen a diaper, so it was interesting. But my PhD was in making diamond-like films, and I'd never seen a diamond. So I was ready to go at it. And then I've been doing a lot of great work around sustainability, because that's a very strong piece of what we do at 3M. So lots of sustainable industrial products. And then one day I was approached, when the results of the first 3M State of Science Index were being studied, that we absolutely need to advocate for science. Because one of the stats that is very interesting is, at that time, 4 out of 10 said if science didn't exist, our lives would be no different. 4 out of 10. And they were taking the survey on their laptops or mobile phones. So you see the problem. Science is underappreciated. Science is invisible. Science is taken for granted. So I was absolutely shocked when I saw those results. And so I was like, I'm all in. I want science to be out there, and we want to advocate for it. So I took this role on, and it's just been a phenomenal role. We have done this survey now for 4 years. This is the fourth year, and it's very interesting to see how, when science plays out on the world stage, that people now really do appreciate science and acknowledge and are willing to advocate for it.
Real interesting findings at a very interesting time in our country. Let's leave
Certainly.
it there. 3M Chief Science Advocate, Dr. Jayshree Seth. Good to see you.
Thank you so much.
All right, Petco just made a big decision that may impact your furry friend. We have more with Petco CEO Ron Coughlin coming right up. Welcome back to the first trade. Let's get back to Inez Ferre for another look at the markets. Inez?
And Brian, we're taking a look at the major averages, which are in the green, slightly in the green. We're watching some of the FANG names, particularly Apple and Amazon, after a draft of a House panel report is set to recommend some sweeping reforms, essentially to block Apple and Amazon from both owning a marketplace and also selling its own products on that marketplace. Now, this is according to a Bloomberg report citing a Republican critique of that recommendation. The release of the report is expected this week, but has been pushed back. Also, we're watching Alphabet's Google after Alphabet's Google has announced that it's renaming its G Suite of business tools, calling it Google Workspace. The rebranding coincides with the launch of some new features to those tools. And then we're also watching Ford after Ford announced that it now holds more than 13 million shares of Velodyne LiDAR. This is an autonomous driving company. That's about a 7.6% stake in the company. And Velodyne LiDAR, which specializes in sensors for cars, went public through a SPAC last month, Brian.
Okay, some exciting news in the world of pets. Petco announced this morning that it's removing pet shock collars from its stores and online, and is providing resources for pet parents to discipline their furry friends in less harmful ways. Joining us now with the details is Petco CEO Ron Coughlin. Ron, good to see you again here. I've been in Petco stores before. I've never seen these collars. How many stores were they in, and why were they in the stores to begin with?
Yeah, they were in all of our stores, but when we look at it today, our mission is about improving lives. And when we think about shocking your furry friends, we believe that electricity belongs in microwaves, but not to be used as training. Actually, we don't believe in discipline training. We believe in positive training, and that's a better way.
Ron, I'm wondering if I know those shock collars are going away. I don't have any idea if you deal with the fencing. Some people have those sort of electric fences around their properties to stop their pets from leaving the property. Do you know if those are going away as well?
Yeah, so we have a veterinary advisory council with some of the top vets as well as veterinary behavioralists. And so this is the first step in a multi-stage journey. Actually, it's the second step. The first one was getting rid of all foods with artificial ingredients and flavors. And then today, the shock collars, where there's just a better way. And it really was triggered by our launching of online training. So now there's nobody in America that can't train their pets positively and appropriately. And so we thought today is the right time to make this move.
Ron, it sounds as though you're really looking at your portfolio of products and just removing things that no longer make sense. Are there other items on the chopping block here? Leashes with muzzles, choker collars. What else could be pulled from the shelves?
Yeah, we've really dedicated ourselves to being a health and wellness company. So, the more important thing actually that we're driving next is around affordable vet care. 70% of pets don't get the care they need because of affordability. So we are in the process of doing the fastest build out of a vet network in history. And we went from 0 to 100. We just launched our 100th store. We'll be at 140 by January, eventually getting to 800. So that's the most fundamental thing. But as I said, we're constantly looking at our portfolio and making adjustments. The next thing is actually artificials and companion animal foods, which we needed to work with the vendors to generate that change. And that's happening as we speak.
Talk to us a little bit about the cost of doing all of this. This is pretty aggressive, getting those doctors, those vets into all of the stores over a course of time. And sadly, when we think about eating healthier, whether it's for humans or pets, sometimes that comes at a premium. So how are you handling the cost, and might we start to see some prices for some of these things go up at Petco's?
Yeah, we pride ourselves in having a variety of choices for different affordability. 2 years ago, we got rid of artificial foods that had artificial ingredients and flavors. That was a $100 million bet. And guess what? It restarted our growth and it elicited the passion from the partners in our stores. This is a $10 million bet, but we believe it's the right way to do things. And what I've said since minute one is what's right for the pet is going to be right for business. And that's held true, and I'm confident it's going to hold true with this initiative.
Since we last spoke with you, Ron, there were some reports that you are eyeing an IPO. How long away in that process are you?
Our partners are doing a great job taking care of more customers in more ways. And when you have success, people talk, but we don't make comments on anything in that area.
And lastly, in terms of innovation, what can we expect for our pets from Petco in the coming months?
Like I said, we're rolling out our veterinary network. And along with that, we've just launched something called Vital Care. And Vital Care is really the only holistic solution for a pet parent to ensure they're providing health and wellness for their pets. So whether it is grooming, whether it's your vaccination, whether it's discounts on food, we are the only pet provider that can go end-to-end in an integrated fashion, provide all those things for a pet parent. And Vital Care allows you to do that in a simple monthly payment. We think it's quite breakthrough.
All right, we'll leave it there. Petco CEO Ron Coughlin, good to see you again, and good to see what you're doing here.
Thank you very much. Appreciate it.
Okay, do stick around. We are about to hear from Fed Chairman Jerome Powell. Our Fed correspondent Brian Chung is here with a preview on what Powell could tell markets. Welcome back to the First Trade. Federal Reserve Chairman Jerome Powell is set to speak in just a few minutes at the National Association for Business Economics annual meeting. Our Fed correspondent Brian Chung is with us now. Brian, what might Powell say here?
Well, a big speech from Jerome Powell, obviously, here this morning. But within the context of everything that's been going on, it does seem like the Federal Reserve's been trying to de-emphasize its role as the eyes really shift to fiscal policymakers as they continue to work through that second round of coronavirus relief right now. Now, the concern here, though, is still that the Federal Reserve does still have some bullets in its chamber. When you consider things like what the Federal Reserve's been doing with its forward guidance, they've already pinned interest rates to when they can expect to see liftoff, which won't be any time in the future, as we've heard the Fed chairman say. But they could still do things like pin quantitative easing or asset purchases to that guidance as well. That could be something that maybe Jerome Powell discusses in this particular speech. All that we know so far is that it's going to be about the economic outlook. So that could mean a wide variety of different things. But again, I think the tone from the Fed chairman with regards to what's happening on the fiscal policy side of things could definitely be in view. The Fed chairman's been walking this tightrope with trying to tell fiscal policymakers that more support is needed while also trying to maintain the Federal Reserve and the central bank's independence. That does remain an issue here. Another thing that's also worth mentioning is that this is his first remarks since the Federal Reserve got that print on the September job report, which we got just last Friday, where the unemployment rate dipped down to 7.9%. That's still above where the Federal Reserve expects to see unemployment end the year, but a number of things overlooming this speech, which should be beginning quite soon.
Brian, do you think we might hear anything more about support for small businesses and the Main Street lending program? Because we see, especially in lots of large cities here in New York, so many businesses have shuttered to never reopen again.
Absolutely. And that was the big focus of his back-to-back 3-day round of hearings about 2 weeks ago on Capitol Hill. There was a lot of focus on the shifting between whether or not it should be the Federal Reserve's Main Street lending program, which offers loans to medium and small businesses, or the Paycheck Protection Program that was granted in that first round of CARES Act funding back in March, which, as we know, has dried up since that point in time. Now, what we do know is that there's a pretty big difference between those two programs, which the Fed chairman has emphasized, that being Paycheck Protection Program loans are forgivable. If you can prove that you've used the majority of it or a lion's share of it on keeping your workers on payroll, then you could have that loan forgiven. The Main Street program loans cannot be forgiven. They will have to be paid back at some point in time because the Fed has what they call lending powers, not spending powers. So the Fed has said right now, what we know is that businesses still need help. You look at the Yelp data, for example, that shows that a large percentage of businesses that were marked as temporarily closed at the beginning of this crisis are now permanently closed. So the need for support is there, but the Fed's argument is, well, we can't offer grants that would be forgiven. So why would companies want to take on more debt? I think that's really underscored the Federal Reserve chairman's tone in saying it really needs to be fiscal policymakers, not us here at the Federal Reserve, to offer that kind of support.
Brian, this will also be Jay Powell's first speech since the president got diagnosed with COVID-19. How will he thread that line?
Well, it's entirely possible that he speaks on that. I would say a very low chance that he makes any remarks on that thing. As we know that the president's health has been a major concern for markets, but the Fed chairman doesn't like to talk about even the politics of whatever the president is saying. This was especially the case when the president was particularly critical of the Fed's policies during those 2019 insurance rate cuts. Now, the Federal Reserve chairman, again, could talk about broadly the risks facing the economy, but I think it would be very, very low probability that he speaks specifically on the idea of the president getting sick over the weekend.
Brian, earlier in the show, we spoke with Goldman Sachs about the municipal bond market, and we have state and local governments facing historic budget falls. We know the Federal Reserve has tried to backstop municipal finances, but there was debate on the Hill recently about whether or not the Fed has done enough. Do you think we may hear from Powell regarding the muni market, and what else can they do to lend support?
Well, it is definitely possible that the Fed chairman could be speaking to the idea of those, support to those local and municipalities. What we do know is that the budget shortfalls have been huge, with essentially no tax revenue coming in because of the amount of people that have been laid off, in addition to areas where there's lots of sales taxes. Obviously, consumption has been quite low as well. Those are all major concerns. And actually, Alexis, I'm just now seeing that some of the headlines from the Fed chairman's speech are crossing the wires, although he has not officially made his appearance yet. But the Fed chairman is saying that Congress and the Fed should not be afraid of overdoing it. That's a quote from the speech text, again, just released by the Federal Reserve a few minutes ago, saying, quote, "The risks of overdoing it seem for now to be smaller." The Fed chairman adding that, quote, "too little support would lead to a weak recovery, creating unnecessary hardship for households and businesses," end quote. That does seem to hint that the Fed chairman is pushing, again, harder on fiscal policymakers to be doing something during this time. This does come as the Senate Republicans are arguing here. It does look like, by the way, he's about to make his remarks.
That's right, Brian. Let's get to Fed Chairman Jerome Powell right now.
Thank you, Lisa, and also Constance and Ellen. It's good to see all of you. Good morning. So it has been just 8 months since the pandemic first gained a foothold on our shores, bringing with it the sharpest downturn on record, as well as the most forceful policy response in living memory. Although it's too early for definitive conclusions, today I will offer a current assessment of the response to the economic fallout of this historic event and discuss the path ahead. As the coronavirus spread across the globe, the U.S. economy was in its 128th month of expansion, the longest in our recorded history, and was generally in a strong position. Moderate growth continued at a slightly above trend pace. Labor market conditions were strong across a range of measures. The unemployment rate was running at 50-year lows. PCE inflation was running just below our 2% target. The economy did face longer-term challenges, as all economies do. Labor force participation among people in their prime working years had been trending down since the turn of the millennium, and productivity gains during the expansion were disappointing. Income and wealth disparities had been growing for several decades. As the expansion continued, its long run, however, productivity started to pick up. The labor market strengthened, and the benefits of growth began to be more widely shared. In particular, improved labor market conditions during the past few years encouraged more prime-age workers to rejoin or remain in the labor force. Meanwhile, real wage gains for all workers picked up, especially for those in lower-paying jobs. Most economic forecasters expected the expansion and its benefits to continue, and with good reason. There was no economy-threatening asset bubble to pop, and no unsustainable boom to bust. While non-financial business leverage appeared to be elevated, leverage in the household sector was moderate. The banking system was strong, with robust levels of capital and liquidity. The COVID-19 recession was unusual in that it was not triggered by a buildup of financial or economic imbalances. Instead, the pandemic shock was essentially a case of a natural disaster hitting a healthy economy. Given the condition of the economy, in the early stages of the crisis, it seemed plausible that, with a rapid, forceful, and sustained policy response, many sectors of the economy would be able to bounce back strongly once the virus was under control. That response would need to come from actions across all levels of government, from health and fiscal authorities and from the Federal Reserve. It also seemed likely that the sectors most affected by the pandemic, those relying on extensive in-person contact, would face a long and difficult path to recovery. These sectors and people working in them would likely need targeted and sustained policy support. Some asked what the Fed could do to address what was essentially a medical emergency. We identified 3 ways that our tools could help limit the economic damage from the pandemic: providing stability and relief during the acute phase of the crisis when much of the economy was shut down, vigorously supporting the expansion when it came, and doing what we could to limit longer-run damage to the productive capacity of the economy. When it became clear in late February that the disease was spreading worldwide, financial markets were roiled by a global flight to cash. By the end of the month, many important markets were faltering, raising the threat of a financial crisis that could exacerbate the economic fallout of the pandemic. Widespread economic shutdowns began in March, and in the United States, with many sectors shut down or operating well below capacity, real GDP fell 31% in the second quarter on an annualized basis. Employers slashed payrolls by 22 million, with those on temporary layoff rising by 17 million. Broader measures of labor force conditions, such as labor force participation and those working part-time for economic reasons, showed further damage. In response, we deployed the full range of tools at our disposal, cutting rates to their effective lower bound, conducting unprecedented quantities of asset purchases, and establishing a range of emergency lending facilities to restore market function and support the flow of credit to households, businesses, and state and local governments. We also implemented targeted and temporary measures to allow banks to better support their customers. The fiscal response was truly extraordinary. The unanimous passage of the CARES Act and 3 other bills passed with broad support in March and April established wide-ranging programs that are expected to provide roughly $3 trillion in economic support overall, by far the largest and most innovative fiscal response to an economic crisis since the Great Depression. What have these policies managed to accomplish so far? First, the substantial fiscal aid has given vital support to households. The rise in transfers supported necessary spending and contributed to a sharp increase in household saving. Goods consumption is now above its pre-pandemic level. Services consumption remains low, although it seems likely that much of this weakness is the byproduct of health concerns and social distancing, rather than reductions in income and wealth. Consumption held up well through August, after the expiration of expanded unemployment insurance benefits, indicating that savings from transfer payments continue to support economic activity. A recent Fed survey showed that households in July had surprisingly upbeat views of their current financial well-being, with 77% of adults either doing okay or living comfortably, an improvement even over the reading immediately preceding the pandemic. Still, since it appears that many will undergo extended periods of unemployment, there is likely to be a need for further support. Second, aid to firms, in particular the Paycheck Protection Program, and the general boost to aggregate demand have so far partly forestalled an expected wave of bankruptcies and lessened permanent layoffs. Business investment appears to be on a renewed upward trajectory, and new business formation similarly appears to be rebounding, pointing to some confidence in the path ahead. Third, after briefly seizing up in March, financial markets have largely returned to normal functioning, albeit in the context of extensive ongoing policy support. Financial conditions are highly accommodative, and credit is available on reasonable terms for many, though not all, households and businesses. Interest-sensitive spending has been relatively strong, as shown in the housing and auto sectors. Taken together, fiscal and monetary policy actions have so far supported a strong but incomplete recovery in demand and have, for now, substantially muted the normal recessionary dynamics that occur in a downturn. In a typical recession, there is a downward spiral in which layoffs lead to still lower demand and subsequent additional layoffs. This dynamic was disrupted by the infusion of funds to households and businesses. Prompt and forceful policy actions were also likely responsible for reducing risk aversion in financial markets and business decisions more broadly. While the combined effects of fiscal and monetary policy have also aided the solid recovery in the labor market so far, there's still a long way to go. Payrolls have now recovered roughly half of the 22 million decline. After rising to 14.7% in April, the unemployment rate is back to 7.9%, clearly a significant and rapid rebound. A broader measure that better captures current labor market conditions by adjusting for mistaken characterizations of job status and for the decline in labor force participation since February, is running around 11%. The burdens of the downturn have not been evenly shared. The initial job losses fell heavily on lower wage workers in service industries facing the public, job categories in which minorities and women are overrepresented. In August, employment of those in the bottom quartile of the wage distribution was still 21% below its February level, while it was only 4% lower for other workers. Combined with the disproportionate effects of COVID on communities of color and the overwhelming burden of childcare during quarantine and distance learning, which has fallen mostly on women, the pandemic is further widening divides in wealth and economic mobility. I'll turn now to the outlook. The recovery has progressed more quickly than generally expected, and the most recent projections by FOMC participants at our September meeting show the recovery continuing at a solid pace. The median participants saw unemployment declining to 4% and inflation reaching 2% by the end of 2023. Of course, the economy may perform better or worse than expected. The outlook remains highly uncertain, in part because it depends on controlling the spread and effects of the virus. There is a risk that the rapid initial gains from reopening may transition to a longer than expected slog back to full recovery as some segments struggle with the pandemic's continued fallout. The pace of economic improvement has moderated since the outside gains of May and June, as is evident in employment, income, and spending data. The increase in permanent job loss, as well as recent layoffs, are also notable. We should continue to do what we can to manage downside risks to the outlook. One such risk is that COVID-19 cases might again rise to levels that more significantly limit economic activity, not to mention the tragic effects on lives and well-being. Managing this risk as the expansion continues will require following medical experts' guidance, including using masks and social distancing measures. A second risk is that a prolonged slowing in the pace of improvement over time could trigger typical recessionary dynamics, as weakness feeds on weakness. A long period of unnecessarily slow progress could continue to exacerbate existing disparities in our economy. That would be tragic, especially in light of our country's progress on these issues in the years leading up to the pandemic. The expansion is still far from complete. At this early stage, I would argue that the risks of policy intervention are still asymmetric. Too little support would lead to a weak recovery, creating unnecessary hardship for households and businesses. Over time, household insolvencies and business bankruptcies would rise, harming the productive capacity of the economy and holding back wage growth. By contrast, the risks of overdoing it seem, for now, to be smaller. Even if policy actions ultimately prove to be greater than needed, they will not go to waste. The recovery will be stronger and move faster if monetary policy and fiscal policy continue to work side by side to provide support to the economy until it is clearly out of the woods. Given this audience, I would be remiss were I not to mention our review of our monetary policy strategy, tools, and communications, which concluded recently with our adoption of a flexible average inflation targeting regime. My colleagues and I have discussed this new framework in detail in recent remarks. Today, I'll just note that the underlying structure of the economy changes over time, and that the FOMC's framework for conducting monetary policy must keep pace. The recent changes to our consensus statement reflect our evolving understanding of several important developments. There has been a decline in estimates of the potential or longer-run growth rate of the economy and in the general level of interest rates, presenting challenges for the ability of monetary policy to respond to a downturn. On a more positive note, we have seen that the economy can sustain historically high levels of employment, bringing significant societal benefits and without causing a troubling rise in inflation. The new consensus statement acknowledges these developments and makes appropriate changes in our monetary policy framework to position the FOMC to best achieve its statutory goals. The forward rate guidance adopted at our September meeting reflects our new consensus statement. The new guidance says that with inflation running persistently below our longer-run 2% goal, the committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. The committee expects to maintain an accommodative stance of policy until these outcomes are achieved. The committee also left the target range for the federal funds rate unchanged at 0 to 0.25%, and it expects it will be appropriate to maintain this target range until labor market conditions have reached levels that are consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. We expect that the new framework and guidance will support our efforts in pursuit of a strong economic recovery. Thank you again. It's great to be back at NABE, and I look forward to our discussion.
Wonderful. Thank you, Chairman Powell. Lots to work on in our Q&A session, and I think I'll start with a question from the audience, which is about fiscal policy. And following the GFC, we had a significant tightening of fiscal policy, both at the federal level, but in particular at state and local levels. You mentioned this in your prepared remarks, but what would you hope to see in terms of fiscal policy in the next 6 to 12 months?
So, Lisa, I guess I would start by saying that the U.S. federal budget is on an unsustainable path, has been for some time, and I think that's something we will need to return to. And that just means having the economy grow faster than the debt. Having the debt grow faster than the economy is sort of by definition unsustainable in the long run. I would also say this is not the time to give priority to those concerns. The time to do that is when the economy is strong, unemployment is low, people are working, they're paying taxes, we're on sound fiscal and economic footing. That's the time to work on getting back on a sustainable path. You mentioned state and local government, and the same is true of the federal government. Policy was very tight, or conditions were very tight at state and local government because of the financial squeeze they were under during those years, and that held back the economy. There's research, a lot of research showing that. In addition, the federal government chose to cut spending and raise taxes long before the economy was close to fully recovered. And so I would just say that we will need to return to those concerns on financial sustainability. But I think in the near term, as I mentioned in my remarks, I think it's important that we keep working together. And in particular, I would point to one of the unusual characteristics of this downturn is how focused it is on a particular group of industries and people that are directly exposed to the pandemic. And these are people who their old jobs may struggle to come back to them because people will take their time in going back to certain activities that involve a lot of direct contact with other people. So I think the right thing to do and the smart thing to do for the long run is to continue to support those people as they return to their old jobs or find new jobs in different sectors of the economy. Great.
When you spoke to us in 2018, the Fed was just at the beginning of reevaluating their framework. And I've since learned that you are particularly keen of some of the estimates that you showed of how the Phillips curve and inflation trends had flattened over the past 2 decades. And those realizations helped inform the Fed's decision to engage in the average inflation targeting model. In the spirit of careful what you wish for, should we actually see some of those trends start to revert? Do you worry that it may actually be difficult to turn some of those trends back if they start to move upward?
Well, I guess I would say that the economy is ever changing. And the framework that we use has to adapt. It doesn't tend to change very quickly. It tends to change gradually over time. So if you go back to the 70s, what you had was a steep Phillips curve and also a high persistence of inflation. And those were the two of the charts that I showed. I think this was in Boston at your meeting there. And they really capture the change in inflation dynamics in our economy since that time. Of course, at that time, as the labor market tightened, you would see inflation move up. And when inflation moved up, people would expect, inflation is going to be higher. And so it would be persistent.
Yeah.
Now that the Phillips curve for a long time now has been pretty flat, and persistence is also quite low. So we need to take that into account. But we're not under any illusion that any of this is a permanent state of affairs. The economy will continue to evolve. We know that. And we know that we will have to keep adapting our framework as it does evolve. On inflation and the risk of something happening unexpectedly there, I think if you look around the world, what you see are disinflationary pressures from demographics, from technology, all over the world. And there's no question that that can change, and ultimately, I suppose it will change, since nothing in this is permanent. But I would say that these have been persistent forces now. Disinflation, declining inflation, has been a persistent factor for some time. We are still seeing downward pressure on inflation, and I think it's appropriate for central banks, and certainly the Fed, to take that into account and move to a framework that is robust to that current situation, so that we're able to respond to future downturns.
Great. If we look back 10 years from now at the policy that has just been implemented, what would be signs of success?
Well, so as I mentioned, as we've gone through this, we had sort of three consecutive objectives, one of which was to provide stability and relief when the economy was closed down, and the second was to support the expansion when it came. Well, it's here, it's well along. And the third was to avoid longer run damage to the productive capacity of the economy. And that can come in two major ways, one of which is people being out of the labor force so long that they lose touch with their ability to participate in the economy, their working lives, and frankly, their lives are disrupted in a very bad way. The other is just bankruptcies, unnecessary, inappropriate bankruptcies of particularly smaller businesses. There are always going to be bankruptcies and there's always going to be unemployment, but to have those go up to a high sustained level can do damage. So I would think the one thing I would look back on is how well we succeeded at that. And by the way, that is a lot of the urgency we've been feeling, is to do what we can as quickly as we can so that we can avoid those problems. And I think I mentioned temporary layoffs. So you see, when temporary layoffs have a way of dissipating either into permanent layoffs or into return to work, and that tends to happen fairly quickly. So it's now when we need to be working on that problem, because once you're permanently laid off, it's just more difficult. The data are really clear that it's just more difficult to get back in the workforce. So we want to help those people, as I mentioned earlier.
Yeah, and I think one of the questions I'm seeing here is about winners and losers with the recovery, and that demographics, technology, aging, all of these create unique dynamics where we actually may be seeing in this recovery that the winners remain winners and the losers remain losers. How can the Fed hope to address these dynamics? Is there a unique role for fiscal, regulatory, or other government policies to perhaps address these dynamics?
Well, we can help, but clearly, this is not something that monetary and policy and supervision of banks and financial stability and payments can do all by itself. Those are the jobs that we have. Clearly, we have, and we've said this from the beginning, this will be a work of all of government, in the first instance from the health authorities, but then from fiscal authorities. And I wouldn't be, if you just look back to February of this year, it's only been 8 months. And we had wages going up the most for people at the lower end of the wage spectrum. We had labor force participation moving up against all the predictions that if you'd gone back a decade and said what'll be happening with U.S. labor force participation, nobody thought that labor force participation would still be meaningfully above 63%. And yet here we were at 63.4%. So anyway, I am optimistic that I'm very optimistic that we can get back to that. But it will take a concerted and continuing effort, I think, from policymakers to get us through, particularly this next phase. While the expansion is ongoing, it's still moving at a pretty good clip. And I just think it's important that we stay at it.
Wonderful. Some in my industry have described the decision of the Fed to intervene in markets through purchases of investment grade bonds, as well as the traditional MBS and Treasury assets that we saw during the global financial crisis, as the Fed moving from being the referee on the field to a player on the field. And can you describe how the Fed plans to move back to its traditional role as referee? And are there downsides of the Fed being the player on the field?
Well, so let me go back to the beginning. As this began to unfold and as it became clear what was getting ready to happen and the likelihood of a shutdown and the great unknown about what that would mean and the fact that it was happening globally, we came to the view, my colleagues and I came to the view pretty quickly that we needed to use all of our tools and needed to do so in maybe ways that had never, where there had been red lines saying we won't cross these red lines. And there I'm thinking particularly of the lending to corporates and to state and local governments. I don't know how I would have been able to explain to the public that we didn't go to the limit of what we could do. I just thought we have to do this. We're going to do this. And we did. So we took those roles on in this historically unique situation. And I think, history will judge how well we did, but we did it. And I have never regretted the fact that we did that. And we knew from the very beginning that there was going to be a time to put away those tools. That time is not here, but when that time comes, we will put them away. And there will also be issues around expectations that we now have these new tools and we can use them all the time for different things. And that's going to have to be something that we work on as well, because we don't want the Fed, no one should want the Fed to be intervening in markets on a routine basis like this. This was really we hope, once in a lifetime situation. So, we're determined to, first of all, we're going to keep at it until we are very far along and sure that we're out of the woods here. We're in no hurry to stop doing what we're doing. But when the time does come, we will put these away. And we're not looking to find ways to keep them in place and take on new and different roles. These are really emergency tools. And when the emergency is well and truly behind us, and we're highly confident of that, we want to put them away under lock and key. And we'll use them again if we have to, but not on an ongoing basis.
So one of the questions here refers back to your speech as well as President Evans' speech on the word and when you talked about how long we should expect a near zero Fed funds rate, we should expect maximum employment and inflation moderately exceeding 2%. And so this is from Robert Dye. And he says, that sounds like lower for much longer. Is that the message? Which I think I know what the answer is, but I just thought I would ask specifically.
Well, I hope that our guidance the guidance that we issued was clear. And what it said was that we have longer term goals, which are to achieve average inflation and inflation expectations anchored at 2%. And we would remain and we said we wanted to have an overshoot because we'd had a long undershoot. And until we do those things, we'll keep policy accommodative, we said. At the same time, we said we would keep policy at the current level until really three things happen. One, labor market conditions are consistent with the committee's estimates of maximum employment. Two, inflation has reached 2%. And three, inflation is on track to move moderately above 2% for some time. So that's, the thing is, that's not a time-based commitment. That is an outcome-based commitment. And I think that's really one of the nice features of it, is that if the economy recovers much faster than we expect, that'll be great. And this guidance will work in a whole different range of possible outcomes, a vast possible array of outcomes. And if it's slower, then we'll be at the lower bound longer. So that's really what it's meant to accomplish.
Yeah. I have a couple of questions in here about the implications of running inflation at a hotter pace for folks who are on fixed incomes, the elderly, the distributional effects may be somewhat more negative for folks who are on fixed incomes. Any thoughts on some of these sort of perhaps downside effects from the policy?
Yes, so monetary policy is famously a blunt instrument, and I would just point to look at the last recovery. We managed to get to 3.5% unemployment and stay pretty bouncing around between 3.5% and 4% for 2 years. That had enormous benefits for low and moderate income communities, for people at the margins of the economy. Participation moved up. It had great societal benefits. Now, so low interest rates do work to support economic activity, and I think we believe that, and that seems to be the case. It's not that every single person will benefit, and although if you own a home or if you own other financial assets or if you have children who want jobs, lots of people will benefit from low interest rates and a stronger economy. And of course, our assignment from Congress is maximum employment and stable prices. That's what we're supposed to use our tools to accomplish.
So I think I ask you this every year, and I will ask you again. And it always helps to get clarity on this point. Just recently, the San Francisco Fed wrote a research piece on the effects of negative interest rates in other economies and the banking systems there, and the willingness of banks to lend and extend credit. And those negative rates they found did create a negative impulse out of the banking system into the real economies of those countries. And so for the United States here, the Federal Reserve, what are your thoughts on negative rates?
So really nothing has changed since the last 2 years on that. So it's just negative rates are not a tool that we see as something that we're looking to use. And it's really two things. One is that we have tools that we think served us well and will continue to serve us well. And the second is as you just said, the evidence on negative rates is sort of mixed. There is the effect on financial intermediation. There may be also a positive effect to the extent using negative policy rates causes rates that face the public to move down lower. There's probably a positive effect there, but since it's not clear, and since we feel like we have, policies, likely at full employment, we will again have policy space on rates. And I think we understand asset purchases better and better. So I think we have the tools that we need.
Wonderful. During the GFC, there was quite a bit of coordination across the global central banks. It was much more of a financial leverage type of crisis than the COVID crisis. But perhaps you can spend a couple of minutes discussing how you've been coordinating with other central banks in response to the COVID crisis.
Sure. So there's a lot of communication all the time between central banks, both at the staff level and including me with my peers, and informally. There's also we have regular meetings every 2 months in Basel, and although currently we do those, of course, not in Basel, but on a group call. So there's a lot of communication going on. I'd say when this crisis broke, I would point to a couple things. First, the swap lines. With ultimately, 14 different countries. So that was international coordination. There was one difference this time, though, which is that in the global financial crisis, more central banks had room to cut rates, meaningfully cut rates. So, and we were we had easily the most policy space to do that, which we did very quickly at the beginning. But so there didn't need to be a lot of coordination on that because, other central banks, important central banks, were already at negative rates or very low. So, but I would just say the coordination is essential and it's ongoing. And I think because we're independent, we're not part of the governments. We have a very collaborative and constructive relationship with each other and a lot of communication, and that's a healthy thing.
Great. So I'm seeing two questions that are essentially about the interplay between the Fed's new policy and the capital markets. And I'll ask you both questions, and they're basically the opposite scenarios. So the first scenario is X number of years down the road, we still have not met the Fed's new policy objectives, and at the same time, we see serious asset bubbles. What should or could the Fed do to respond to this? The obverse is basically, let's call it X number of years down the road, and the Fed's hitting its objective, and inflation and unemployment are within the target as stated by the Fed, but asset markets are down considerably. How should the Fed respond? So it's basically the same question with two opposite scenarios.
Okay, so the first one, so we said in our, we say in our new consensus statement that, I'll just read this, that sustainably achieving our goals depends on a stable financial system. Therefore, the committee's policy decisions reflect its longer run goals, medium-term outlook, and assessments of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. We also had there's a statement in our post-meeting statement that notes that we'd be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. Now, one of those risks could be financial stability, but I would look at it more as kind of a humility clause. We know that the economy can react in surprising and unexpected ways. Witness 2020. And so we say explicitly in our statement that, again, if risks emerge that could impede the attainment of the committee's goals, then we can respond that way. Now, I would also have to add that I don't think, and we don't think of monetary policy as the first round of defense on financial stability. That really is a job for capital, liquidity, risk management, all of the things that the banks do so much better now. That's really the stress testing, all the things that we do. That's really the first line of defense against financial instability, is just having a really strong and robust financial system that's resilient to the things that can happen in the financial system. So we haven't historically, we always, clearly we are considering financial conditions in the decisions that we make, but we have generally not, I don't know of a case in which we've ultimately decided to take an action because of financial instability, but it's something, it's in theory, it's possible. The second one, if I understood, I'm not sure I totally understood the second. So we're doing everything right, but asset prices are low?
Yes, so the economy is booming, inflation is at target, unemployment, we're at full employment, but the stock market, let's say, is in the doldrums and is down. Should the Fed worry?
That's a really easy question. Our job is maximum employment, price stability. That's our job. If you give me maximum employment and price stability, then those are the things that we're focused on. We're obviously not focused on. We monitor financial conditions, but we're not focused on the price of any particular asset really ever. It's about broad financial conditions, and ultimately, it's about the real economy. If the real economy is in great shape, then that's where we want to be.
Yeah. So in your talk today and in previous talks over the last several months, you've spoken quite a bit about the distribution of gains into the economy have varied based on who you are. And here I have a question about the current situation, where they ask, what impact do you expect to see on economic growth and employment as a result of a homeschooling environment which requires women to either drop out of the workforce or work less? So that's a little more specific than typical, but curious on your thoughts.
Right. So, I mean, as I mentioned, this episode, this pandemic and the economic fallout from it are very challenging from the standpoint of issues of income and wealth equality and just basic fairness. And that, in essence, the part of the economy that's been hit the hardest is those people who are on the front line in service industries. That skews to women, it skews to minorities. And when even 8 months ago, we were able for the first time in a really long time to have some good news on distributional issues. Now this comes. So it's something we've been calling this out since the very beginning. We've really got to work hard to counteract this. Now you mentioned, and we did see, you mentioned women and homeschooling, and you see the labor force participation among women dropping as the school year starts. And, it depends on how long it lasts. So I would just say, if ideally we'll get through this, we'll have a vaccine, we'll have, sooner rather than later, we'll have something that will enable people to go back to their lives and make the choices that they want to make and not have them forced on them by this pandemic. And I certainly hope that's the case. The longer it goes on, the more likely there is some lasting damage. We hope it's not too much. And frankly, it's not great for children either. I mean, someone told me the other day, there's no online preschool. And, so for many people, and it's a lot of women, it's winding up being in the home with young children who really should be in school, and you would much prefer to be working. So it's a real issue.
All right. So the pre-GSE model before the financial crisis has often been criticized as a system of privatization of profits and socialization of risks. Some would describe capitalism as a system that allows owners to take risk with the expectation of return should their investments, ideas, and process bear fruit. A key component of this system has been tail risk, both to the upside and downside. If the Fed and fiscal authorities scramble to save capital holders from taking losses when a tail risk arises, are you concerned that the elimination or minimization of the Schumpeterian process in our economic system may actually increase the risk of secular stagnation, the exact scenario that monetary and fiscal authorities are trying to avoid?
So I think that's a very legitimate concern. And I do believe that, under our system, one should be able to reap the benefits of success and should have to bear the costs of economic non-success. So I think that's all right. And I think, that doesn't change. I wouldn't change what we did, though. I mean, I think we did what we did because of the people that we serve, in particular, the people who've lost their jobs and now are trying to find their way back into, a profitable economic life, a positive economic life. So I guess the best thing we can do to ward off the concerns that this questioner raises, I think, is to now go back over what happened, just as we did after the financial crisis. And we're doing this. Go back over and look at the places that really are there places where we can fix things so that they would be more resilient to this kind of a shock. And that, by the way, that would also include, things we can do to be better prepared for a pandemic, right? Because, obviously that's now a possible thing. And we can, if it happens again, we hope not, but if it does, hopefully we can be better prepared on that front. We can also look at things that happen in the financial markets and in the economy and make them more robust to episodes like this. And in this case, it's not because, this didn't happen because of moral hazard. The moral hazard is more that we don't want people to assume that that will run in all the time. We want to reserve these things for truly unusual and exigent circumstances. So very legitimate concerns. I think the time to address them is, when we're well and truly back on a solid footing, unemployment is much lower, and economic activity is going on. People are going back to work. And then I think that's really time to be ready to maybe make some changes in regulation. We'll see. I mean, we'll see what comes out of the analysis. We're actually working on it right now, as others are around the world.
All right, wonderful. So many wonderful questions still in the queue, and I apologize to everyone who we didn't get to address their questions. But I want to thank Chair Powell again for joining us again at the annual NABE meeting. And we wish you and the Federal Reserve the best of luck and a success in all of the policies that you've initiated over the last several months, and certainly for the U.S. economy that we continue on this positive path.
Thank you, Lisa. Thanks to everybody.
Thank you.
Welcome to Yahoo Finance on the Move. We've been listening to Jay Powell as he has been speaking to the NABE about the economy. Some of the headlines from this, as he has pointed out, as we have heard in the past, that the initial job losses have been harder on lower earners during this pandemic downturn. We've also heard from him. He said that the Fed still has no plans or desire to use negative rates. Now, we've got quite a bit on tap for you regarding all of this. I've got Brian Chung, who covers the Fed for us, in the wings. We've also got Julie Hyman, my co-anchor, who's been paying attention to what Chair Powell had to say. Let's start with Brian real quick. Is there one specific thing, before I introduce our first guest, Dan I, from Fort Pitt Capital Group? He's head of asset allocation and equity research. Brian, is there one thing that jumps out to you from what we heard today from the chair?
Well, I think the one big thing that jumps out is not necessarily new, but it's building on something that he's already said, which is that it's really on the responsibility of fiscal policymakers to be doing something right now, saying, quote, the risks of overdoing it seem for now to be smaller, adding also in those same prepared remarks that, quote, too little support would lead to a weak recovery, creating unnecessary hardship for households and businesses, saying that monetary policy and fiscal policy need to be doing something together. But the Fed chairman also adding that, well, we already have near zero rates, which kind of leaves the interpretation open that it's really on that second round of stimulus that's still being negotiated right now down in Washington, D.C. to provide the support to households and businesses that's so desperately needed right now. So in summary, the Fed chairman saying, Congress, it's time to do something and do it now.
All right. And as I take a look at the markets right now, Dan, I can see the Dow is up about 30 points, but the S&P 500 and NASDAQ are in negative territory. One more time, Dan I is Fort Pitt Capital Group's head of asset allocation and equity research. And what we've heard from the chair is that you, at least, when he talked about the recovery being stronger than what had been expected, you still have a bullish thesis because of the massive monetary stimulus. But what about this fact that the chair is calling for Congress for more fiscal stimulus, Dan?
Yeah, good question, Adam, and thanks for having me. It's nice to be with you. So it's nothing new from the chairman. We've seen multiple calls for more fiscal stimulus from Chairman Powell. It looks like both sides in Congress are starting to get a bit closer to a fiscal stimulus deal, but still a ways away in terms of the size and the scope. So we'll certainly see what happens there, but we've been pleased with the strength of the economic rebound and recovery. So we think when the market looks at the situation, they look at the fiscal stimulus package as something that we'll get eventually, whether it's before or after the elections. But we do think that the expectations are that something happens there eventually.
Hey, Dan, it's Julie here. It's good to see you. So as we look at the sort of back and forth on fiscal stimulus, as we look at the coronavirus numbers, as we look at the economic data, which as you said has been relatively strong, although certainly the job gains seem to have stalled out to some extent recently, does any of that matter as much on that side of the ledger as monetary stimulus does on the other side? In other words, can the market go down very much while the Fed is still doing what it's doing?
That's a good question. And we've heard in their September meeting that the Fed's going to be extremely accommodative with plans to keep interest rates at or near zero through 2023 and even through full employment. We don't know exactly what the definition of their full employment structure is, but extremely accommodative. And it really does constrain other investment opportunities outside of the equity markets. We're looking at a 10-year Treasury yield at 80 basis points. It's not very difficult to find very high quality dividend paying stocks that pay investors 3 or 4% yields. We haven't seen that type of divergence in a very long time. So they both work together. But on the economic front, we've been really encouraged by what we've seen on the jobs front. We've added back more than 50% of the jobs that we lost in March and April. The housing market is on fire. On the corporate front, earnings results have been really resilient, which has been encouraging. So the two definitely go hand in hand.
Dan, it's Brian Chung here. I want to ask about volatility, not just the VIX, but broadly speaking. Do you feel like the volatility has kind of come down? Because it seems like that's what the Fed's mission is here, committing to keeping rates near zero and doing whatever it takes over at least the next 3 years or so. So have they succeeded in reducing market volatility, or do you think that it's just other types of news headlines that have now entered the chat here in terms of keeping everyone on their toes?
Yeah, that's a really good question, Brian. And we've seen, obviously volatility levels have come down from historic highs back in March. But the VIX still trading at around 28. That's significantly higher than long-term historical averages. So we think a lot of that probably has to do with some of the uncertainties that we expect around the November elections. Do we see a contested election cycle where the results are really extended over weeks and months? So we think that's probably a contributor why we've seen such a powerful rally in the equity markets, but the volatility hasn't crept down to below historical averages, and it is still fairly elevated.
Dan, I wanted to ask you about some individual stocks that you like here as well. Bristol Myers is one of them. Of course, the company announcing yesterday was going to buy Myocardia for about $13 billion. And it's interesting because there's been sort of a pile into segments of the pharmaceutical space, but it's been more on the sort of biotech, higher beta names. What's bringing you to Bristol Myers?
Yeah, so we think that Bristol Myers has really just a leading oncology and cardiovascular portfolio. We think that was really strengthened through their merger with Celgene, which closed late last year. And I think valuation is really a key component for us as well. It's one of the cheapest stocks in our portfolio. It trades at 8 times earnings estimates for next year. And given that low valuation, you would tend to think there's some structural issues with the company. Certainly not the case with Bristol Myers. Earnings are expected to grow by about 30% this year and almost 20% next year. Stock also pays investors a really attractive 3% dividend yield. So we just really like that attractive combination of value, growth, and income from the stock.
One of the stocks you also like is Ciena Corp, and they're a little bit more expensive, trading at roughly 13 times earnings. But what is it that you like about this, especially as the world goes 5G?
Yeah, very good question. So Ciena really supplies the platform and the architecture that supports internet traffic and also telecom infrastructure. Some of their clients include the large service providers, the web scalers, and the cloud players. And we do think that they're really well positioned for those long-term connectivity trends, not only the rollout of 5G, but the growing demand for bandwidth growth, network densification, and just the greater connectivity of the data centers around the country and around the world. The stock or the company gave some weak earnings guidance on their last call. It sent the stock down about 35% from those August highs. So it now trades at about a 50% discount to the technology industry. We think this is a company that can grow their earnings at 15 to 20% over the intermediate term. So we've used that weakness to add a position in Ciena Corp.
Dan I is Fort Pitt Capital Group's head of asset allocation and equity research. We appreciate your insight. It is valuable to a great many of us. We're going to turn our attention, though, to what's happening with COVID-19, the White House, President Trump, and several other issues. I want to let you know, too, some breaking news that Vice President Pence has tested negative once again for COVID-19. That test result released this morning. So again, Vice President Pence testing negative. This ahead of tomorrow's vice presidential debate against Kamala Harris. But turning to the latest COVID-19 news, coronavirus news, Angelique Kemlani joins us with this. And Angelique, before we begin to talk about where we stand today, especially with the FDA, want to play for everybody a soundbite from President Trump's video after he released himself from the hospital yesterday.
I know there's a risk, there's a danger, but that's okay. And now I'm better, and maybe I'm immune, I don't know. But don't let it dominate your lives. Get out there, be careful. We have the best medicines in the world, and it all happened very shortly, and they're all getting approved, and the vaccines are coming momentarily.
Anjali, it's that last thing he said, the vaccines are coming momentarily. Give us some insight. Where do we stand? Because I thought he was getting pushback from the FDA.
Yes, that is correct, Adam. So what we know is that the FDA has been pushing for a 2-month observation period on those phase 3 trials, and that would push any efficacy data, any safety data, indications of a vaccine working out from the end of the month, which is the earliest that Pfizer has said that it could get some results on the table, out to November and post-election. So it clears that window of what many health experts are saying is the crucial window for Trump and his reelection. So right now, as it stands, Pfizer with the end of the month and Moderna into October, but the early part of it is the latest indications we've got of when that vaccine could happen. So what that means is that just the data indicating that a vaccine works. Now, looking at from that standpoint, there is not going to be a vaccine in anyone's arm by election day by any stretch of the imagination. The EUA, the emergency use authorization, takes weeks to process by the FDA. So at earliest, it could be the end of November when we see something like that and start seeing the use of one. So questions obviously around these two frontrunner vaccine candidates, Pfizer, Moderna, and when they'll come out. And just a point to note also is that their vaccine technology is new. So not only is the FDA faced with, understanding the data, but also what it means in terms of this newer technology. And so that's where a lot of pressure from the scientific community for a 2-month window is coming from. And as it stands right now, we know that there's an advisory committee slated for October 22nd. And in the material there, even though the White House has blocked these guidelines from the FDA, in the material there for that meeting, the guidelines for that 2-month window are already there. So that's up for discussion October 22nd.
Angela, going back to some of the comments we got from the president saying essentially, look, don't be afraid of the virus. Things are going to be fine. That goes back to the concerns that doctors have had about this mixed signal coming from places like the CDC. And on that front, we now have sort of a reversal of a reversal, I guess, new guidelines that essentially say that, yes, in fact, the coronavirus is airborne and can be spread beyond 6 feet. In the doctors that you speak to, who are they going off of at this point? It feels like every week we're talking about the CDC reversing the guideline. So who's setting the standard moving forward?
So the CDC's guidelines actually reflects what a lot of experts believe, but I've heard doctors say that 6 feet is still okay to stick to as of right now. But the important point, and we've seen this repeatedly come into the forefront, is the masking question. And so, to that point, going back to what the president's message has been yesterday, coming off of Marine One, as well as before he was released from Walter Reed, we saw him say multiple times, don't be afraid of COVID. And just this morning, comparing it once again to the flu, saying that the country doesn't shut down for the flu. And so with all these messages, public health officials are very concerned, about what exactly the message is to the American people, despite having gone through, the virus himself. He's not still reflecting on what top health experts in his administration are pushing for. We heard CDC head Dr. Robert Redfield say that a mask can save lives in place of a vaccine, and still we don't have sort of that cohesion and any national strategy to sort of bounce off of. So health experts are really just doing it based on their knowledge and what the data says.
Anjali, it's Brian. And one interesting thing is that aside from the guidelines on the transmission of the virus itself, there's also questions about the guidelines on vaccines. The Politico reporting from last night saying that there could be some confusion about the White House actually maybe preventing the FDA from releasing guidance on emergency use of vaccines, citing industry concerns, although there's been some mixed signals about whether or not the industry does have concerns about that specific guideline. Walk us through exactly what's going on here in that kind of carousel of the White House, the FDA, and then also the industries working on this vaccine.
I'm glad you asked, Brian, because that is what I spent all morning talking to people about. Let's look at it from first the White House perspective. So very clearly, there's an incentive to sort of get some sort of announcement on prior to Election Day in order to encourage Trump's campaign. And that's sort of where people are placing the focus of the White House on, and the reason behind its blocking of the FDA guidelines. The FDA is battling two fronts. Number one, the White House political pressure, and simultaneously public public trust, and that goes in two directions as well. Whether or not it's public trust of watching this political pressure, or the anti-vaccine movement that is going to gain momentum if any indication of a rush vaccine is present. Simultaneously, you have the industry that works in coordination with pharma, right? There's that relationship already there. These companies know the agency, they work together on a number of other drugs. And so they're faced with sort of helping each other out, if you will. If that in fact can happen, the companies themselves have an incentive to get the vaccine to market first, both for stock and investor reasons and also for branding and purposes. But they too face the liability of, if there is any adverse reaction, if there's a lack of public trust, what will happen to that drug? So this is like a multifaceted factor right now, that they're all sort of facing, and we honestly won't be able to see any definitive route probably until after the election.
And speaking of the election, Anjali, just wanted to talk about as well. I know you cover more the medical angle of it as much as politics has crept into it, but it is fascinating how the Trump campaign tacked on all of this seems to be to say that President Trump is somehow strong and that's how he has defeated this virus, although we know it has taken down many people who were otherwise healthy. It's also interesting the sort of takeaways amongst the public from his illness. Axios released an Axios Ipsos poll this morning and asked people, are you more likely to wear a mask now that President Trump has caught coronavirus? And it found 21% were much or somewhat more likely, and 21% were also somewhat or much more likely to have distance of 6 feet or more from people, because we have seen in very public fashion how a high-profile person who did not observe these guidelines indeed became ill, even if at this point it doesn't look like that illness was life-threatening. But still, it's interesting if that does end up changing people's behaviors to any extent.
Absolutely. I think to your point, there was, all this concern and sort of waiting to see whether or not, kind of like what we saw in the UK when Prime Minister Boris Johnson got it, his stance reversed a little bit. And experts were kind of hoping or waiting to see if that would happen with Trump as well. And clearly that has not. In fact, he's doubled down on the messaging that he believes in. And that is definitely going to play a role and a point actually on the sort of energy and enthusiasm and strength image from Trump. Someone pointed out that he is on steroids, on dexamethasone, and whatever drugs he is on could be playing a role in that level of energy. But of course, we will have to hear from the White House doctors and physicians to know exactly where he stands right now.
All right, Anjali, thank you very much. We're going to take a quick break. As we go to break and before we check markets in the next segment, I want to draw your attention to Apple. Those shares right now are trading down about 2%. A couple of reports right now as we await the new iPhone 12, perhaps mid-month, is that they are no longer selling Sonos or Ultimate Ears brand from Logitech, or even some of the third-party speakers and ear devices. And this is having an impact, perhaps, as Apple is making a big push for its own Apple-branded over-the-ear headphones, as well as their HomePod smart speakers. So shares of Apple right now down about 2%. We're going to have more on the move for you after this.
Time for news on the move now. John McAfee has been arrested in Spain on tax evasion charges, accused of failing to file U.S. tax returns from 2014 to 2018 and hiding assets including real estate, a vehicle, and a yacht. McAfee, the eccentric cybersecurity pioneer whose name still graces that popular antivirus software, allegedly earned millions of dollars by hyping cryptocurrencies, among other things. But he didn't file tax returns, according to the U.S. government. He faces up to a total of 6 years in prison.
The Supreme Court sided with South Carolina Republicans to reinstate a legal mandate that absentee ballots require a witness signature. The decision overturns lower court rulings that the coronavirus puts an undue burden on voters to safely get a witness to co-sign their ballot. Ballots already cast and those mailed today and tomorrow without witness signatures, they will still be counted. Justice Brett Kavanaugh wrote, quote, "This court has repeatedly emphasized that federal courts ordinarily should not alter state election rules in the period close to an election."
Fresh cut fruit sold at Walmart in 9 states is being recalled by the producer. Cut or sliced apples, grapes, mangoes, pineapples, and cantaloupe distributed by Walmart in 9 states may have been contaminated with listeria and could be dangerous to eat. Packages with best if used by dates between October 3rd and October 11th and sold in states including Illinois and Texas are subject to that recall. You can find full details on the FDA's website. Let's now get full details on what's going on in markets today, in particular with energy stocks, as we have another hurricane that is strengthening. Jared Blickery's here with some details for us. Jared?
That's right. Name stored Delta, because we ran out of letters in the alphabet, bearing down on the Caribbean, attacking the Yucatan, and probably another day or two moving north. And we're seeing energy stocks up for the 3rd day in a row. Exxon is up 1.5%, Chevron up a little bit more, and the oil majors overseas faring well as well. And services companies outperforming. Halliburton is up about 5% right now. Also taking a look at the NASDAQ, which is underperforming. Those big cap names under pressure as the yield curve expands, as we see the 10-year T-note yield head higher. Apple is down 2.5%, Amazon off just over 2%, and Facebook, Alphabet, and Microsoft off just more than 1%. Tesla, that volatile stock we love to track, that is down 2.4%, down 87 basis points over the last 5 days. Guys?
Thank you, Jared. And as we go to break, want to bring you a check on Macy's as well. Those shares not up huge today, but they did extend some modest gains after the company said it is partnering with DoorDash on same-day delivery. It's saying it's going to be offering same-day delivery this holiday season in partnership with DoorDash. I should say the shares were up a little more than 1%, but now they're back down below that threshold. We'll be right back.
Welcome back to Yahoo Finance on the Move. We want to bring into the stream right now Kumara Ramanathan, welcoming her from London, and to the Yahoo Finance on the Move team to help us talk about Christine Lagarde and some statements she said about additional stimulus.
Absolutely. Thank you so much. Lagarde described Europe's economic recovery as, quote, being a little bit more shaky than anticipated. She made the statements at the Wall Street Journal CEO Council Summit that was earlier today. Now, with the second wave of infections hitting here in Europe, in France and Spain specifically, we really have no end in sight when it comes to when the economies of the continent are going to be taking a turn for the better. But she did want to firmly make clear that she had all tools at her arsenal and was willing to basically fire on all cylinders if necessary. Specifically, she said effective, efficient, and a proportionate outcome was what she was looking for. And if that meant cutting the key interest rate further below zero, she was willing to do so. Now, we know that in Europe, the ECB has already been engaged heavily in interventionist measures. That includes looking at large-scale bond purchases as well as cheap loans for banks that match roughly what the Federal Reserve has already done. But going below that 0% mark has been a step that she has not been willing to take. ECB, the BOE, we know that this is something that a lot of banks are fearful of because the knock-on effect is for the banking community that will say, well, you're going to cut into our profits, which are already hit so hard by COVID. Now, she also wanted to add that it was almost like a call for action, if you will, for all central banks, saying that they needed to provide more stimulus as was necessary. But individual governments on this side of the pond have really been doing their part. So far, no additional aggressive measures have not been necessary, but she said she's not afraid to do it if need be.
Kumara Ramanathan joining us from London. Thank you very much. We're going to be back with more on the move for you right after this. Brian Chung, you spoke with the Federal Reserve Bank president from Kansas City, Esther George. What is she telling you?
Yeah, well, at a conference yesterday, at the CIBOS conference, I had the chance to speak with the Kansas City Fed chief talking about central bank digital currencies, non-monetary policy, and President George saying that they're doing research into maybe having some sort of digital version of the US dollar. They've been piloting programs with MIT, for example, to figure out use cases, but said, let's pump the brakes. This doesn't mean we're going to full on adopt it. Here's what she had to say.
I have to make sure I note, though, at this point, None of those efforts signal a decision by the Fed to actually adopt such a currency, but I think it's prudent that we do our homework and think about what that entails.
So the Fed does want to make sure it's doing their homework. So it's possible they could adopt something. Keep in mind that a survey from the Bank of International Settlements says that only 10% of global central banks actually plan on doing this. But again, the Fed's saying we're researching it and we've got it in the back of our heads, at least for right now.
And Akiko, you're looking at plans to break up big tech, at least these plans in the House of Representatives.
Yeah, we're looking to a number of cases that are expected to be brought forward in the next few weeks. And Bloomberg now reporting that the House Antitrust Panel is looking to propose reforms that would prevent tech giants from selling products on a marketplace that they own. And that would certainly be a dramatic overhaul from the competition law that is currently in place. When you think about the likes of Amazon and Google, not only have they grown their platform, they have been able to expand it by selling products and services that they own on their very own platform. Specifically, when you talk about the House Antitrust Panel, they're looking to include a Glass-Steagall law for tech platforms. That, of course, was back in the 1930s, separating investment banking activities from commercial banking ones. In the case of tech, companies like Google and Amazon would be prohibited from entering different lines of businesses, which would effectively amount to some sort of breakup. All of this, of course, coming as the panel wraps up its year-long investigation. And we're getting a number of reports that suggest the Department of Justice, as well as the state attorneys generals, are all planning to move forward with their antitrust cases in the next few weeks. One other thing to note, Adam, here is the case involving the state attorneys general, because when you look at Texas and the attorney general there, Ken Paxton, he is now embroiled in a bribery scandal there that could really question the credibility of his case. Remember, he's one of the very first ones that came forward, getting other state attorneys generals on board with a case against Google. So a number of threads to be watching here, but we're going to be following the big tech space as we expect these cases to come forward in the next few weeks.
And we'll be right back.
Here in New York, we are 2.5 hours into the trading day. Stocks are mixed right now. The Dow, very little change, slightly to the upside. We've got the S&P up about 0.05%. The NASDAQ about 0.5%. The Russell 2000, by the way, has been holding up better over the past few days than the major averages. It's up 1.25% today. Traders and investors are weighing the comments from Jay Powell earlier about the economy, about the risks to the economy, and about the need for fiscal stimulus. Meanwhile, President Trump says, don't let coronavirus dominate your life as he returns to the White House. But our first guest today says his diagnosis could dominate the rest of the campaign. Spending was hit hard for one group that didn't get direct stimulus. That was teenagers. The results of a highly watched teen spending survey is coming up. And socks and exotic plants, two areas seeing high demand during the pandemic. Now, two companies are catering to cozy feet and serene spaces. Welcome to On the Move. I'm Julie Hyman, along with Adam Shapiro. Joining us this hour on the panel will be our Melody Hum and Emily McCormick. Let's start with President Trump and Washington, because of course he did return to the White House from Walter Reed Medical Center late yesterday, released a promotional video and made some comments from the White House.
And I learned so much about coronavirus. And one thing that's for certain, don't let it dominate you. Don't be afraid of it. You're going to beat it. We have the best medical equipment. We have the best medicines, all developed recently. And you're going to beat it.
Let's bring in Jeffrey Wright now. He is with the Eurasia Group there. He's the U.S. analyst. Jeff, as you listen to those comments, I know that the president has been getting a lot of flack over sort of being too blasé about the virus. His supporters would say he was sort of striking an optimistic tone about our ability to move past it. But how does all of this play when it comes to his reelection campaign?
I think the obvious answer is we don't know yet. We'll see. But I think the big risk for Trump is that this compounds his biggest pre-existing weakness in this campaign, which is the coronavirus and his handling of the pandemic. It also kind of personalizes it in a way. You know, if before voters were sort of unconvinced that he'd done a good job in handling it as the head of the government, he's, I think, pretty clearly done a very poor job in keeping it out of his own office and, you know, away from the closest people to him. So I think it's a huge political negative for now.
And we know that there was no what they call a sympathy bounce from his getting ill. So let's assume that he is on the road to recovery, strong and ready, as he says, to debate next week. Does he get some kind of recovery bounce, do you think?
I doubt it. The U.S. is so sharply polarized now that almost nothing moves polls. So I think it's possible. But there's some examples from abroad, from Boris Johnson and Bolsonaro in Brazil. But the situation in the U.S. is much different. And I think the caveat you made in the beginning, let's assume that he's out of the woods. That's a big assumption, because given what we know about the course of COVID in a lot of patients, he may still have a week or more of potentially, symptomatic time and potentially contagious time as well.
Jeffrey, just taking a look at the next 4 weeks or so, what would you say is the importance of whether or not President Donald Trump is actually able to debate in person, whether those actually go forward as planned as live events or as virtual events? Who stands to gain whether or not these actually happen as they were previously scheduled?
It's a good question. I would suspect that if you're the Biden campaign today, keeping Biden as far away as possible from Trump or anyone else with coronavirus is probably a huge priority. So I'm skeptical myself that these will go forward in person, but it seems like Trump wants to press that issue. I think in general, the place to start with debates is that they almost never change the trajectory of campaigns. There are a few exceptions, but they're pretty rare. So that would be my baseline here. I think if Trump can debate and does seem to be recovered by the 15th of October, then, there's some potential upside for him, certainly with Republicans who already are sort of predisposed to believe that the virus is not as bad as the media says it is and so forth. But I think with the swing voters that are going to decide the election, this is still a big negative, regardless of how quickly he recovers.
And Jeffrey, we've talked a lot about the domestic sort of reception and the potential for whether it's a Biden presidency or Trump getting reelected. But what about our geopolitical standing? What are sort of the ultimate scenarios? I know it sounds like fear mongering, but at one point, America was not the global leader, right? So when you think about the way that we've dealt with this virus and Trump being at the helm, how do you envision our standing in the world really changing and perhaps transforming after this virus?
Oh, I think it's a black eye. I mean, there's no question about that. The fact that Trump has been unserious about it from the beginning, and now that has come, directly into the West Wing of the White House, I think, there's no way to spin that isn't a problem for the U.S. I think, if you're optimistic about Trump's chances, you could say that by recovering quickly, he sort of, he helps illustrate to his base what he's been saying all along, which is, the virus is not a big deal. We should be worried about the economy. As I say, I think that's a big if. And if he were to return to the hospital over the next, this coming week or next weekend, I think that would be very difficult to recover from in the time that he has left between now and Election Day.
Jeff, finally, I do want to ask you about stimulus, which is also something that is sort of hanging over Washington. What are the current prospects and timeline, for that matter, of getting something done there?
It's a good question. It's one of many things that have been sort of upended by Trump's news. So, the immediate impact is that Mnuchin is really in charge on stimulus, and, sort of he clearly wants a deal. And I think to some extent Pelosi does as well. We're still skeptical that it gets done before the election, but I think the scenario that we may see emerging is that you get a deal announced potentially as soon as this week between Pelosi and Mnuchin, but the sort of disinterest in that deal from Senate Republicans keeps it from getting done before the election, and then they return to it in the lame duck.
Jeff Wright of Eurasia, U.S. analyst. Thank you so much, Jeff. Good to see you.
Thanks, guys.
Wanted to bring you an update on Apple and its iPhone introduction event, or what is presumed to be its iPhone introduction event. October 13th is now the date that the company has given for that event. We've been watching Apple today, as well as some audio equipment makers, and that's after a report that said Apple had pulled competing earphones from its selling channels, stores, websites, etc., things like Sonos products, Beats products, etc. So we are seeing shares of those companies like Sonos on the decline today. Again, October 13th is the date we might get some new product announcements. Let's get back to the markets now and talk about the quest for yield, because that has been a big theme this year with interest rates pushing ever lower. People are looking for return. We're joined now by Iman Brivanlu. He is TCW High Income Equities Managing Director. He's joining us from Los Angeles. Iman, thank you for joining us. First of all, I would ask, have you been seeing an uptick in demand in this environment because yield is somewhat difficult to come by with rates so low?
Yeah, good morning, Julie, and thank you very much for having me. No, the answer is no. Most of our investors still remain on the sidelines. There are a number of open questions in many of our spaces. They've been under pressure, and for now, the demand has remained muted.
Wouldn't now, though, be the time to jump in? We have a housing shortage. We're going to need to be building multifamily dwellings outside of big cities. And yet, even within big cities, the office sector is going to recover somewhat at some point. So it seemed maybe we've hit bottom and now would be a time to jump in. Or am I wrong?
No, you raise an interesting point, Adam. So let's take a step back and talk about the performance year to date of the space. For example, let's take REITs. They've underperformed very dramatically. They're down about 15% year to date at a time when the S&P more broadly is up about 7%. So you're underperforming by about 20% or so. And, I think it's important to remember that many of the subsectors within real estate, for example, take lodging or take retail, really we're at the epicenter of the pandemic and the damage caused by the shutdown. So, in those specific subsectors, you're down anywhere from 45 to 55% year to date. And so, that type of activity, that type of performance has really spooked, I would say, market participants. And, to your point about, office perhaps beginning to bottom out, other sectors perhaps, having some upward momentum, I would say that there are still a number of open questions, out there that remain to be worked out. So, for example, the success of work from home models, I think really, brings into question how much demand, will come back even when we recover. for office space. To the extent that you have increased inventory within office, what does that do to the other other spaces, other sectors? Residential, for example, comes to mind. So I'd say the market still has to work out through all of these issues and questions for the near term. For the long term, of course, the space is attractive for the same reasons it has always been attractive. It provides a level of diversification for investors, and of course, investors are drawn to income, and we don't think that's going to change.
Iman, bringing it back to the election and the near-term questions around that, up until that point, what do you see as being more important to equity investors and what they're actually pricing in? Whether there might be certainty and a clear-cut victory for one candidate and a reduction in the likelihood that we get a contested election, or is it whether one candidate specifically actually wins the White House come November?
It's a great question, Emily. So I would say the first order effect is, of course, the market abhors any kind of uncertainty. Any outcomes that may broaden the spectrum, are generally viewed negatively. To the extent that you have more certainty around the outcome, to the extent that you take some of the really bad scenarios of constitutional crisis, contested elections, and so forth off the table, of course, the market will view on that favorably. I would say that if the polls as they currently stand end up proving accurate, if Biden comes into office, perhaps if you have a blue sweep, it raises also the prospects of a more concerted, kind of a more directed effort in containing the pandemic. That, of course, would be strongly favorable. To the extent that again that blue wave results in perhaps a less antagonistic stance towards China. That benefits us. Less protectionism, definitely, I think, would be viewed favorably. So I would say that all of those things are factors that the market is, currently kind of weighing in and pricing in.
So, Iman, I would also ask you about Biden's tax plan and effect that could have on corporate profits. I believe it was Bank of America was out with a note earlier in the week looking at the potential effect and the potential hit to corporations, although there's also the possibility that, as corporations frequently do, they will find a way to pay less taxes, even if the overall rate does go up.
Yeah, it's a great question, Julie. I guess let me take a step back. When President Trump first got elected, and there was the talk of and the implementation of the corporate tax cut. Of course, you saw the rest of the market, kind of those sectors outside of our bread and butter areas that are, REITs and BDCs and those high income sectors really benefit tremendously. So, what we have is, for many of our structures, for example, again, REITs, they don't pay corporate taxes. BDCs also don't pay corporate taxes. So, when you had the tax cuts, other sectors that kind of benefited more from that deregulation, benefited more from that, overhang of the lifting of the overhang of that tax burden really did well. What I envision is if, Biden comes in and there is a blue sweep, perhaps if corporate tax rates go up, then you might get a little bit of an unwind of that, of that dynamic. And so, what I envision again is perhaps those sectors that were more out of favor, the REITs, the BDCs, and so on, they would actually benefit from that from a relative standpoint.
Interesting. Something to watch out for. Iman Brivanlu, thank you so much. TCW High Income Equities Managing Director. Appreciate it.
Absolutely. My pleasure.
We want to talk about now a survey that is highly watched. It comes out twice a year. It comes out from Piper Jaffray, and it's about teen spending and teens' favorite brands. And the survey this time around, it's the 40th one they've done, shows that teen spending hit its lowest level in 2 decades. They did the survey in August and September and found that the spending this year was $2,150. That's a drop of 9%. So interesting here. Melody, always there's lots of interesting stuff to dig into here on what teens are spending and not spending on.
Yeah, this Piper survey always fascinates me because it just shows, yes, there is some divergence with older generations like millennials, like Gen X and boomers, but at the same time, the thread is pretty much reflective of the overall economy. What I mean by that is secondhand representing 8% of shopping time allocation, really taking market share from those off-price specialty department stores. Skincare sales have remained relatively steady, although male teenagers have spent 12% more on skincare year over year. So that's pretty fascinating to think about as we talk to entrepreneurs and executives in the skincare space, in the makeup space. All of these are pretty much reflective of what we've heard from our own guests. Another interesting trend, 18% consume plant-based meat. Impossible Foods is the #1 brand of choice for the teenagers that were surveyed. And then another kind of interesting nugget too is teens reported spending of just $87 on handbags. That is actually an all-time low, but none of these sort of findings should come necessarily at such a surprise, right? Where are teens going? Where do they need handbags? As well as shifting consumer behavior, you can track even older generations. Handbag sales are not as popular, right? People don't feel the need to be as flashy with that sort of merchandise. So again, very interesting and timely, but Julie, as your earlier point with the drop in total amount of purchasing power, that doesn't come as a surprise, given the fact that we're in the thick of a financial crisis and a pandemic.
Melody, I would definitely echo a lot of what you had to say. And the other thing that really struck me about this survey was that it really reaffirmed the trends that we've seen in terms of the stay-at-home trade. I mean, we had the trends that were streaming, video games, redecorating teens' rooms for online education, trends that were out were dining out, public events like concerts, and we had wallet share contraction really reflecting that. We had food still the #1 category, as well as concerts and events still being popular, but losing some of that wallet share for teens that were included in the survey. We should note that it was taken between August 19th and September 22nd. So all of these trends reflected here, still in the relative near term, and still trends that we're seeing even as the pandemic is perhaps off the lows of what we saw during the spring, as stay-in-place orders have abated a bit since the worst of what we saw earlier this year. But continuing to see spending here on video games, again, movies. Within that, we actually saw video games at 10% of total teen wallet share for a new survey high. And just bringing that back out to what that might mean for individual stocks, we have companies like Activision Vision potentially getting a boost here because of the popularity of Call of Duty. We saw that spiking in the survey to 62% of teens from 33% in spring 2020, taking a look at that specifically. So I think a lot of this, again, reaffirming the stay-at-home trade, reaffirming a lot of the stocks included in that, including names like Amazon, of course, still the most widely used online retailer at 54% of respondents. So again, a lot of the winners that we've seen for the year to date in the stock market getting included in Piper's survey.
Yeah, Emily, Julie, I think what's particularly interesting to me is the #1 spots have pretty much stayed unchanged, right? Those that had been market leaders continue to gain market share. To Emily's point, Amazon remains #1, but #2 is quite fascinating. It's a site called Shine, which is actually a China-based retailer, fast fashion, sort of a hybrid of H&M, ASOS, Urban Outfitters, where it's things you can buy for cheap that are very trendy. And then when you look at the social space, Snapchat still remains #1 among teens. #2, of course, is TikTok. So as much as the Trump administration, as much as all of our government officials can say that we want to sort of uncouple ourselves from China, from the global market, it just shows that China makes a good product, right? There's that demand even here domestically. So we should expect TikTok, Shine, all those sites to continue to actually gain traction, regardless of sort of the rhetoric coming out of the administration.
Yeah, it's a good point. And I wonder how many of those teens adopted dogs during this time and what it did to pet food sales. We got a little cameo there from, I think, Melody's new pooch. All right, I want to bring you a little bit of an update from President Trump and the effect that it has had on tech stocks. He's just tweeting the past few moments, repeal Section 230. Now, remember, this is the law that basically protects the large cap tech companies from legal liability related to content that users post on their sites. And there has been bipartisan discussion about changing that law, including from members of both parties that watch these tech companies closely. We are seeing a little bit of a hit to some large cap tech companies, the likes of Facebook, Google, Twitter, and Amazon. So we're watching those stocks. We're also watching a couple of other movers that I just wanted to mention to you. One of them is called Alteryx. It's a data analytics software maker that's up more than 25% today after raising its sales forecast and naming a new CEO. The new CEO, Mark Anderson, formerly president at Palo Alto Networks. So those shares getting a big boost. And then we are watching, and here's the mouthful, Social Capital Head Sophia Holdings Corp III. Remember, this is Chamath Palihapitiya's firm, and he announced today it's a SPAC. It's taking public Clover Health, which is a Medicare insurance startup that's backed by Alphabet. This deal would value Clover at $3.7 billion. Palihapitiya has been very busy this year. He just made a SPAC deal for Open Door. Remember, he's the guy who brought Virgin Galactic public through a SPAC as well. Those shares, by the way, though, are trading lower. We'll be right back. Continuing to watch the airlines, particularly Southwest Airlines, which is up about 1.2% today. For the first time, the airline's asking the company's labor unions to accept pay cuts in order to prevent furloughs. Adam, you have been tracking this issue very closely here. And, you know, we've seen different approaches at the different airlines. Some of them are indeed doing the furloughs, and some of them are asking for these pay cuts.
Yeah, I just want to point out that all of the airlines right now are trading higher, but this isn't particularly troubling for Southwest. And before I get into what Gary Kelly was telling his team, you can go watch this. He posts regular Ask Gary, as he calls them. He's the CEO from Southwest, videos on the website. And in the most recent posting yesterday, he literally refers to Southwest's, quote, war against COVID-19. So here's what they're going to do. They are now negotiating with their labor unions. He said if they do not have some kind of concessions in place by January of next year, they are going to have to impose these layoffs for the first time in the company's history in order to save the airline. He's pointing out that the quarterly losses could be in the billions. They were expecting Congress to pass what's called the Payroll Support Program, an extension of that. He's still optimistic that could happen. If it does happen, none of what they're talking about will proceed, but he's not expecting it to happen anytime soon. And he said they have to act now. Quote, we just can't afford to wait any longer. So you've got him pointing out that travel demand is down 70%. Again, that quarterly losses are expected to be in the billions of dollars. To put this in perspective as I wrap up, we are at 1970s airline traffic volume levels. That's what he is saying. And there is no way for Southwest, Delta, American, United, the legacy carriers to continue at this kind of volume without some continued payroll support from Congress.
And as you said, Adam, it doesn't look like that support is forthcoming, right? I mean, even what is in the stimulus proposals that have been bandied about for the airlines.
You can expect another, and to put it into perspective again, payroll support kept these people, some on the payroll, others took voluntary leave so they didn't get paychecks, but they still got their benefits. When you're furloughed, you lose your benefits after a very short period of time. So payroll support would be anywhere from 20 to 28 billion. Republicans originally proposed 28 billion. Democrats had put into their bill 20 billion. There's this belief it'll be another 25 billion. And it's not just the legacy carriers. We had on the director of the airline yesterday, the private airline, Linear Air, in which smaller, very private, perhaps, kinds of airlines were getting some payroll support. So this affects the entire industry. It's in the stimulus bill, but it hasn't gotten out of Congress.
Indeed. Well, one of the other industries we've been watching very closely that has been seeing some of the same kinds of challenges is the movie industry, the theater industry as well. Yesterday, we heard about the Regal Cinemas in the U.S. Shutting down for now. Cineworld, the UK parent, also shutting down theaters on the continent and in the UK. And now we're hearing about some more individual release delays. That is the Batman and Dune being delayed by Warner Brothers. Melody, you're out there on the West Coast and probably seeing firsthand the kind of effect that all of this is having on the movie industry.
And think about it, every economist that we've spoken to, whether it's from LinkedIn and Glassdoor, a lot of the folks that focus on hiring and potential layoffs, entertainment and arts has been the hardest hit. We talk about hospitality and leisure, but ultimately it's the artists and the creative set that has completely been decimated during this period of time. As you mentioned, Julie, the Batman has been postponed until 2022. That's after Dune was pushed to 2021. And this is as Netflix's Glow show will not finish filming its fourth season. It was actually in the middle of production, and then Netflix decided to pull the plug on that. I do want to say, though, there seems to be a bifurcation. The projects that seem to be the most screwed at this point in time are the ones that have already wrapped or are in the middle of production right now. What I mean by that is there are still deals being signed left and right from agencies. One stat so far is CAA, one of the biggest talent agencies here. They actually sold about 175 book titles for film and TV so far in 2020. That's 5 times the volume during the same period of time last year. WME, United Talent Agency, they're reporting similar numbers. So it's fascinating to see. This is sort of like throwing in the towel for a moot year, if you will, and then starting fresh. So a lot of these projects that have been put on pause, perhaps being delayed, we should expect them to be on streaming platforms perhaps, or have limited theatrical debuts. But I think the industry is still very optimistic that post-COVID, they'll be able to work on these projects, perhaps slated to air on 2022 or perhaps 2023.
I think one of the big uncertainties that we have here in the entertainment industry, specifically on the theatrical, physical theater side of things, and not so much on the production side, though, is how long these closures are going to last. I mean, we had Cineworld, of course, yesterday announcing those temporary closures in the US and the UK because of the pushback of these release dates of some of these major films, like the new James Bond movie, No Time to Die. But at the same time, we have the potential now for this vicious cycle of problems in the film industry where movie dates are getting pushed back, movie theaters are closing down at least temporarily, and then that means these production companies might need to rethink their distribution without getting a concrete date on when those theaters are actually going to reopen. And that's how typically audiences would see these films in the first place. So I think that's potentially a risk that we have coming in 2021. If we think about all of the movies that we have now pushed back, we had not just that No Time to Die, but also F9, the next Fast and Furious movie, along with Morbius and the next Ghostbusters. Really just a huge influx of these films, along with production for both the streaming and feature films getting pushed back.
It doesn't feel like so long ago, right, where we're talking about Trolls World Tour being the anomaly, right? That was the one-off, and that the trend, the trajectory would continue. No, Mulan will be a home run. It'll be a slam dunk. Tenet will be a slam dunk, regardless of the fate of coronavirus. That's clearly proven to be incorrect, right? So to Emily's point, this sort of complete upending of timelines is a good sort of reset, right, for the industry. Where do consumers want to watch their content? From the Piper survey, we found time and time again, it's Netflix. So I think the big winners here, and it's sort of an obvious sort of TLDR bottom line, is it will be the streaming platforms that will end up creating more bidding wars, right? Especially if movie theaters are not going to be willing to pay or to stay open, to offer some of those precautions. Ultimately, we know that it can be safe to sit at home on your couch and watch all the content that you desire. So I'm curious to see sort of the evolution of how this turns out, and if consumers will be interested in 2-3 years to kind of re-up things like movie passes and AMC A-List, StubHub, to be able to have those rewards programs as well. Because as of right now, the future is looking a little bleak.
Well, the content I desire is Glow, so I, for one, am not happy about that show going away, Melody. All right, we'll be right back here on Yahoo Finance. We've seen a lot of evolving shopping trends, shall we say, during the coronavirus pandemic. And it looks like one of the things that people have been buying more of, perhaps, is socks, things that you use more of when you are at home. David Heath is joining us now. He's the co-founder and CEO of Bombas, which is not only a sock company, but a one-for-one model sock company. For every pair that they sell, they also give away a pair of socks. Dave's joining us from New York. Talk to us about the demand that you have seen at this time. Have you seen a significant uptick with more people at home and maybe many of them just wearing socks and not shoes right now?
Yeah, at Bombas, we like to say that since coronavirus, socks have become the new shoes because everybody's inside. Yeah, we've seen a tremendous increase in demand for our business. We've seen almost a 100% increase from pre-coronavirus to post-coronavirus. And I think for a lot of the reasons that you said, not only our category, people are investing in comfort, they're investing in things that they're wearing around the house, but also, our kind of business was built for this. We're almost 100% direct to consumer. We've been doing this for 7 years now, so our teams are really, really good at getting to customers, re-engaging our current customers, but also our mission side of the business. Right when coronavirus hit, I think a lot of people were getting emails that felt a little tone deaf from a lot of other e-commerce brands being like, shop new spring styles and, check out our newest colors. And you're like, I can't find toilet paper, right? Like, that feels weird. Why am I getting this message? And we have our mission component. So we shifted all of our, direct response type of messaging to here's what we're doing out in the community. We've built a network of over 3,500 giving partners, mostly homeless shelters throughout the entire country. And because because we have a team that's been dedicated to that, we've donated over 40 million pairs of socks and other items across the country. We had partners like Clean Cult, which is cleaning supplies, and Brooklinen, which is bedding supplies, reach out to us and say, how can we get our goods to your the people who need them the most? So we've been able to really thrive in this environment across all levels.
Does that include, because you launched T-shirts in 2019, are you also giving away the T-shirts? And I just have to ask a very basic question. I just buy a T-shirt. I'm thrilled if it doesn't have a tag. You make a big deal out of Pima cotton. I've never known, what is Pima cotton and why is it different than just a regular, I don't want to say a competitor, but T-shirt?
Yes. So to answer your last question first, so Pima cotton is one of the best natural fibers you can put on your body. It has an incredibly cool hand feel. So what we like to say is it feels like the other side of your pillow. It stays cool and fresh and crisp, all day long, and you can kind of dress it up, you can dress it down, and we've got a lot of other innovations around fit and stuff that we've done. But the proprietary benefit for our T-shirts is definitely the fabric. And yes, we do donate T-shirts. For every T-shirt sold, we're on a mission to build a brand for the homeless community, right? This is a community of people that doesn't necessarily have brands or products designed for them. And we treat our non-paying customers, what we refer to as the homeless community, the same way that we treat our paying customers. So we design specific donation items. We're not just taking stuff that's been run over the factory. We're actually putting design and R&D into these fabrics. So our donation sock has antimicrobial treatments, reinforced seams, darker colors to minimize visible wear. Our T-shirts have antimicrobial treatment. They're sized slightly specifically to allow layering, which oftentimes people in the homeless community have. And we like to think that everything that we're doing is really trying to solve a need with that community. Socks are the #1 most requested. Underwear are #2. T-shirts are #3. So items that are close to the body tend to get worn through, in a faster rate. Is obviously in high demand for that community.
Dave, we actually spoke last April, and you told me that you could easily be a billion-dollar brand in the next 5 years. And you noted that you are profitable as a business while still doing good. Give us an update here. As you see the SPAC frenzy, as the IPO frenzy happening this year, are you getting a sense of FOMO? What's your trajectory look like right now?
So again, we're still experiencing incredible growth. I still believe that we've got an opportunity to hit $1 billion in the next 5 years, based on our financial projections. I think we've had a lot of SPACs reach out to us. I think we're lucky. We're in a space where we're incredibly cash generative, despite, giving back. And so we're in a position where we're still kind of controlling our own destiny. We don't need capital. I think a lot of our peers have gone out and raised capital or gone to the public markets because they continue to lose a lot of money year over year. I think we buck that trend. We generate a lot of cash year over year. I think we're going to be opportunistic about any type of fundraising or transaction that we end up doing. I think that a business like ours, you could see us being public. We're high growth, high profitability. It's not a sector that I think is foreign to the public markets. You have the Lulus and the Under Armours and the Gaps that all came before us. Our playbook right now is very similar. It's tried and true, right? Expand product categories, expand geography, and expand sales channels. And I think we're laser focused on just execution over the next few years.
Dave, when we think about the one-to-one model, and credit to Melody for bringing this up separately in conversation, people think of Tom's, right, which kind of pioneered this model.
Totally.
Tom's filed for bankruptcy early this year. How do you avoid perhaps pitfalls that they experienced when you have the same kind of model?
Yeah. So, for us and similar to Tom's, I think our giving was built into the brand, and the financials from day one, right? We've built a very sustainable business that can accommodate this. Blake is a good friend of mine, and Blake's the founder of Tom's, and he was a many time over serial entrepreneur, super successful. So I think he had large aspirations focused on innovation, right? And he wanted to take a brand that went from shoes to eyewear to water, to coffee, to all of these other avenues, trying to build kind of what Richard Branson had built from a Virgin brand, right? A giving brand that can span across multiple product categories. And those businesses are so uniquely challenging in so many different ways. But again, he's a real pioneer and an innovator. And we're kind of trying to march a playbook that I think, again, has kind of been executed on many times before us in the industry, from an apparel standpoint. And again, I think we stay super laser focused on margin and execute, again, from the ground up, knowing the financial framework that we have to work with to continue to grow this business.
Dave, thank you so much for joining us. David Heath is Bombas co-founder and CEO. Appreciate it.
Thank you.
As we take you to break, want to take a check on oil prices. They're up almost 2.5% and trading over $40 a barrel. We have yet another storm approaching the Gulf of Mexico. This one is Delta. As our Jared Blickery pointed out earlier, they have run out of letters in the alphabet and named storms. So now they have gone to Delta here. So oil prices getting a boost on the possibility of some crimped supply. We'll be right back.
Welcome back to Yahoo Finance on the Move. A lot of people, as lockdowns were taking place, went and got pets. But you don't have to walk a house plant. So let's bring back to the stream Justin Mast. He is the CEO of Bloomscape, which is revolutionizing the way that a lot of us get house plants. It's good to have you back, Justin. Just got to share a quick funny story with you. I was talking to some friends who were wondering if all the little plants that people had at their offices, which are now probably dead because they haven't been watered, if you're going to face a boom once people start going back to the office. So what are you seeing in the business? Because it's essentially online, order your plant, get it delivered kind of business.
That's right. Yeah, I think it'll be interesting. I mean, I think people will probably start moving back to the office a lot slower than they moved out of the office and into home offices. So I don't know if we'll see a all at once boom like we did in helping people get their home offices set up with plants.
Justin, it seems like there's also been this movement for exotic plants in particular. There were some recent press about, sort of swapping and trading of cuttings of exotic plants so that you could grow these amazing rare plants. Is that something you guys are seeing? Are there any challenges in getting supply of those types of plants?
Yeah, we are seeing this. I mean, I think as, there's this new generation of gardeners and plant parents coming up. And I think as people get more experienced, people are looking for something new and sort of interesting to get into. So, I know this past spring, our big surprise hit was we had a pineapple plant that we offered that we just could not keep in stock. So yeah, we are definitely seeing this too.
Justin, just taking a look at Bloomscape, I know you're one of several companies that work within this e-commerce live plant delivery space. I mean, I'm thinking about like the Sill, Amazon, even also delivering live plants. So how do you differentiate yourself when a lot of these companies are offering similar breeds of plants and similar shipping speeds?
Yeah, I mean, our big vision is to reinvent the garden center for this new generation of gardeners. So we started with indoor plants. I think the thing that made us unique coming out of the gate was we had designed a process where we could ship fully grown, like 5-6 foot tall, potted plants that are living room ready to any zip code in the US 12 months out of the year. And since then, we've really built around that. I think our product has stood out, that unique supply chain that we've built has allowed us to ship larger plants, higher quality plants, and this coming spring we'll be offering outdoor plants as well.
And Justin, I know you recently announced the acquisition of Vera, which is that plant care app, provides content, troubleshooting. How big is this industry going to get? When you think about total addressable market, how big are we talking here? What is your scope?
I mean, retail lawn and garden is over a $50 billion industry, and it's one of, I would say, the last major retail categories to see a major digital disruption. But one of the things we learned right when we launched is that when we can help people feel confident with their ability to care for their plants, that they like gardening, they like spending time with their plants a whole lot more. We see that as a good thing. And so, early on in the launch of the company, we created this program called Plant Mom, where I recruited my actual mom to help our customers with plant tips. But that's obviously not a very scalable business strategy. Our customer base is a lot bigger now. And so we did a lot of research and we've been really looking for a way to bring that kind of personalized, when you need it, plant care support to our customers. We saw a huge opportunity by bringing our Grow How together with the Vera Plant app.
Justin, just want to let everyone know, ordering online, I did order before you were around a small little gem boxwood, which is outdoors and huge now.
Nice.
So I want to have you back when you start doing that kind of delivery, because I got some work I got to do out on the terrace. Just want to thank you once again. Justin is the CEO of Bloomscape, and we look forward to having you back. Justin Mass joining us from Detroit.
Thank you.
As we talk about all these kinds of issues with the pandemic, Ari Nesferre spoke with Jesus Matas. He's a senior managing partner for IBM Services as part of our Hispanic Stars sub-series of Yahoo Finance Presents for Hispanic Heritage Month.
A big portion of our population just doesn't finish at 4 college degrees. But when you actually look at the characteristics of the jobs that I'm describing, like good paying jobs in technology, that people with skills can participate, it's more important that we give people the skills than the diploma. So what we have done, and we've been at this for a long time, we didn't just do this, we've been over 8 years, is create something that we call Pathways to Technologies, which is work with local high schools to add 2 years to the curriculum. So for those people that, either don't have the means or they're not interested on spending, 4 years to get a college degree, they can spend 2 more years and they actually get, all the skills that they are required, whether it's cybersecurity, whether it's technology, but also the life skills, empathy, relationship building, teamwork. And that is what we call PTech. And this is what we call the new collar jobs. These jobs is more important to be filled with people that have skills versus people that have college degrees. And that way we can create a faster path for people of all means to participate on these type of jobs. And frankly, we can create just an acceleration of it. We still have many open jobs in this country that need people with those skills. So there is a supply constraint that we can fill a lot faster, and we can have a lot more disadvantaged groups, minorities, any areas to really participate in those.
S&P 500 and Dow now positive. We're going to have another market check for you right after this.
It's time for Word on the Street, where we check in with our panelists, find out what stories they are watching. Melody, you are looking at BTS. There are apparently calls for them to skip the mandatory military service in Korea.
Yeah, for those who don't know, all able-bodied men in South Korea between the ages of 18 and 26 must actually serve in the military for about 2 years. And now there's growing traction to get all seven members of BTS out of that mandatory conscription. The eldest member of the band, Jin, is 27 years old right now. So he actually has passed that deadline and is supposed to actually serve within the next year or two. This is relevant because let's think about Big Hit Entertainment. It's planning to go public. Shares will start trading on the Kospi, the Korean Stock Exchange, starting on October 15th. And 97% of Big Hit's revenue comes from BTS. So as much as this can seem like a very individualistic story, there has never been a time where the Korean government has actually said that K-pop star cannot serve in the army. A classical musician was once forgiven. Professional athletes have been kind of allowed to skip that mandatory service. But if BTS does get this sort of special permission, it would be unprecedented. And in many ways, it'll give perhaps investors some additional hope that Big Hit has some longevity here.
Very interesting. All right, Emily, we talked about that teen survey from Piper Jaffray at the top of the show. One of the trends that they're also watching is secondhand clothing, and Levi's is trying to jump on that trend.
Absolutely, Julie. So Levi Strauss just launched a new program called Levi's Secondhand yesterday. It's billed as a re-commerce site specifically for previously owned Levi's jeans and their other apparel. Most of these items sourced directly from Levi's customers. They're able to exchange these items for gift cards for future purchases. And what's unprecedented about this, according to Vogue, which first wrote about this launch, is that they're billing Levi's as the first denim brand of their size to create a buyback program and work through that full life cycle of their clothing. So this really ties into that trend that we're seeing with corporate social responsibility, really finding new ways to be environmentally conscious, reduce the waste that comes with fast fashion, and actually re-engage with customers. We have seen Levi's highs, under pressure for the year to date. That stock down 20% or so, and they are expected to report a second straight quarterly loss after market close today and see sales tumble another 43% to $822 million. So again, another way to potentially re-engage with the customer base here.
Yeah, and it seems like of all the things to sell secondhand, jeans make a lot of sense because they hold up pretty well. All right, thanks so much, Emily. Thank you so much, Melody. Thanks as always to Adam. Just taking a look here at what stocks are doing currently. The Dow has gained a little ground. It's now up 1/3 of 1%. The S&P as well is now higher by 1/10 of 1%. The Nasdaq is still down by about 1/10 of 1%. Remember, just a little while ago, we had President Trump tweeting about repealing Section 230, which governs technology companies. So perhaps we're still seeing a little bit of tech pressure as a result of that. The Russell 2000 still holding up well, up 1.25%. Keep it right here on Yahoo Finance.
Welcome into live market coverage here on the ticker. Once again, we do have the Dow trading up today, up by about 1/3 of 1% right now. The Nasdaq, the lone index in the red, off by about 0.1%. The S&P in the green by about that margin. And right now, when you look at the sectors, it's a mixed day here. The upside being led there by utilities, and on the flip side, we are seeing communication services, that sector taking a hit today, off by about 1%. But overall, again, continually watching these updates here on the coronavirus front. Of course, President Trump getting discharged from Walter Reed yesterday, as we continue to learn more about the uptick in cases, once again rising by about 4,000 in terms of daily new cases versus what we saw by about a week ago. That has been the trend lately, as has a lot of people wondering if this is the beginning of a second wave. We're going to be chatting that in just a moment here. But of course, stocks caught a boost after we did see the news that President Trump was improving. It moves to remove maybe a bit of the question marks we've been talking about here ahead of the big one that will be the election this November, now just about 30 days away. But want to jump right into all of those questions here to kick off the show, since it's a very stacked show today, no time to dilly-dally. So let's get right into it, because there's a lot of questions around where the market goes from here, as we have traded notably higher here. But is it a real rally or just a head fake ahead of the election? Join us now for more on that. Is our first guest today, who oversees nearly $160 billion in retail assets. That's Brent Schutte, Chief Investment Strategist, Northwestern Mutual Wealth Management Company. And Brent, it's good to be chatting with you again today here. I mean, as I said, stocks are popping on the announcement that President Trump would be leaving Walter Reed. We've seen that. He addressed the nation after he was out in a new video that I just want to play here, urging Americans to get back out there and not be afraid of the pandemic at hand, potentially, I guess, spurring a bit of a boost to the recovery we've been seeing. But here's what he had to say. Take a listen.
Don't let it dominate you. Don't be afraid of it. You're going to beat it. As your leader, I had to do that. I knew there's danger to it, but I had to do it. I stood out front. I led. Nobody that's a leader would not do what I did. And I know there's a risk, there's a danger, but that's okay. And now I'm better, and maybe I'm immune. I don't know.
Brent, we're going to be having a medical discussion in a bit, so I don't want to put you on the spot or ask you about those elements there, whether the president's immune. But he does speak to a larger economic question here, because the data has shown that Americans are kind of hesitant to spend on certain things through this, mainly travel. We've seen hotel, airline stocks, casino stocks still way down in this recovery. So regardless of what the president says about getting back out there, there's still a demand shock that investors need to be cognizant of here, right?
Yeah, but I guess, the one thing I will say is that the economy has adapted. And so if you think about what I'm doing today, I'm actually sitting in my basement and not in an office. And so if you think about it, many companies have actually figured out how to serve their clients in a COVID-influenced economy. You've had the fiscal stimulus come in, which is kind of driving the backs in force. And if you look at spending, it has shifted. And so last week we had PCE consumption come out, and goods, think durables, think housing, think big picture purchases, non-durables, think groceries. They have actually gained during this, while services, those parts of the economy that you mentioned, are still the ones that are somewhat offline. They're down. But overall, the nominal spending in the US economy is only 3% lower than what it was in February. And so you've had this shifting of spending. You've had economy that has adapted, and that is lessening the impact that COVID is having. So once upon a day, it impacted all of us. We had that huge growth downturn in the first and second quarter. Estimated growth for the third quarter right now, according to the Atlanta Fed, is 34.6% quarter over quarter at an annualized pace. And if that were to occur, that would leave the US economy only 3% smaller than what it was in February. And so that's why you've had this positive backdrop as much as anything else.
Yeah, I'd say that's true. I mean, but when we think about other market watchers out there, mainly the big firms, we've seen a lot of them cutting their Q4 growth forecasts because of the stalling stimulus talks here. What could happen in terms of upticks on the coronavirus front? I mean, we've seen that drag on. Stimulus talks remain active, but hope remains low. And you consider the trillions in the gap between Democrats at 2.2 trillion and their latest offer here, and Republicans closer to 1 trillion, depending on what Secretary Mnuchin can get Senate support for here. But even that looks shaky. So how does that change as you're talking about kind of sectors recovering through this and how we've seen different paths here in 2020 for a lot of those businesses? How does it change your investment strategy at all when you think about what could happen if maybe a deal on that front comes through?
So look, this is not a comment on whether or not I think stimulus needs to be done or not, but one on what I think the impact of the market will be. So you've pulled a lot of people across the economic valley that COVID caused. So the stimulus that actually occurred was necessary. We had, I think, 17 million additional people become unemployed. Now 11 million people are back on payrolls. And so the impact is lessening. I would like to actually have it occur to pull the rest of the people across that valley. But if it doesn't, I don't think it's a deal breaker from the market, because I do think you are seeing the economy adapt. You are seeing companies figure out how to operate in a COVID influenced economy. And hopefully at some point we do get a vaccine, which will, kind of completely lessen the impact, hopefully, or at least even more so. And you're going to see earnings growth broaden out. I mean, in the third quarter, you will see earnings grow, and you're going to see them broaden out. So there's only been one game in town or a couple of games in town recently because of what happened in the first quarter. That was technology stocks. You're going to start seeing earnings grow across more of the industries just because of the economy coming back online and the economy adapting to the COVID.
Yeah, we've heard a few guests on the show talking about that too, in terms of that rotation maybe over back to the value side of the market. But when we talk about the president, I'm sure he would agree. I mean, we've talked about how that stimulus bill coming through here would be a plus in terms of boosting the economy. As you said, maybe if it doesn't come through, maybe not all that terrible when you think about how this recovery has been going on. Certainly might not help it speed up here. But when you talk about the president, that's going to be a big question answered in November, I suppose, hopefully, about who will be president moving forward. As we're getting new polling data, a late CNN poll showed that Joe Biden has continued his lead here with 75% of likely voters backing him to just 41% of President Trump in a nationwide poll. Of course, these things don't really matter when you think about the nationwide polling versus some key battleground states. But even there, Joe Biden seems to have a significant lead in some of those states. But when you look at that big question mark, how do you position around that, since that does seem to be not even who wins, but also the question of whether or not you get a peaceful transition of power that's hanging over a lot of investors' minds?
Sure. So I think some of the polling that you mentioned probably drove investors to believe this week, and maybe that's some of the positive market action, that the likelihood of a contested election, which is probably the most disruption, has gone down somewhat. Now we'll see what actually happens as we push further. Certainly there's still a month left and a lot of things can change in a month, but that at least now has probably taken off some of that contested election that people have been playing for and pricing in. I do think that if you did get a Democratic sweep, there would be a knee-jerk reaction because it would mean higher taxes on companies and individuals, which does have an impact on earnings. But I want to really, really point out again and bring this back. Investors should not overplay politics in their portfolio positioning. The US economy is large. It has a natural trend rate of growth that is, quite frankly, hard for any administration to dislodge. They can actually take some of that natural trend rate of growth and shift it around a bit, but they can't, to my estimation, eliminate it. And if I take you back and I look at the economy and I go back to 1960 and I look at elections, where the economy is in its economic cycle is more important than who is president, in my estimation. So if you inherit an economy late in an economic cycle, the average return over your 4 years is something like 6.7%. And by late in the cycle, I mean the Fed is usually raising rates, the economy is growing too fast, inflation's ticking up. Mid-cycle, if I do them by that, meaning that the economy has recovered some of its losses and it's moving towards being, quite frankly, late cycle, the return is 10%. Early cycle, if you inherit an economy right after an election, the returns are about, if you inherit an economy right after a recession, the returns are much higher. I believe the average is around 14%. And so I guess the good news is that either one of these presidents, whoever gets elected, will inherit an economy that still has slack left. And one big key thing that is very important to markets, they're going to inherit a Federal Reserve that wants to do no harm, wants to backstop markets, and isn't raising rates anytime soon, which is a very, very important conversation.
Yeah, and you got Fed Chair Jerome Powell out today. Some people were pointing to his comments and maybe how that had stocks under pressure here when he warned of another, comments we've heard from him many times before, talking about a weak recovery without sufficient government aid on the fiscal side, which again, as we just talked about, still remains in limbo. But lastly, I mean, when you think about that, it sounds like you're saying the election, is kind of being overhyped and over talked about in terms of your impact looking at 2021 on earnings and how this recovery goes from there. But in terms of how you trade it around right now, and I know short term doesn't really get a lot of people who come on here very excited when I put them on the spot for that. But we've had a few guests saying that the technical levels to watch here on the S&P is around 33.63 in terms of closing above that. We did that now, which has some people, mainly Tom Lee, a guest on the show, saying that we're out of the woods in terms of putting new money to work here. Is that your take as well, that I guess if the election isn't so big of an issue, now that we've seemingly almost moved past that volatility, that we're good to go here?
Yeah, I'm not suggesting that there won't be a knee-jerk reaction. So I do think that if you did get a Democratic sweep, the market wouldn't like that. Now, this is not a value statement on right or wrong. It's what I think the market will do. The market would have, I think, a knee-jerk reaction, but I don't think that would be long-lived. I mean, there are other offsetting positives that would come along with that. I guess to me, where an administration can impact is sectors, industries, and companies that are more favored by their policies. That's where they can take and shift some of that natural trend rate of growth towards. And that's something that we'll be paying attention to as we move closer to the election. But from a big overall standpoint, I'll leave Tom Lee to talk about the short term. I'll talk about the intermediate term. I still think stocks are going higher over the next year. I think there'll be different leadership, the value stocks that we've talked about, small cap stocks, things that are more economically sensitive. And I guess one thing that isn't going to change also besides the Fed is that neither one of these parties are talking about spending less money. They're both talking about spending more money. And that can help drive stocks higher until the bond market has a fit, which certainly isn't happening anytime soon.
Yeah, just a matter of how much more money, I guess, is really what's being discussed right now. But you raise good points there, and you and Tom Lee are on the same page about what it could look like over the long term. So we'll leave that there. But Brent Schutte, Chief Investment Strategist at Northwestern Mutual Wealth Management Company. Always appreciate you coming on.
Thank you for having me.
All right, shifting over to the updates we've been getting out of the White House. Of course, as I noted, President Trump leaving Walter Reed after his condition approved. We are hearing similar updates in terms of today with a White House memo showing that President Trump reported no symptoms of the coronavirus on Tuesday, according to the medical staff there. And it raises new questions about maybe his thinking, as he said in that video, his thinking about what the pandemic means and what the coronavirus as a threat means to the American public. I just want to read one of the tweets that is now actually under pressure in terms of Facebook taking down some of these things tied to, again, putting the coronavirus threat against the flu. Here's what he had to say. He said, quote, "Flu season is coming up. Many people every year, sometimes over 100,000, and despite the vaccine, die from the flu. Are we going to close down our country? No, we have learned to live with it, just like we are learning to live with COVID in most populations, far less lethal." Here to discuss that take, as well as many others on coronavirus, is Dr. Sajal Hathi, physician and clinical fellow at Massachusetts General Hospital and host of Civic RX podcast. Dr. Hathi, I want to just first get your reaction to what the president said there, because we've heard this issue brought up a number of times from people talking about the flu and how coronavirus might be less deadly than that. Clearly, Facebook taking that down because they think that's misinformation. What's your take on that?
Well, I think Facebook's reaction is testament enough to the complete and utter falsehood that once again has been emitted by the White House. I want to make a couple points here. Firstly, comparing COVID-19 deaths to flu deaths is like comparing apples to oranges. COVID-19 mortalities are minutely counted and reported directly. They are raw, they are real numbers. Flu deaths, by contrast, are swollen statistical estimates that are derived by the CDC and numerous public health agencies like it by multiplying the number of actual flu deaths counted by various coefficients intended to capture anything that might have been missed. So if you look at the actual flu death counts that are recorded the same way that we count COVID-19 deaths, you would see that these have ranged over the last 6 flu seasons from 3,000 to 15,000, substantially lower than what we're seeing with COVID-19. But even if we were to accept the inflated numbers, the 22,000 that were reported in the last year, for instance, the flu hasn't killed 100,000 or more than 100,000 Americans annually in more than a half century. COVID-19, by contrast, has killed more than 210,000 Americans in the last 7 months alone. There's another point that I want to make, and that's this. The last time that the flu killed as many Americans as we're looking at right now was, of course, in 1918 when we suffered the global flu pandemic. And President Trump noted in his tweet there that when we suffer from the flu, we don't close down the country. Well, that's absolutely false. In 1918, cities instituted quarantines, mask mandates were imposed, classrooms were moved outside. So we did dramatically change the way that we operate as a country. And we did that because these are proven public health measures. This is what we need to do to survive and thrive beyond this pandemic.
I'm glad you mentioned that too, though, about the apples and oranges comparison, because that was something that even came up on the debate stage when President Trump brought up Joe Biden's and the Obama administration's response to swine flu, which seemingly backfired when he raised how many people died from that. And it wasn't really a fair comparison. And then also it was strange to see play out because these are different viruses. Obviously, the response is expected to be different as well. But on that front, you would hope that the science is consistent in terms of leading the response. At least that's what you would hope. But on that front, we're seeing the White House continue to push back against the FDA, the CDC. That's something that also came out yesterday in terms of the reports around the White House seemingly blocking the FDA's structure here to make sure that any vaccine that does get approved is safe. They want to add 2 months to tracking these patients in these trials to make sure that they are safe. The White House doesn't see a medical reason to do so. So what does that say to you about, again, this conflict between the White House and pushing for a vaccine by the election, as Trump has said, versus what the CDC or the FDA wants to do and waiting to make sure it's safe?
Right. So as you exactly pointed out, the FDA did what it did to ensure that any vaccine that was made available was safe, reliable, effective, and trustworthy by the American people. That the administration would contest that is no surprise because it has consistently placed politics before public health. And the reality is that the Trump administration has adduced no clear medical reasons for pushing back against the FDA. It's instead using this vaccine as a political tool. And by doing that, it's undermining not only the trust that people have in a vaccine, but the vaccine's very value, right? Because after all, the mere availability of a vaccine does nothing to combat or to reverse an epidemic. It has to be taken to be effective. And in order to be taken, it has to be trusted. And right now, 27% of Americans are saying that they do not trust, they would not trust any vaccine that is touted by the Trump administration. And ironically, this number is driven largely by Republicans. Only half will say now that they are likely to get a vaccine if it is to be released immediately, whereas 3/4 of them said that they would in May. So what we're seeing is that at a moment when public trust is paramount, once again, it is being sacrificed by an administration that has consistently valued politics over public health.
And I mean, I guess to push that point further, we've seen these biotech companies come out with kind of a statement of their own when you look at the leading ones working on these vaccines, saying that they too won't rush this process by asking for FDA approval and emergency use authorization before they show that these things are safe. I mean, I know that this country leans a lot in terms of leaning on private companies and the corporate state doing a lot of good here, but you would hope that the agency overseeing a lot of these things would step in and have the power to do so as well to protect the American people. I guess, what does that say maybe about what these biotech companies are trying to say as well in working on this problem together to make that step that a lot of people didn't see coming?
Yeah, well, I hope that what they are communicating to the American people is that they will ensure that any vaccine that is released is, again, as safe and reliable and effective as possible. And what we know from every vaccine prior is that the type of rushed and frenzied process the administration is advocating and purporting to get through before the November 3 election is just simply not possible. Any vaccine that's released before November 3 is not going to work. I certainly, as a healthcare worker, wouldn't feel comfortable taking it myself. I would not convey to my patients that they should take it either. And I think perhaps the biotech companies realize that. And let's hope that that's what they're intending to convey to the American people.
Yeah, it's kind of surprising to hear. I mean, we've heard from some other guests as well as Dr. Fauci and Robert Redfield talking about how they would take it if it was proven safe. And that, again, becomes a very big question when we think about this approval process. But lastly, just because it's going to be a while before we get that vaccine, if you believe them and if you believe you, I mean, when we think about what's going on right now, clearly cases are rising. Yesterday, we saw the national case count come in at more than 36,000 in terms of new daily cases. That was up by about 4,500 versus what we saw 7 days ago. So, I mean, when you put these pieces together and the fact that we're going to be waiting for a vaccine, how do you see this winter going? Because we've heard a lot of warnings about a twindemic.
Absolutely. I think that your worry is well-founded. I am worried myself, and I think that we're going to have to be doubly diligent in ensuring that we adhere to prescribed behavioral precautions. That is to say, maintaining 6 feet of physical distancing, ensuring we're wearing masks everywhere we go, perhaps even getting high filtrate masks for healthcare workers and other essential workers who are exposed to what is clearly now an aerosolized virus, ensuring that we are not crowding in enclosed spaces, washing our hands frequently. I think we know what to do, and it's just a matter of following these protocols that have time and time again been championed by public health experts as we await a virus.
Yeah, and it's I for one enjoyed this conversation. I think it's important to focus in on those things as well as this continues to drag on. I know people out there might be getting sick of lockdown measures, of having to worry about this. I am as well, but important to bring up as a reminder here. But Dr. Saeed Al-Hathi, appreciate the chat. Be well.
Thank you very much for having me.
All right, we're going to take a quick break here on the ticker, but when we return, maybe you fall into the camp of maybe looking elsewhere outside the U.S. We've seen a surge of people looking into moving, whether it's all the political pressures here in the country or the threat of coronavirus and how our country has responded to it so far. We'll chat with the editor over at International Living for where Americans are looking to move when it comes to finding some other homes out there. Stay with us. Welcome back to live market coverage here on the ticker. The Dow up by about 0.5%. The Nasdaq still in the red, though trending near break even right now. We'll bring you updates as we get them on that front. And meantime, we've been dealing with a lot here in 2020. Not sure if you noticed, but particularly in the US, it's a stressful year. We got an election coming up. Obviously, health concerns shared with much of the world, but more and more Americans are seemingly looking into potential options out there in living abroad. It's, of course, the specialty of our next guest in terms of where might be the best spots to look. That would be internationalliving.com senior editor Dan Preacher joins us now. And Dan, appreciate you taking the time to chat here. I mean, we've seen these trends, these search trends before in terms of Americans looking at where is good to go. But you've looked into that. I mean, that's what you guys do over there. So talk to me about what you've seen in terms of trends and where are the best spots to consider.
Well, it kind of happens every year, as you might expect. Every time there's political Sturm und Drang, people start thinking about where else in the world they might move. This political cycle has been especially active, though. There's been a general uptick of about 300 to 500% in people just doing searches about moving abroad in general, 1,600% uptick in people looking about moving to New Zealand or Canada, because Canada's close and New Zealand has a wonderful story all its own during COVID. But these places aren't particularly easy or cheap to move to. They're easier and cheaper places to move. And International Living's been looking at those for about 43 years now.
Yeah, I mean, obviously, it comes to mind that you'd be able to speak English in those countries, though Canada, I guess, has a bit of a thing going on with French. But beyond that, I mean, where else are you seeing people look, or what have you seen in terms of outside of maybe these English-speaking countries, others that have popped up on your guys' list?
One of the perennial favorites is Panama, because the canal is there. It's economically stable. They've been dealing with North Americans for a century now. So it's an easy move and it's easy to settle into. English is widely spoken. Mexico is just across the border. Probably more US expats live full or part-time in Mexico than any other country on the planet. And they too have been dealing with North Americans for a long, long time. So there are places that are easy to go, easy to settle into, and almost all of the places in the Western Hemisphere, besides Canada, are much, much cheaper than the United States to live in. Lower cost of living, lower overhead, more available and cheaper healthcare. So it's a compelling combination for a lot of people.
Yeah, there's a lot of ironies there when we think about the push here to tell everyone to speak English in this country, that more might be speaking English in Mexico. But beyond all of that, I mean, I guess a lot of Americans might be new to thinking about living abroad. I mean, when you talk to people and have them chat that through, what do you think are some of the maybe preconceived notions or mistakes people make in thinking about planning the big move outside of the US, or maybe some of those expats that eventually move back to America as well?
Well, for a lot of North Americans, the rest of the world is imagined like US light. It's just like the United States, only at half the cost. And that's not the case. These are distinct cultures. They have their own economies. They have their own senses of humor. So if you're not engaged with the culture that you're moving to, you're going to get bumped out if you expect it to be just like home. Some people find that when they move, they're not prepared for it. And moving back is not, this isn't like jumping off a cliff. It's not a one-way move. If you try to move to Belize, or you try to move to Penang, or Puerto Vallarta, it's not like jumping off a cliff. You can always come back if you find that that's not your cup of tea. My wife and I have lived in 7 different communities in 4 different countries throughout Latin America over the last 20 years. Loved all of them. And the more you do it, the easier it gets, frankly. We're kind of serial relocators.
I think that's a very fair point to point out here, because I studied abroad. I went to Argentina, got homesick, had to come back. My 3 months was good enough for me. But I guess that's one of the things too that people might fear. A, there's maybe that aspect, but also B, it's tough to plan, I guess, costs of these things if you don't really know what cost of living is like in a lot of these countries, or planning around that becomes very difficult when you think about how hard Americans have planning for retirement, even knowing what life is like here in the US. So maybe talk to me about that cost aspect and what people should know, particularly about maybe some of these regions you pointed out.
It depends completely on where you move and what your personal needs are. You can, of course, spend as much as you want on your lifestyle anywhere on the planet that you move. But if you move to a place with good nationalized health care, where the weather is such that you don't need to run heating or air conditioning, where there's public transportation, so you don't need a car and you don't need all the associated expenses of all that stuff. Take that off the top of your monthly budget, you'll get some kind of idea how much cheaper you can live in another country. But that doesn't happen the minute you walk off the plane. If you get off the plane in Quito, Ecuador, your cost of living suddenly isn't going to plummet 50%. You'll need a cushion. You'll need to be able to rent your place. You'll need a deposit for rent. You'll need all the legal expenses for getting your visa. All of those costs still exist. So planning for those things and doing your research is a crucial first step.
Yeah, it's important to consider all those things, and crazy to think that healthcare might actually have people moving out of the U.S. But again, I guess it's just kind of where we are here in 2020. But appreciate the conversation so much there, Dan, at internationalliving.com, that senior editor. Appreciate it again.
Thanks, Zach.
All right, we're going to take another quick break here. On the other side, the happenings at Starbucks here, as of course, they remain active in the election year. We'll chat about their efforts here in 2020 to get people to the polls on election day right after the break. Stay with us. Welcome back to live market coverage here on the ticker. As we've been discussing in pretty much every segment so far today, of course, this is an election year. The election's coming up less than a month away from the big day. And one company, Starbucks, is putting money where their mouth is in terms of showing they care about getting people to the polls. And here to chat that with us is Yahoo Finance's Julia LaRoche. Julia?
Well, yeah, that's right, Zach. You are seeing more and more companies start to come out with initiatives around this election, getting folks to participate in our democracy by casting their ballots in what has already shaped up to be an incredibly polarizing election. And if you go back to August, Starbucks kind of announced, well, their CEO rather kind of issued a call to make sure that their voices are heard. In other words, Starbucks employs 200,000 partners, in other words, these are their employees in the US, and they want to get them to the polls or at least get their ballots cast. So they're basically saying they do not have to choose between working or making their voice heard. And now through November 3rd, the company will pay for them to take a lift to the polls to cast a ballot or take a lift to the polls to work as a poll worker or even drop their their ballot off at their local drop-off location or post office, what have you. But the Lyft ride, it's a free one-way ride up to $75 for each employee. And as I was mentioning earlier, it builds upon CEO Kevin Johnson's call back in August, nudging the employees or encouraging them to participate. He wrote in a letter at the time, he didn't come out with a news statement around the news today, but at the time he said, quote, "The upcoming election is a reminder that we as citizens play an active role in our society by simply getting involved in voting. Who you vote for is a very personal decision that you make as a citizen." He also added that it is one way for you to be heard. It is how democracy works. He also says, "Yet we know barriers exist, notably in Black and brown communities throughout the nation that lend to systemic racism and require greater voter access and protections." Now, part of this is it builds into a bigger program from Starbucks around promoting civil rights for its partners, the employees, the customers, and the communities. If you were using the Starbucks mobile app, you may have noticed they were featuring information on how to register to vote, how to find your local polling place. They've also provided all of their employees, a web page called fuelOurDemocracy.com that provides a lot of nonpartisan information on, how to access and get to the polls.
Yeah, and I mean, Lyft shares are up by more than 1% today. Uber shares are off by about that same margin. Read into that what you will. But the offer, interestingly, also covering drop-offs to get to drop off a ballot at the post office or another voting location. So not limited to just getting to the polls themselves. But Julie LaRoche, very interesting push there by Starbucks. Appreciate you bringing us that. We're going to take another break here on the ticker, but we'll be right back with the discussion digging into the way that various different communities have been impacted by COVID-19 and the drawdown on the economy, impacting everything from unemployment rates. We'll chat with McKinsey on a new report that shows Asian Americans are also dealing with this quite a bit in 2020. We'll chat that after the break. Stay with us. Welcome back to the ticker. This year, we've been tracking the impacts of the coronavirus pandemic and been noting how it's impacted some communities harder than others. And a new report from McKinsey is digging into how Asian Americans have been impacted by the pandemic, pointing out that Asian American unemployment rates increased by more than 450% from February to June this year, which is much more than what we've seen in some other groups by race as well. In that last clip, the Asian unemployment rate in this country was at 8.9%. That was higher than white Americans at 7%. So what's really going on here? Here to chat that with us is McKinsey & Co. partner Emily Yua, as well as Yahoo Finance's Brian Chung. And Emily, I appreciate you taking the time to chat. It's interesting. It's a very interesting report when you highlight kind of how this may have happened. And it's something we've seen across other racial groups as well, in terms of maybe being over levered to some sectors, whether it be hospitality or the medical profession in this case. But what's going on in terms of what you've seen since the pandemic hit?
You're spot on. Thank you so much for having me, Zach. I think the whole reason we actually wrote the article was really to shine a light on a conversation that many people around the world were simply not having. Asian Americans have been significantly impacted, almost disproportionately impacted by the pandemic. And we can actually see this in a number of different ways. The percentage of, as you mentioned, unemployment has been going up steadily. We've also seen mental health increasingly become an issue, with a rise of 39% in mental health across all of Asian Americans. And when you juxtapose that next to, just frankly, the things that we actually see happening in the front lines, the high percentage of Asian Americans who risk their lives every day to be, in the front lines serving their communities, it's actually a complete stark and contradiction. And so we really wanted to shine a light on that.
Hey, Emily, it's Brian here. So, you and Zach mentioned the points about occupational overrepresentations of Asians in restaurants, hospitality services, industries that have been really hurt by this crisis, as we know. But what are some other explanations for maybe why Asian American unemployment has fallen so much? It seems like it's actually a little bit different than what we saw in 2008 and a harsher impact during this time. Why might that be?
You're spot on. I mean, it's actually crazy when you think about when we say Asian Americans, it's not a monolith, right? There's actually a huge diaspora of people. When we think about how an East Asian experiences coming to America versus someone in the Southeast Asia versus, on the West, it's completely different. And not only that, I mean, Brian, you and I have discussed this before. There's really almost a vintaging of Asian Americans coming to America at different times and their experiences. And so the punchline to all of that is how Asian Americans have arrived in the US really begins to impact, frankly, how they are adopted into the economic and social infrastructure. And when we thought about how we wanted to shine a light on this and what the communities around the world could do, we really wanted to make sure that this wasn't yet another sort of racial Olympics, if you will. We wanted to make sure that we actually had an opportunity to make this even more clear in terms of the opportunities to impact their communities.
And yeah, at the same time, one thing that your report kind of highlighted was the unique experience of specifically xenophobia and discrimination. A lot of people associating this virus with specifically East Asian cultures. I mean, how has that played into maybe some of the unemployment trends? Has that really hurt businesses based off of what McKinsey was seeing when you guys were compiling this report?
It's difficult to say what exactly causes what. And, it's very difficult to link xenophobia directly to the unemployment. But we do see that there has been a rise in targeted, discrimination against Asians. And the impact of this is really that, over a third of Americans have been observing and witnessed individuals blaming Asian Americans for the outbreak. This is preposterous when you think about, the size of the Asian American community. And when we see that, this is really immediately correlated with a community that doesn't typically talk about mental health. And we actually see that rise by 39%, as I mentioned earlier. So these things are very closely linked to, frankly, the broader context of what is happening to Asian Americans in the US.
I'm glad you mentioned that aspect on the racial Olympics, because that's not what we want to see happen here either. Because every time we talk about one group getting impacted in this, you hear some other people coming out saying, why are you highlighting that? And obviously, you can be discriminated against across the board here. So we're not saying that's not happening. But what's interesting is that the unemployment rate did decline in terms of the Asian unemployment rate in that last clip in September, as I said, down to 8.9%. The jobless rate for Blacks, 12.1%, and Hispanics at 10.3%. So, I mean, it is impacting other communities. It's something that we've seen. But talk to me about why it's not necessarily a conversation around not helping all these communities, but something that each one has seen happen here when we think about, again, the white unemployment rate still better than all those at 7%.
What we know from research is that during times of crises, we all turn to the people that we know and that we trust. And that is just a social phenomenon. That's an economic phenomenon that we've seen year in year, across all the different crises. And what we also know is that part of being disenfranchised is that you're not in the core, you're not in that circle of trust. And so what you said, Zach, is spot on. It's not a huge surprise to see unemployment rise for groups that are historically not at the core, and for those that are at the core to really become even closer during times of crises.
And Emily, lastly, McKinsey works with lots of companies. So what is the overarching theme, I guess, of the report? How are you taking this and applying it to conversations that you're having with companies that have the power to rehire people or decide what to do with their diversity initiatives? What do you hope is the product of this?
Brian, I think this is the big aspiration and push of the article. It's really three things. First, let's all get educated, really understand the data, really understand what the baseline of the conversation should be. And the second is to take a pretty clear stance on combating xenophobia, agnostic of what group we're talking about. This really needs to be a time for us to come together and realize the tapestry that America is. And then the third is that, when possible, serve your communities. And I think in this particular context, the Asian American communities really are, some of the communities right outside your neighborhood.
All right, there you go. A very interesting discussion there. Obviously, a problem worth highlighting here. Emily, you at McKinsey, a partner, as well as Yahoo Finance's Brian Chung. Appreciate you both for the conversation.
Thanks so much for having us.
All right, we're going to take another quick break here on the ticker. When we return, another startup looking into alternative investments, how it's giving people the opportunity to invest in collectibles. We'll chat that alternative investment right after the break. Stay with us. Welcome back. As we've been discussing here in 2020, the fastest bear market sell-off in history back in March, coupled with interest rates near historic lows, has some investors scrambling to find a way to put cash to work here this year, maybe outside equities. There's Masterworks, a startup that we profiled just a couple weeks ago that lets people buy fractional shares in artwork. But one new startup is making strides looking to help people do exactly the same with collectibles. That would be Rally, based here in New York, launched in 2017. The platform already has about 200,000 users getting access to alternative asset investments in collectibles. Just recently, the company raised a fresh round of capital, bringing in $17 million from some big-name investors, including Reddit's co-founder Alexis Ohanian, and also brought a new CEO and a former Disney exec, George Limer, who joins us now. And George, appreciate you taking the time to chat here. I mean, as I said, the company got the start in 2017. You guys focused on classic cars back then, but now the platform includes everything from watches to wine to sports memorabilia. But the idea seems similar here. So talk to me about how it works.
Yeah, thanks for having me. So very similar to when the company started with cars. And so what happens is we take an asset like a baseball card or a case of fine wine, and we securitize that investment, and we offer that investment to investors, just as an investor would invest in an IPO of a company. So in essence, these become investable entities, and investors can buy shares in them.
Yeah, and I mean, when that happens, I mean, obviously you guys are looking, trying to find what might be good memorabilia here, what might be good collectibles for people to invest in. But what does that look like? I mean, what's the average investment you're seeing here, or the products that you guys are going after?
Yeah, from a product perspective, we're really looking for things that are aspirational, that are one of one, or one of a very small set of examples of the product. And as far as the investments go, the investments range from $1 to an average of about $25 a share. Investors invest anywhere from $300 to $1,000 on average. The average portfolio after an investor's been on the site for a while ranges to about $1,000 and 3.6 assets in their portfolio. And so we've really got investors investing across a wide range of assets. They tend to migrate from whatever initial category they've invested in to other categories quite quickly.
Interesting. So not just coming on for one specialty, perhaps, but also just seeking some alternative asset class across the board. And on that front, I mean, I've seen these things blow up. It's been kind of crazy to look at the historic nature of some of these large flips. I mean, at another network, I wrote about a man who was homeless. He went to a millionaire overnight because he auctioned off a Navajo blanket. I suspect nothing crazy has come through yet on your guys' platform relative to that. But talk to me about the process here in terms of the returns that you're looking to turn here for investors on Rally.
Right. So there's really two parts to that process. One is we have a secondary market where investors can trade, buy and sell shares that they've either purchased in an IPO, or new investors can come in and purchase shares from initial investors in the IPO. And we also get offers all the time to exit these items outright. And we've done that about 6 or 7 times in the past, with returns that range anywhere from 15% to close to 100%. So there's a lot of opportunity here for investors to sort of realize appreciation on these assets that they invest in going forward.
Yeah, those exits outright is always, to me, the most interesting question here when you think about how that might work, because it's very different than a company getting bought out, or what that process looks like. At Masterworks, we were talking about how it looks, in terms of selling the art pieces. But when it comes to answering that question, how would you look at an exit process when you think, all right, we've got a fair offer here, or when you need to say, all right, we're going to cut our losses?
Yeah, it's somewhat similar, right? We get that offer. We put that offer up to vote to the shareholders of the particular item that we've gotten the offer from. It's a non-binding vote, but so far, most of the offers have been good enough that the majority of the investors in a particular offering have voted to accept that offer, and then we more or less follow what the shareholders of that product ask us to do when that offer comes in.
And lastly, I mean, obviously, you guys are the platform. We've seen different business models set up here. Where does Rally make money here? Is it off the sale? Is it sign-up fees? I mean, how do you guys monetize it?
We think there are a lot of paths to revenue. Right now, we're not focused on revenue at all. We're focused on building the community, building the investor side of the community, and also just continuing to access the best investments. We think if we access the best assets and we build the user side and show that value, there's plenty of ways to monetize in the future. So we're really focused more on building the audience right now.
All right. Well, catching a lot of attention, no doubt, after the latest round. Alex Ohanian, every time he got his name attached to it. Very interesting project here. But Rally CEO George Lima, appreciate you taking the time to chat.
Thank you so much. Appreciate having me.
All right, we're going to take one more break here on the ticker, but when we return, another look at the importance of focusing in on minorities in STEM, as well as why efforts are underway at IBM here in pushing through on that front. We'll chat that after the break. Stay with us. Welcome back to the ticker as we got the NASDAQ climbing back here into break-even territory, trading about flat at 11,329 right now. We'll keep you up to date on those moves. It is, of course, Hispanic Heritage Month, and we've been highlighting aspects of that here on the show this month. And in the latest edition here, our own Ines Ferre got the chance to catch up with Senior Managing Partner for IBM Services, Jesus Montas, for an interesting discussion on efforts there being led to introduce Latinos and Hispanics to STEM careers. And I want to bring on Ines Ferre with more on that interview. And Ines, I mean, it's an important initiative here. What'd you learn?
Right. So Jesus is personally working on this initiative, as well as IBM, which IBM has a Path to Technologies initiative in order to mentor young people to get them into STEM careers and also offering internships. We talk about getting more Latinos and more Hispanic girls as well into STEM careers. Here's what he had to say.
Some of the kids, they can't be what they can see. So if they don't see somebody that looks like themselves, that have an uprising like themselves, be successful in these technology careers, they actually believe that, well, that maybe is not for them. We've seen, and by the way, you have to get at them very early, especially girls, especially, Hispanic or any other ethnicity girls. By the time they're 13th or 14th, they typically have made up their mind if they're going to go to a STEM career or not. And it's really hard to change them if they've made up their mind that maybe that's not for them. So some of the things that I've done, I've worked with organizations like the Powerful Foundation, so the O'Brien's Foundation. And, she focuses very much on that, young girls, make sure that they know that they have that possibility, that technology is a part of every job and they're capable of doing that. We work obviously with PTech, and we are accelerating the disposition of mentors. So all of these students can actually see people that look like them, speak like them, behave like them, and they say, wow, maybe I can be like that too. I think mentorship is super important. The other one is them providing the internships opportunity for them to gain the confidence that this is not going to be just education, that there is a job after that.
And Zach, you heard Jesus talk about making sure that these young people can see people who look like them and sound like them. And his story is so interesting because he came from the south of Spain back in 1994 as a consultant. And when he came here, he said he hardly really spoke any English. And he was even advised to perhaps change his name, his first name, so it would fit in a little bit more. And he said, do you want to fit into context, or do you want to be your authentic self? Saying really in the long run, it's better if you're just your authentic self.
No, absolutely, for sure. I'd call that out and applaud that as well here, but important to highlight the initiatives here being made and the efforts being made at education at a younger age, because that is something that we've seen across the board being very important. But Ines Ferre, appreciate you bringing us that. That'll do it for us here in the 1 p.m. hour. Appreciate you tuning in, everybody. We're going to continue the conversation on the other side of the break, bringing you all the latest on the coronavirus front, as well as the latest market moves as well. So stay with us. We'll be right back after this.
Welcome to Yahoo Finance. I'm Kristen Myers, and this is the second hour of the ticker. Checking market action right now, we have fairly mixed bag. Actually, no, all three major indices are in the green, fairly flat. However, for the NASDAQ, they had been in the red a little bit earlier today, up about 0.01%. The Dow right now leading the way up 0.3 of a percentage point, with the S&P 500 up about 0.2 of a percentage point right now. On a sector basis right now, utilities are leading up over 1.5%, followed by financials and industrials. In the red right now, we are seeing healthcare, consumer discretionary, and communication services is leading the way lower, down about 0.5 percentage point right now. Now, we did have a really nice rally yesterday on the news of both President Trump's recovery and his health, and renewed hopes around stimulus. Now, this morning, we did hear Fed Chair Jay Powell speak, and as expected, he pushed for Congress to make moves on stimulus. He said, quote, "The recovery will be stronger and move faster if monetary policy and fiscal policy continue to work side by side to provide support to the economy until it is clearly out of the woods." So on the stimulus front, House Speaker Nancy Pelosi and Treasury Secretary Steven Mnuchin spoke by phone yesterday. They will be continuing conversations today. Republicans still want that $1.6 trillion package that was proposed by the White House. But again, today in his comments, Jay Powell did undercut that funding figure from Republicans who want a smaller package, saying that the risk of, quote, overdoing it on stimulus was smaller. Now, we will be chatting that in just a moment. On jobs front, we do have the JOLTS data out from the Labor Department. Job openings in August declined for the first time in 4 months. Figures 6.493 million job openings in August. That's versus 6.5 million job openings expected. That is a decline from July's figures, which did total at 6.697 million. So as we have been chatting about here on this show, we are seeing the growth in the labor start to slow through this pandemic. Now, looking over at stocks, I want to take a look first over at Boeing, down 3.2% right now. They did cut their 10-year forecast for aircraft demand by 11% from last year. And in some other news that we got a little bit earlier today, American Airlines is also going to be delaying training for their pilots of the Boeing 737 MAX airplane. That is that embattled airplane from Boeing. Looking over at Costco, up over 0.5 percentage point right now. For Costco, Barclays has upgraded their stock to overweight. We will be chatting that a little bit later in the show. On the coronavirus front, the president continuing to recover in the White House after he was discharged from Walter Reed Hospital late yesterday around 6:30 p.m. And in the United States, the current case count right now stands at just under 7.5 million. The death count now stands at roughly 211,000. So we have a lot to chat about today. So let's start with today's market moves with a good friend of the ticker, Alfred Eskandar, Salt Financial President and Chief Operating Officer. Alfred, good to see you again. I know it's been a little bit of time. Yesterday, we saw a nice pop in the markets. Today, fairly flat right now. What are you making from today's moves?
Well, I mean, the pop was over the optimism of a stimulus package, and obviously the president coming out of the hospital was another good signal. So the market embraced it. Today, I think it's more of a question around, the volatility, the reality of the volatility you're going to have to deal with going into the election. And we saw the majority of sectors actually pull back, except for the three you mentioned earlier, which were financial, industrials, and energy. But those for the year continue to be pretty beaten up. So it's nice to see them get a little bit of a kick.
So, Alfred, you did mention the elections. I will get to that in just a moment, but want to ask you about some of the comments that we heard from Jay Powell, essentially undercutting that argument that we've often heard from Republicans about a smaller stimulus package. The White House did a counter proposal of that $2.2 trillion package from the Democrats, $1.6 trillion from the White House. I'm wondering if what you make of Jay Powell's comments, and if you think the markets right now are considering stimulus a foregone conclusion, especially after we've had a couple of months now where negotiations essentially have been stalled.
Yeah, I think if you compare, sort of side by side, with the exception of the overall size, there's a lot of similarities. The big one that really stands out would be the $400 versus $600 a week that the Republicans are offering versus the $600 that the Dems would prefer. And I think Powell's comments are directly contrary to what the White House has been saying about we don't necessarily need it. We have an economy that is improving. 400 is sufficient. So I think he's probably going to hear some tweets or from the president about that specific comment. That being said, the number of 1.6 trillion is tremendous. And obviously 2.2 is greater. So I think the market is pricing in a substantial stimulus. And what they're hearing from the Fed is that it is needed. It is something that will clearly be beneficial to help the economy recover at a faster pace.
So on the note of elections, which you did mention, we've been talking to a couple of people, and we of course keep continuously asking essentially the question I'm asking you, which is how much volatility are we going to be seeing around the election? And folks keep saying, listen, make sure not to overplay politics, particularly when we consider the market's moves. But even taking that into consideration, how volatile do you think markets are going to be getting ahead or even right after the election?
Well, they're pretty volatile right now. If you recall back in April, March, the VIX was north of 45 and it's roughly 28 now. Looking at the VIX futures for November and December, you see an expected level of elevation, and whether that's around the contested outcome of the election, God knows what's ultimately going to progress, or if there's another setback with COVID. So there's a tremendous amount of uncertainty for sure. So we do see that VIX levels and volatility going into the end of the year are going to remain elevated. That being said, there's a number of things that investors can do to kind of help protect themselves against some of this volatility. And the good news for investors is that you don't necessarily have to be a massively sophisticated trader to benefit from hedging and buffer strategies that are aimed to kind of protect you in these volatile times. I mean, there's actual products now, like the Direction Dynamic Hedge product, that will actually do that for you. There's buffer products that will actually, protect you from the first, 9 or 10% of a market pullback. So the good news is there are products for investors to lean on to help get them some protection in these volatile months coming up.
Do you think that markets have baked in a Biden victory, a blue wave? We're seeing the polls showing that Joe Biden right now is expanding his lead over President Trump.
Yeah, the good news for the Biden campaign is the perceived lead seems to be getting bigger. Whether you look at the CNN poll or even the Fox News poll, they've got Vice President Biden building on his lead, where CNN, I believe, has him up by 16 points versus Fox's 14 points. Either one is a tremendous margin. And even if you factor in the margin of error, there's still nearly double digits that the vice president seems to be ahead of Trump right now.
All right. So, Alfred, I was reading your note, and you say that tech continues to drive returns. I was looking today, however, we are seeing financial ETFs performing well. I'm wondering if investors should really start considering to look more and more at value.
Well, value and small caps seem to be working together right now, which is not something that has worked all year. Again, I go into sort of what is the risk appetite for the particular investor? Are you matching up that risk appetite with the appropriate mix of products? I mean, financials are up roughly 10% in the last week or so of trading, but they've been down all year and they're still net down for the year. So a lot of times when you have a few sectors that have really pulled away, the ones that have been really beaten down become a little bit more attractive as the investor takes some of the money off of the big winners and starts buying some of these sectors or ETFs that have been pretty beaten up for the year.
All right. Well, we will leave that there. Alfred Eskandar, Salt Financial President and Chief Operating Officer. Always good chatting with you. Hopefully it won't be a whole month before I get to talk to you again. Thanks so much.
Good to be with you again, Kristen.
All right, well, let's talk about coronavirus now. The president, as I had mentioned earlier, has returned to the White House to continue his recovery after leaving Walter Reed Hospital yesterday evening. So to chat about this and much more, we're joined now by Yahoo News medical contributor, Dr. Uchi Blackstock, Advancing Health Equity CEO. So doctor, good to have you with us. We saw the president is still infectious and headed to the White House. I'm wondering what your response was to his choosing to leave Walter Reed Hospital. And as a doctor, what do you think that message that he's sending to the public is?
So those are such great questions. And I think what I would say is, like, for the average American who was at his age, in his condition, who had received the medications that he received and had the symptoms that he had, they would probably still be in the hospital. So it is unusual that in the course of his disease, that he's left the hospital quite prematurely. But also we have to consider that he's essentially in a hospital within the White House. He's getting 24/7 medical care. He's still getting intravenous medications and being closely monitored. And so I want to say that this is definitely an exceptional situation and not something that most Americans think about when thinking about the normal course of this disease.
So speaking to the message we have been getting from the president, at least in terms of that move and that decision to leave the hospital, we also have the message that the president decided to tweet out to the American public. He said, quote, "Flu season is coming up. Many people every year, sometimes over 100,000, and despite the vaccine, die from the flu. Are we going to close down our country? No, we have learned to live with it. Just like we are learning to live with COVID. In most populations, far less lethal." I believe he was meaning far less lethal than the flu coronavirus. I'm wondering if you could just do a quick fact check for that statement for us. I have been reading that a lot of what he said in that tweet is incorrect, but I figure it is better for the people to hear from a doctor than from me to do that fact checking.
Sure. Yeah. I mean, it seems like he's trying to normalize the coronavirus, and the coronavirus is not like the flu. First of all, you're 10 times more likely to be hospitalized by coronavirus, 10 times more likely to die from coronavirus. The flu has killed on average between 12,000 and 62,000 people a year. We're already at 210,000 deaths in this country. And so, I can hope those points just show you how we're dealing with the coronavirus is totally different than dealing with the flu. And we also have a vaccine for the flu, and we don't have a safe and effective one yet for coronavirus. So that's another big difference.
I'm wondering if you've seen the president's moves, even just, let's just say over the last 72 hours or ever since Friday when we found out he was diagnosed with coronavirus. I know you've seen the tweets, you've seen some of the messages that have come out from the president. He came out and said, don't fear COVID, don't let it dominate our lives. I'm wondering if you think that the president's actions and also just some of his latest messages, if you believe that he is endangering the American public, both directly, if you're working in the White House and you are one of those staffers, or even indirectly, if you're just someone, who listens to what the president has to say.
Yeah, no, I agree. And the messaging, the actions, the behavior, really are almost unconscionable and appalling and incredibly irresponsible. He is the leader of this nation. He should be role modeling the basic public health measures that we know work. I mean, he arrived at the White House and took off his mask, and so we have to worry about him exposing infectious particles to other White House staffers, people who are cooking his meals, serving him. I mean, it's incredibly irresponsible. And then the message that he's sending to Americans that this is a benign virus. This virus is far from benign. We saw what it did here in New York City and what it's done across the country. And I think that Americans need to understand that we're not anywhere near out of this pandemic, and that we need to really keep using those public health measures that we know actually work.
I want to mention, or ask you rather, about something that you just mentioned a moment ago, which is the vaccine, that we do not yet have a vaccine for coronavirus. We have seen the news that the White House has actually stepped in and intervened to block these new guidelines from the FDA, which is a reminder for everyone, is an agency that works to make sure that the food and the drugs that we take are safe and follow certain safety guidelines. The White House stepped in and prevented the FDA from issuing these new guidelines for vaccines that essentially would mean that a coronavirus vaccine, if these guidelines were implemented, a coronavirus vaccine would not be brought to market or available until after the election. I'm wondering what your thoughts are on this move. The White House said that they did not believe that these stringent guidelines from the FDA, which essentially was going to require trials for, I believe, over 2 months, they did not believe them medically necessary. You, I'm sure, have been talking about vaccines quite a bit. What are your thoughts on that move?
Yeah, no, so I actually, along with a group of about 60 other physicians and public experts, actually sent a letter to Pfizer's CEO, Albert Bourla, about this the week before last, because we're really concerned about political interference in the vaccine development process. This is incredibly concerning. Those 2 months that we're asking for manufacturers to use are to assess whether or not there are any safety and efficacy issues that come up. And so we cannot compromise that timeline. That has to be done. And if that results in a vaccine being available after the election, then so be it. There's nothing worse than coming out with a vaccine that is ineffective and unsafe to undermine public trust.
All right. Doctor, I just had one last question for you. If you can speak a little bit more to the fact that perhaps politics are interfering too much in this fight with the pandemic. And do you think that kind of gives credence to what you're hinting about right now, that people are fearful of taking that first generation vaccine, and that people just frankly do not trust the president and in a way, more broadly, the government when it comes to fighting and treating this virus?
Right. Yeah, no, I think the pattern of political interference that we've seen, whether it be from emergency use authorization of hydroxychloroquine or interference in the school reopening guidelines, or even in whether or not coronavirus is airborne or not, right? We've seen interference in that with the CDC, really continues to undermine the trust the public has for these agencies that have been around for a very long time and that were really well respected. And so I think that, it's important, and what we've seen actually today is that the number of Americans that will be willing to take a vaccine is slowly decreasing. And so we really can't have that, because if that happens, we are going to prolong this pandemic, right? We need to get a certain percentage of the population who's willing to take these vaccines. And so this political interference is really is decimating any trust that's left that the public has for these previously esteemed agencies.
All right, well, we will leave that there. Yahoo News medical contributor, Dr. Uchi Blackstock, Advancing Health Equity CEO. Thank you so much for joining us today.
Thank you for having me.
And coming up after the break, we will be joined by the philanthropist, former investor, and one-time Democratic presidential candidate, Tom Steyer. That's up next. Welcome back to Yahoo Finance. Checking market action right now. All three major indices remain in the green. The NASDAQ had been in the red a little bit earlier, still fairly flat right now, up about 0.2 of a percentage point. We are seeing the Dow right now, the leader of the day, up under half a percentage point right now. The S&P 500 up about 1/3 of a percentage point. Now, in that last segment, we were chatting about the president's health. And so I want to pick that conversation up here with former Democratic presidential candidate Tom Steyer. Tom, thank you so much for joining us. I want to start with the moves that we're seeing out of the White House, particularly with President Trump. He's insisted on recovering in the White House and then tweeted out that Americans shouldn't be afraid of COVID, nor should they let it dominate our lives. I'm wondering if you think the president, I had asked the doctor this in the last segment, I'm wondering if you think right now that the president directly or indirectly is endangering American lives in some of these moves.
Well, he obviously is. I mean, he has made it clear that he doesn't respect the use of masks, that he doesn't think that Americans should be taking precautions to protect each other. And I think that that is something which has been true since the very beginning of this pandemic. And I think that he has made it worse in the United States, and that he has basically failed in his basic function as president, which is to preserve the safety and health of Americans first and foremost. And he has absolutely failed to come up with any concerted plan to deal with this virus and to keep Americans safe. I think it's, emblematic of his presidency, to be honest.
So on that point of a lack of a plan, what do you think is the cost borne by us all, generally speaking, when we see the politicization of something that shouldn't be political, which is a virus who does not care who you are or where you are? What do you make of that? And what do you think that the impact is going to be even longer term in the United States, that we see this politicization of our own scientists and of medicine?
Well, Kristen, I think it's obvious that he's putting his own political interests ahead of the safety and health of American citizens, and that is just plain wrong. But let me say, this is by no means a unique performance by this president, because he has been putting his political interests ahead of the safety and health of Americans in terms of our climate crisis from the time he was inaugurated. And so what we're seeing is somebody who has chosen not to do his job for the American people. And it is absolutely dangerous in terms of health. It is absolutely dangerous in terms of prosperity and growth. I think there's no question in my mind, and I don't think there's any secret about this, I'm foursquare behind Joe Biden, because he plans to deal effectively with the virus. He plans to deal effectively with our unemployment issues, and he plans to deal effectively in terms of justice and climate. So we couldn't have a bigger chasm in terms of what the different candidates are promising.
So speaking about Joe Biden, there is a presidential debate next week in Miami. The president insisting that he wants to be there. For his part, Joe Biden saying that he would see President Trump on that debate stage if it was deemed safe. I know that you watched the last debate. All of us said how chaotic it was with the interruptions. I'm wondering, given the concerns about coronavirus and perhaps even the president's performance from last week, if you think that Joe Biden, frankly, should skip this debate and wait a little bit longer.
Well, Kristen, I believe that every debate is an opportunity, like the first debate, for Joe Biden to absolutely beat the pants off Donald Trump. I think that Americans walked away from that first debate, and I think you can see this in any, polling data or conversation with Americans, thinking that he's a far superior choice and that he really won that debate hands down. And I think that you weigh the real opportunity for Joe Biden to build on his lead against the risk of him being infected. And that's a risk that I don't think the country should bear. And so I look at this as Donald Trump probably was infected at the time of the first debate, if you go back and figure out when he showed extreme symptoms. And I think that therefore the Biden campaign has to be absolutely convinced that Joe Biden will be safe to make it worth it, because I think any debate is going to be a big opportunity for Joe Biden to show how much better he is than Donald Trump.
All right, I want to switch gears here and just ask you about stimulus. We do have some optimism around stimulus talks, but the talks continue to drag on, this three-pronged negotiation between the White House, the Republicans, Democrats. What do you want to see out of the next stimulus package, and how large should it be? What is that headline figure that you would like to see out of a package? Is it 3 trillion, 2.2 trillion, or somewhere less or in between?
Look, I don't have a specific number in mind, Kristen. I think it is absolutely critical that, in fact, we have a stimulus package that comes to the aid of struggling American citizens and also comes to the aid of state and local governments. The one place in our system where you're allowed to do deficit spending is at the federal government level. And we can see that this pandemic has blown a hole in the budgets of state and local governments supplying essential services to their citizens. And I think it's absolutely critical that, in fact, the federal government come and support those state and local governments in doing those jobs. And I think that it's critical that we have a big stimulus package. And I think what we're hearing from economists, which I think is true, is this is something that is necessary. This is the time to do it. It's overdue because of the wrangling, and they should get it done.
All right. Well, speaking about something that is blowing a huge hole in budgets, I want to ask about your state of California right now, struggling with wildfires, which continue to grow and spread across the state. Climate change was a huge part of your platform when you were a presidential candidate. I'm wondering what you think California as a state needs to be doing going forward to really combat these wildfires, and also what moves you think we need to see the federal government making to prevent wildfires in not just California, but we're also seeing them in states like Oregon as well.
Well, let me put those wildfires in some perspective, Kristen. We've had over 4 million acres burn. That's more than double any year in history. It's bigger than the state of Connecticut. And we're in the middle of fire season. We're not at all done. The fires followed the hottest month ever recorded in California, which was August. And it included the highest temperature ever recorded on the planet Earth, which was 130 degrees in Death Valley in August. So what we're seeing is Californians living climate change just the way we are across the West, but we can also see people on the East Coast living climate change in the record number of hurricanes and storms that we're seeing this year. So what do we need to see? We need to see a couple of things. We need to see adaptation, which is knowing that we're in the situation we're in, how do we manage the forests in a way to reduce fires? But that is dealing with a symptom. We have an underlying cause of what's going on, which is the world is getting hotter as a result of greenhouse gas emissions. And that is something where we need a concerted effort between the federal government, governments around the world, but including state governments, to reduce greenhouse gas emissions. And let me say, the Biden plan, the Build Back Better plan that he put forward about climate, is a necessary and aggressive plan, but it also addresses the very high unemployment. It will create millions of good paying middle-class jobs. And it also addresses some of our health issues in the United States, specifically air pollution, water pollution, and toxicity, particularly in underserved Black and brown communities. So when you talk about what do we need to do, we need to address the symptoms. We need to deal with the issues that are affecting American citizens and Californians right now and reduce them going forward and support them when they're burned out or endangered or their homes are burned down. But we also need to address the underlying root cause. And that's something we need to do at a state level. And you can see Governor Newsom has taken some very strong actions. At a federal level, I think Vice President Biden is proposing something that is very aggressive and important. But more than that, we need to lead the world again. We need to create the industries that make a green economy possible. We need to act diplomatically around the world and gather the other countries to solve what is a global problem and that threatens the health and safety of every American.
All right. Well, unfortunately, we will have to leave that there. We just do not have any more time. Tom Steyer, former Democratic presidential candidate, we will have to have you back. I know that there will be many more issues to chat with you about in the coming weeks and months. Thanks so much for joining us.
Thank you, Kristen.
And coming up after a quick break, we will be chatting Apple and Costco. That's next. Here on Yahoo Finance, taking a look at the markets right now, all three major indices remain in the green right now. The NASDAQ actually accelerating some of the gains, up about 0.25 percentage point right now. The Dow and the S&P 500 fairly in line with each other, both up about 0.5 percentage point right now. But let's talk Apple. They have an iPhone event date announcement. So for more on that, we have Yahoo Finance's techspert, Dan Howley. Hey, Dan, tell us about what we have going on over at Apple.
Yeah, Kristen, so October 13th, that's the date that Apple is going to host its event. This looks like it's going to be the iPhone event that we were expecting last month, but was held up because of COVID-19 and the pandemic around it. This event should show off the iPhone with 5G capabilities. It's kind of alluded to in the actual tagline for the event that has to do with speed. 5G is a faster version of cellular connectivity than 4G LTE. And that's really going to be the main feature of these phones. We also could get new headphones from Apple, over-the-ear headphones that would kind of rival what you would get out of Bose, which we now know have been pushed out of Apple stores, and a new kind of solo speaker that would kind of be a replacement for the HomePod. It would be a smaller version, most likely, and we now know that Sonos and its speakers being pushed out of Apple stores as well. So these would rival those. So it looks to be a pretty packed event. But obviously the star of the show will be the iPhone, which we're tentatively calling the iPhone 12. We just don't know the full name yet.
And I also want to ask you about a new survey from Piper Jaffray showing this is something I know that's very much in your wheelhouse. Call of Duty overtaking Fortnite. I haven't played either one of those games, but tell us more about that.
Yeah, I play Call of Duty way too much. Basically the way I keep in touch with my friends. So maybe I'm just like every teen out there. I'm not though. But yeah, so according to this Piper Sandler study, basically what's going on is that Call of Duty has overtaken Fortnite among teens as far as popularity goes. And by that, I mean, it's like essentially crushing it. 62% of respondents have said that they play Call of Duty. That's up from 33% in the spring. Now, Fortnite, which is made by Epic Games, which is locked in that legal battle with Apple, has seen those numbers drop. Not too badly, but enough. They're not up there with Call of Duty. They went from 39% in the spring to 37% now. Now, when you think about the context of the pandemic, though, those numbers are pretty bad when we've seen interactions with games just go through the roof as kids haven't been able to do anything throughout the summer. There's less to do as far as movies, team sports, things along those lines. So kids are now playing more games. So the fact that Fortnite fell off while Call of Duty exploded could be worrying for Epic Games. Call of Duty, by the way, this is the free-to-play version called Warzone. It came out March 10th, so it really just hit at the right time. And Activision Blizzard has been pumping out updates for it nonstop, making it more and more interesting for gamers. So this is a big thing for Activision Blizzard. For myself, I just continue to play Call of Duty and will continue to do so going forward, regardless of what the teens think is cool.
I don't know, Dan. I don't know if I buy that you're not just like every other American teen out there. Thank you so much, Dan Howley. Well, let's talk now about Costco. As I mentioned earlier in the show, they were given an upgrade to overweight from Barclays. So for more on this, we're joined now by Yahoo Finance's Emily McCormick. Hey, Emily.
Hello, Kristen. And we did see another Wall Street firm now getting bullish on Costco, this time coming from Barclays and analyst Karen Short. She upgraded shares of the company to overweight from equal weight rate and raised her price target on the stock to $400 from $330 previously. That would imply upside of about 11.6% from yesterday's closing levels. Now, a few assumptions here served as catalyst for this upgrade. One is Barclays' expectation that traffic levels will remain robust and continue to improve going forward. Now, remember that we saw Costco in its fiscal fourth quarter growing comparable same-store sales by a better than expected 14% for that period ending in August. Now, the company did note at the time that traffic in person at stores was down overall, but actually up in U.S. stores specifically during that time frame. So potentially something to see continue to improve in the quarters ahead. Now, Barclays also speculated that increases in membership fees could be on the horizon in the intermediate term. That's something that could also help with Costco's top line, since we did see membership fee growth come in a bit slower than expected in that fourth quarter. It was up a bit over 5% over last year. Now, also on a separate subject, want to highlight that Barclays said that there is a high likelihood that Costco may pay out a special dividend in the near term, given its current cash balances. Those cash and cash equivalents had been at $12.3 billion at the end of the August quarter. And note that Costco has paid out special dividends in the past. These tend to be quite a bit higher than its regular dividends. For context, we just had that last declared dividend this past summer at 70 cents per share. The last special dividend had been $7 per share back in 2017, so quite a bit higher there. Now, lastly, the final thing I want to point out is a key point that Barclays made around what it considers to be Costco's, quote, special sauce. And that's what they said is the company's merchandising excellence, driven in turn by Costco's special curation, its private label, and the treasure hunting experience that it's really curated for its customers. In a key quote here, they said, quote, "It may often be overlooked that Costco's best-in-class presence all starts with merchandise, the discipline of having 3,800 stock keeping units, and its ability to leverage relationships with vendors and suppliers. This leads to a best-in-class velocity in SKUs unmatched across all of retail globally." Now, on the heels of this note, we do have Costco shares up about 1% intraday and adding to a year-to-date gain of about 20%. Kristen?
All right. Thanks so much, Emily McCormick. Well, on the other side of a quick break, we will be doing another look at the markets. Welcome back to Yahoo Finance. Well, let's talk the markets and the economic outlook. We're joined now by Kathy Jones, Charles Schwab's chief fixed income strategist. Kathy, good to see you again. I want to start with the economic outlook. You were expecting, I was reading your note a little bit earlier, for the economic recovery to continue, as most are. Wondering how slowly, however, you think that recovery is going to be, given all of the headwinds that we have out there, particularly around coronavirus and the potential for a second wave as we're starting to see these case counts start to surge.
Yeah, I would say that the biggest headwind is the rise in coronavirus and the drop in consumer confidence that goes with it. So whenever it enters a community or an area, what we see is people's willingness to congregate goes down. And of course, that affects business and hiring, et cetera. So clearly that's critical. I think one of the factors that we're also closely watching is fiscal stimulus. Had a lot of talk about it today. Congress and the White House continue to talking about fiscal stimulus. It seems to be up and down. If we get it, I think we can count on a little bit stronger pace of growth and the recovery getting some traction sooner rather than later. If it gets pushed off into next year, then we'll probably have a pretty soft fourth quarter ahead of us.
Now, we are seeing Treasury yields hitting their highest levels since June. I'm wondering how you think investors are viewing that economic outlook, and is it too optimistic as we're seeing some of these moves in the yield curve right now?
I don't think it's overly optimistic. I think it's predicated on a couple of factors. That we have a recovery that looks self-sustaining, even though it isn't strong. It looks like it can sustain. We may get some fiscal stimulus at some point in the next 3 to 6 months to give it a little bit of a boost to the economy. We've beaten back the disinflation, deflation fears that were in the market. We have a lot of supply to come to be absorbed because of the rising deficits. So all those factors are in play in terms of pushing longer term yields up. But I do think that there's a limit to how high they're going to go. If it moves up too fast or too far, I think the Fed would probably step in and start purchasing longer term bonds to cap out the rise in yields in 10 and 30 years.
Now, your note was also saying that you're going to see the yield curve steepen, but that it is going to be a bumpy road ahead. How bumpy do you think it is going to be, particularly considering that we have elections coming up in just under 4 weeks?
Yeah, that's one of the big critical factors that I think keeps volatility high. Not only do we have the elections, but we may not have the results of the elections right away. It's going to make people a little bit nervous about positioning. And so from time to time, a flight to safety that pulls yields down is certainly a reasonable expectation. But then if, again, depending on fiscal stimulus and a few other factors out there, if we get some decent economic numbers, we're going to see the yields bounce back up. So our expectation is for a gradual steepening in the yield curve, but not a smooth ride between now and early next year.
We heard Jay Powell speaking a little bit earlier today. Take a listen to what he had to say a little bit earlier.
The committee also left the target range for the federal funds rate unchanged at 0 to 0.25%. And it expects it will be appropriate to maintain this target range until labor market conditions have reached levels that are consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. We expect that the new framework and guidance will support our efforts in pursuit of a strong economic recovery.
Now, Powell did say that we cannot necessarily expect negative interest rates soon. They are trying to hold that interest rate near zero for the next couple of years, Kathy. But of course, he repeated again his call for stimulus. And we do have some renewed hopes on stimulus between the Republicans, the White House, Democrats. I'm wondering how much you think markets, and even I guess the Fed, when looking at their toolbox, which they are running out of room of what they can do, are looking at stimulus as a foregone conclusion.
I think a lot of the move up that we've seen in yields over the last couple of weeks is really partly due to the expectation that we'll get some sort of a deal out of Washington. And then after the election, no matter who wins, an expectation that we'll get at least some infrastructure or some other sort of fiscal relief that comes into the market. It seems as though the sticking point right now is aid to state and local governments. If they can get past that, then that would be a real positive for the economic outlook and pull up yields. But again, Powell keeps asking for it. Economists continue to talk about the need for it as a bridge over this time period before we get a vaccine. But Congress and the White House don't seem to be able to come to terms on it. So that's one of the real risk factors here over the next couple of months.
All right, Chief Fixed Income Strategist at Charles Schwab, Kathy Jones, thanks so much for joining us today.
Thank you.
And after the break, we will be talking about the White House, particularly the president choosing to recover with coronavirus inside the White House. That's next. Welcome back to Yahoo Finance. As we have been talking about throughout this show, we saw the president leave Walter Reed Hospital late yesterday and decide to recover inside the White House. And since then, we have gotten news headline after news headline as members of the administration become sick with coronavirus. We had Kayleigh McEnany, and earlier today we had General Milley, head of the Joint Chiefs of Staff, as well as other members of the Joint Chiefs of Staff, need to quarantine after an admiral tested positive for coronavirus. So we are going to chat this now with Yahoo Finance's Rick Newman. So Rick, you pose a very interesting question, which was this: if a business had as many employees get sick at the White House as we are seeing happening at the White House, wouldn't it get sued? So I guess I'm going to throw that question right to you. Do you think that there could be lawsuits coming down the pike, perhaps, as porters and cooks and just everyday workers inside the White House are getting exposed to coronavirus because the president decided he wanted to leave the hospital?
Probably not at the White House itself, because the White House enjoys some unusual protections. But if this were any other ordinary business in Washington, D.C., the answer is yes, it would be facing a lot of legal liability. I mean, all the stores and other businesses operating around the White House, they all have to abide by Washington, D.C. regulations that are pretty familiar to any of us living in a city at the moment. If you go into a store or work in a store or any business, you have to wear a mask. Businesses have to allow for distancing of employees and customers inside those buildings. And of course, most businesses have signs up that say you have to wear a mask or you can't come in. That is obviously not the case at the White House, where they have just flagrantly flaunted what are CDC guidelines for how to safely operate a business. And of course, as I just said, Washington, D.C. guidelines, which are similar to what many states and cities have. But the thing about the White House, is that it is the federal government. It is actually not subject to the rules within Washington, D.C. or any state or local jurisdiction. The federal government actually has to abide by laws that OSHA sets. That's the Occupational Safety and Health Administration. And big surprise, OSHA has issued no rules at all for businesses and how they should operate safely during the coronavirus pandemic. So in a way that lets every federal agency off the hook, because there actually are no rules by which it has to comply. So there could be some legal redress for employees who work at the White House, but it would be tough.
So, Rick, I want to ask you about something that we're seeing from Donald Trump. He tweeted out that he's instructed his representatives to stop negotiating until after the election, when immediately after I win, we will pass a major stimulus bill that focuses on hardworking Americans and small business. So some bad news there, at least when it comes to the stimulus negotiations. We're just getting that through. We're seeing markets right now take a huge leg down. They've all flipped right now into the negative. Want to know if you can react on that. Donald Trump saying, listen, no more stimulus negotiations until after the election.
Well, he's trying to get control of the messaging here, but this is not a surprise. Frankly, I'm surprised. I was surprised that markets actually seemed to rally yesterday on hopes that there would be a stimulus deal, because the two sides actually seem hopelessly far apart, regardless of what Nancy Pelosi might be saying or Steve Mnuchin, the Treasury Secretary, might be saying. I think markets should take heart here, because we've been reporting this. I've written this. If Joe Biden actually wins in November and Democrats take control of the Senate and they have unified control of the government in Washington, we're going to see a huge stimulus bill. They're not going to have to negotiate with the Republicans at all. And we're going to go back as a baseline, not to the $2.4 trillion bill that Democrats are trying to get enacted now, but the $3.4 trillion bill that they already enacted last May. So if we do have to wait, which I think we do, under either scenario, if Democrats win, it's going to be a big stimulus bill. And if Trump actually does win, it does not look like he will, but if he does, then Democrats there really would be no reason for them to stand in the way of what would probably be a smaller bill. So it's coming one way or the other, probably just later than most people think it should be.
All right. And as I mentioned, we're starting to see markets start to accelerate those losses. The NASDAQ right now down about 0.75 of a percentage point. Thanks so much, Rick.
See ya.
And we will be right back after a quick break. Welcome back to Yahoo Finance. We are continuing to see markets start to accelerate those losses after Donald Trump just tweeted out just a couple of moments ago that he is instructing stimulus negotiations to be put on hold until after the election. The Dow right now down over 300 points. And we are looking at the airlines right now, which are in the red. They are accelerating their losses as the hopes for getting some kind of money from a part of a stimulus package all but fade right now. United down about 3.5%, Delta down about 2.5%, and American Airlines is down just under 3.5% right now. So we want to bring in Yahoo Finance's Sabine Marcellus to chat the impact, particularly on the airlines going forward. Hey, Sabine.
Kristen, so what we're seeing is that the airlines were really hoping for this deal between top Democrats, House Speaker Nancy Pelosi, and Treasury Secretary Steve Mnuchin for another round of fiscal stimulus to help the airline industry. They were asking for an additional $25 billion. We saw last week they let go of more than 32,000 U.S. airline employees. And on this news, clearly this is devastating news for employees who were hoping that maybe they'd be called back if a deal was struck. But we're seeing right now, no hopes of that. Election politics has gotten in the way, and Americans won't be getting that next round of fiscal relief for weeks at minimum.
All right. Well, thank you so much, Sabine. The final round is next. They will be continuing to watch this turn in the markets.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles London with you in New York on this Tuesday afternoon. And let's take a look at the stock market right now. Huge reversal just within the last 10 minutes. Right now, we are looking at all three majors currently at session lows. The NASDAQ is off more than 1.1%. The Dow is off just under 1%, as well as the S&P. They're both down 96 basis points right now. And the proximate cause of this stress, some tweets from the president saying that he is asking representatives or members of the GOP to stop negotiations with Democrats over an additional stimulus package until after the election. Trump tweeting in a series of tweets here saying, I've instructed my representatives to stop negotiating until after the election, when immediately after I win, we will pass a major stimulus bill that focuses on hardworking Americans and small business and so on. That is the middle tweet of 4 here from the president. But again, this sending markets sharply lower here just within the last couple of minutes. Now, we'll sort of see where things shake out. The drop has been precipitous here within the major indices. Again, about 1% just within a few minutes. We'll see how much more selling pressure comes into the market as we get towards the closing bell. Now, as we are looking at the Wi-Fi interactive chart here, you can see we are still trading above levels that we were sitting at just a couple of days ago. So the market, even with this sell-off today, still very much range bound. That's a conversation that we've been having for some time here on this program. We've talked ad nauseum and will, of course, over the next 4 weeks until we get to the election about, the risk of that event, the risk of the stimulus, the president's health, any news on vaccines, treatments, so on and so forth. All of these events have really created a challenging situation for investors. And I think, this kind of headline is something that, while the details of it were not exactly predicted by many folks, you knew there was this sort of thing sitting out there. And I think certainly kept kind of a lid perhaps on how much enthusiasm there could have ever been given the market's rally we've seen just in the last couple of days. All right, I want to bring in my co-host, Shauna Smith, joining us here for the next couple of hours. Shauna, just for your first impressions on this news, which really changes the tenor of the day that we thought we were going to be discussing in the markets.
Yeah, it certainly does, Miles. We were up over 200 points in the Dow at the highs of the day. Right now, we're looking at a sell-off just around 300 points. And of course, this might have been expected. I think we've talked to a number of market guests over the last couple of weeks that were skeptical that we were going to get anything done ahead of the election. But I think the fact that President Trump now reiterating that he wants the talks to be called off until after the November election, at least getting investors' attention for today and triggering some concern here in the markets. And remember that this comes after we heard from Fed Chair Jay Powell this morning. He was reiterating his call for additional fiscal stimulus, saying that it is necessary in order for the economic recovery to continue. So I think on the heels of those comments from Powell, the market taking this a little bit more seriously. When you take a look at the sell-off today, all three of the major averages now off over 1%. We're also seeing the yield on the 10-year Treasury taking a little bit of a hit, off just around 4 basis points right now. Ahead of this call from President Trump, or ahead of this announcement, I should say, from President Trump, Brand Energy is one of the best performing sectors of the day. But obviously that changing here with energy, the XLE now under a little bit of pressure. Crude, though, closing to the upside today, up just around 3%. It has gained a lot of momentum in the past 2 days, up just around 9%. So crude above $40 a barrel is something to watch in this trading action. And the reopening trade on that vaccine news that we got, the reopening trade getting a little bit of a boost today. When you take a look at the leaders inside the S&P, Royal Caribbean amongst the big winners there, that stock up almost 3%. Norwegian also amongst the gainers, up just around 2% today. Carnival is also one of the winners here, up around 2%. So the reopening trade coming into favor here amongst investors. When you take a look at some of the losers on the flip side, big tech under a little bit of pressure today. A couple of things going on with the reopening trade back in favor, big tech falling out of favor. And we also know that a lot of these bigger names are facing some scrutiny in Congress. We're expected to get a little more details as the weeks go on. But that, of course, front and center here for investors today. And then when you take a look inside the Dow, the biggest decliner in the Dow today is Boeing. And I think that's definitely worth noting given the news that we got out of Boeing today. And that, of course, is that the pandemic, they expect the pandemic will hurt aircraft sales for the next 10 years. So Boeing stock off just around 3% in afternoon trading. But when you take a look at this reversal, it really speaks to the fact that even though there was a lot of skepticism out there in the market, I think investors were very hopeful. They were holding out thinking that maybe we were going to get some sort of agreement over the next couple of weeks. But with President Trump now encouraging Republicans to hold off on the talks, that of course adding back some uncertainty here into the market.
Certainly does, and does so very quickly. Let's go to Jared Blickery now for a look at where things stand, Jared, and just what stands out to you in this pretty sudden move we've seen here in the market.
Well, if we wanted to know how much the stimulus was worth for the S&P 500 in the next month, I guess it'd be 1.85%, because that's the movement that we're tracking right now. On an intraday basis, looking at the Wi-Fi Interactive, pretty dramatic. To see it not only take out the lows from earlier in the session, this is Dow Jones Transport, everything's going to basically look the same. Here's the S&P 500. pretty dramatic movement. And we're still within the 5-day range here, but we're heading down more and we're getting to some support. Now, it's interesting because I was talking about the 34.10 level being critical to close above, and we got all the way to 34.30. So we took out these highs earlier, but it's where the settlement is that matters, and we're not going to close anywhere below or above 34.10 today. So this sets up the possibility that we're simply going to head back down and test these 3,200 lows down here over the coming days, or maybe not. Maybe we only go down a little bit more. Maybe we reverse into the close. But I think this has a little bit of momentum. Just looking at some of the other markets, trying to get a feel for what's being priced in right now, it's really the mega cap stocks. It looks like they're off the most. Now, they had been down before, so they were already kind of in the hole here. But you look at Apple down 3 1/3%, Amazon down 3%, and then just about all the other big guys down 2%, Tesla off 4%. That's pretty big. And energy reversed, as Shauna was pointing out, just looking at the banking sector here, that was perfectly green just before all this hit. So I think, so there's going to be a repricing of the infrastructure sucked out of the market, but what effect is that going to have on the big cap names? You look at the interest rate market, I want to see what's happening with the 10-year T-note, and we can see that's a huge reversal because we had headed all the way up to nearly 80 basis points, and read a couple of analyst notes. So you start getting that high, you're going to get a bid in bonds, and that's what's happening. Bonds are being bought, and so the yield is declining right now. Have to see how much of a trend this is over the next few days, because this was a really big upsurge we have over the last 5 trading days. So it's going to be very important to watch the close, not only today, but in the coming days to figure out exactly what's being priced in.
All right, Jared Blickry, we will talk with you later on in today's program. All right, let's turn our attention back now to everything going on with the coronavirus, specifically the current condition of the president returning to the White House last night. Anjali Khemlani joins us now for the latest on that. Anjali.
Thank you, Miles. Yes, we know that the president came back to the White House in grand form, stepping down from Marine One and up the stairs to the balcony of the White House, where he then greeted the cameras. We do know that since then, he's been quarantined in a medical unit, and there has been concern and reports of concern throughout the White House about just how sort of antsy he might be getting sitting in quarantine. We know the president likes to be pretty busy. So listen to what he had to say as soon as he came off Marine One back to the White House.
Don't let it dominate you. Don't be afraid of it. You're going to beat it. As your leader, I had to do that. I knew there's danger to it, but I had to do it. I stood out front. I led. Nobody that's a leader would not do what I did. And I know there's a risk, there's a danger, but that's okay. And now I'm better, and maybe I'm immune. I don't know.
So as you can hear, the tone still carrying a lot of confidence, and that dangerous public health messaging that has gotten many health experts worried about not being afraid, as we discussed yesterday, about the virus. But going forward, we're still waiting to see what the contact tracing efforts do turn up in terms of who and where, who is affected and where individuals were in fact infected. Meanwhile, talks about the vaccine. While the president is talking about being immune, he may well have antibodies at this point, but many Americans still don't. And the FDA is looking to sort of expand its guidelines to 2-month observation periods for phase 3 trials. It's a topic we've discussed before, but the White House is pushing back, saying that at the behest of the industry, they are unlikely to be doing that and approving that. But language about this is already out. The FDA's advisory board, slated to meet on October 22nd, is going to be addressing this, and it should be coming up sort of in headlines then. But even then, the White House can, in fact, push back and override that. At this point in time, it looks like the industry, at least some, are not saying that they are against it. Pfizer CEO tweeting earlier that he hasn't had discussions with the White House, and he does, in fact, support the FDA and their efforts. So that's something definitely to keep an eye on. Meanwhile, talking about vaccines, the World Health Organization is saying that they will consider Chinese vaccines to distribute to the world. And that's something that, of course, has been of concern. China going ahead and distributing their vaccine internally, even to individuals, despite not getting through their late stage trials, which is sort of exactly the conundrum we were trying to avoid. here in the US. So still waiting to hear whether or not they actually make it through. China right now leading the world with vaccines, 4 in late stage trials, and already utilizing it within their population.
I just hope, Anjali, that in 4 weeks plus 1 day, we can go back to talking about aggressive vaccine trials that aren't explicitly politicized around an election that, by the way, has actually begun. Millions of people have already voted. So I'm not exactly sure why we're playing with this at this point, but so it goes. We've seen this coming for many months. All right, Anjali, we'll talk to you later on this week. All right, coming up on the other side of this break, we will talk about our call of the day. Piper Sandler out with its latest survey of American teens. We'll talk about what they're buying, what they're not, coming up just here in 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Time now for our call of the day. Today we are talking about Piper Sandler's latest semi-annual survey of American teenagers. This latest one took place late August to mid-September. 9,800 survey respondents, average age 15.8, covering 48 states. Average household income of respondents, $67,500, so a bit above the national average there. But a few key takeaways stood out to us going through this report, which is always fun because it is fun to speculate on what the youths are doing these days, especially as we all get older. And I think the headline here is that 48% of teens think the economy is getting worse, the second highest reading that Piper has in its survey, which goes back 20 years, and the highest reading that we've seen in some 9 years. And now we can get into some of the spending data as well. Spending is at a record low, which I think makes some sense given all the stuff that teens would do that was mandated to be closed. But Melody Hom, if we look at teen sentiment, I guess, which we do here at Yahoo Finance when these surveys come up each spring and each fall, we've seen a little air coming out of the teenage consumer for some time. Obviously, the pandemic accelerated some of those trends, but it's been kind of a downbeat period for young American consumers now for really a couple of years.
Yeah, I would say so. And I do have to say, as much as Miles, we try to parse out the Gen Z generation versus millennials versus Gen X, a lot of this survey actually reflects behavior that we see across the board, right? Whether it is a decrease in makeup purchases, it's less money spent on handbags, less money spent on apparel, except for athleisure, right? There are the bright spots that sort of echo what we see in the larger population. And I do have to say, looking at social media in particular, that sort of section of the survey always interests me because we know just the geopolitical drama that we've been covering about TikTok, teens don't care, right? And we talked about this about the monetization side of things yesterday, but TikTok did reach number 2 after Snapchat, and Instagram was bumped down to number 3. And I actually just got off the phone with 2 influencers on TikTok who say the deals that they're getting from TikTok are so much more lucrative at this point and less effort to actually create content that they're not willing to invest that extra time in Instagram. So just thinking through how a lot of the anecdata does kind of reiterate some of the findings here. I also think it's fascinating to see the celebrities that teenagers like. Kevin Hart is number 1. So an older dad figure is still the number 1 celebrity that people love. Donald Trump is also on that list, although he did move lower in ranking. And then David Dobrik, who's a 24-year-old YouTuber, still remains kind of hot for the teens. So it just shows, as much as we can say older folks are irrelevant to a certain extent, teens are still looking to them, right, for some sort of inspiration, creator guidance, and whatnot. And I do have to note that a lot of the influencers that I've been speaking with, when we ask who their motivation is or who their inspiration ultimately is, the 2 names that kept coming up, Will Smith and The Rock. So there are some sort of elements there that you can say are, regardless of age, you want to be able to be your own boss, right? And sort of do everything. And I think that theme still remains constant with this teen generation.
Well, and you mentioned Kevin Hart, I guess, as like the dad figure for teens. Number 4 is Adam Sandler. I mean, I was like, what is this, 1998? It is kind of amazing when you look at that list, just to talk about the celebrities that teens care about. There's this huge gulf of millennials. There's no millennials. It's either Gen X or it's teenagers like them. Okay.
Yeah, precisely. I mean, I just want to pull up the social media personalities, right? Because that just shows there is a total chasm, right? Social media personalities are not seen as celebrities yet. Or perhaps that's Piper's own phrasing, right, when they ask the question. Because when you look at Addison Rae, you look at Charlie D'Amelio, they also have been able to branch outside of social media, whether it's through podcast deals on Spotify, being able to develop their own reality TV shows, becoming the next Kardashian clan, right, to a certain extent. I guess the question is, Miles, when do they reach the celebrity status? When do we not separate them as 2 different categories and they would end up being on a list with Kevin Hart? I don't know. My question is, in a decade, will that actually be the case? I'm curious to see if teens actually are able to meld those 2 worlds together.
Yeah, I think the nature of celebrity is such that I guess the endurance of a Kevin Hart or The Rock or someone gets more impressive, obviously, over time. I guess I just felt like there's no one who's like 30 or 35, right? It's you're either 45 and up, or you're like under 22. And so just an interesting kind of another K-shape perhaps out there in our economy. We are going to talk to Aaron Murphy, an analyst over at Piper, in the next hour, a little bit more about this survey. Now, Aaron covers more of the apparel names. So Shauna, I quickly want to talk about some of the trends we're seeing there, particularly 2 that stood out to me, which is really dragging down overall spending, and I think is a real challenge for some of these retailers that have marketed towards teenagers in a specific way for a long time. Spending on handbags, $87 a year. That's down from $190 back in 2006. And then also cosmetics are cut in half basically since 2017. And I'm thinking about how we've told teens that it's about young people. It's about experiences, ways to make yourself feel good. And now people can't do anything because there's a pandemic.
Yeah, I think that's obviously having a big impact on how they are spending, like you were just saying, just in terms of where they're allocating their money. But in terms of what continues to lead the charts, you brought up some of those apparel names. Nike has been now the #1 spot for 10 years in a row. And it still goes along with what we've been seeing over the past 6 months, this I guess, shift towards athleisure. More and more people, whether I know it's teens, but now they're doing school from their homes. They're at home schooling. A lot of them are not going into the classroom. So they're opting for leggings, for sweatpants, for sweatshirts, for that more comfortable attire than maybe they would if they were going back to school. So that, of course, playing into what we've seen in previous years. But what was interesting to me was the spot that Lululemon had on this list, and jumping to number 6, up 1 spot from a year ago. And why this is interesting is just in terms of the price point. We're seeing teens scale back on how much money that they're spending in retail, yet they're still willing to dish out $100, $120 for a pair of leggings. So it even shows that even in these times, at least, I guess people are still justifying, still finding reason to spend so much money on certain pairs of clothes. So Lululemon was a little bit of a surprising spot, or a little bit surprising, I guess, finding to me in this survey. And then also on the cosmetic side of things, e.l.f. was the #2 preferred makeup brand. And what was interesting to me about this was when Piper Sandler mentioned how TikTok is helping fuel some of the brand success. So we're seeing that bridge between retail and social media, and how retail is really trying to connect with Gen Z and trying to connect with their younger customers through these social media channels. So e.l.f. obviously a company that has been doing that and doing that well. So something that maybe some of these other brands who are struggling a little bit to resonate with the younger generation, what they can do in order to boost their sales. But I think the first stat that you led the segment with, the fact that the record number of teens are concerned about the economy right now and concerned about the COVID-19 pandemic, really just speaks to, one, how personal this pandemic has been to so many people. The fact that teens actually reported the fact that it's impacted more people in their homes than the national average. That, of course, is something to take away from the survey. Also, just I think a lot of the feeling out there is maybe the younger generation is out of touch, but when you see something like the pandemic, obviously it impacts all generations, and we're clearly seeing that through this Piper Sandler survey.
And in the same way that, the millennial generation used to decry the fact that we were told we don't want to form households, we were told that we don't want to own a home. I think that's resonating with this next generation, right? Where kind of, as I mentioned earlier, all of those brands, Shauna, you mentioned e.l.f., which is not a DTC startup, right? Revlon is one of the brands that actually spends a lot of money on marketing campaigns, and 16, 17, 18-year-olds are choosing to work with them. So Miles, to your point, it's almost like our generation is completely cut out of the picture. And a lot of these legacy names from 20, 30 years ago that were popular then seem to have staying power. There seems to be this kind of impetus for young folks to choose the legacy brands that even perhaps their parents used to be fond of. And then one other note I wanted to bring up, Netflix, still king, right? Teens spend 34% of their daily video consumption on the platform, of course, followed by YouTube #2, just proving time and time again that it's going to be harder and harder for these upstarts and for the new incumbents. Paramount is launching a platform next year to really try to get any market share from Netflix.
And you mentioned, kind of the old brands. I guess we're parents now. But I never heard of Shein, but I guess it's now the #2 website for teens to shop on, even though it only has 5% market share. So we could go down that rabbit hole too, I guess, Mel.
Yeah, and that is a Chinese brand. So I just want to point out that TikTok, of course, a Chinese company, Shein, a Chinese company, fast fashion, sort of like an H&M, Uniqlo, Urban Outfitters amalgamation, if you will. And it just proves that as much as we obsess over this idea of ethical clothing, sustainable clothing, we've had so many entrepreneurs coming on to talk about how that's the future and that's what young people care about. That's clearly not the case, right? Amazon is #1, Shein is #2. Let's just think about that in the context of maybe if they get more purchasing power in the future, they'll want to spend more money on better quality clothes, but I'm not so sure based on the current survey.
Yeah, look, sustainability is aspirational. I don't think anyone would really question that. It's really cool to be able to buy a $90 t-shirt, but if it costs $8 and you're a teenager, you're going to buy 4 of them instead. All right, coming up on the other side of this break, we're going to talk about everything going on in the market today, how to think about trading up to the election. JJ Kinahan of TD Ameritrade will join us for that conversation coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a quick look at the markets here. We are still seeing stocks well off their highs, pretty much at session lows across the board. The Nasdaq off 1.3%, the S&P and the Dow both off about 1.2%. For more on everything going on in the market today and what's been going on over the last couple of weeks, we're joined now by JJ Kinahan. He's the chief market strategist over at TD Ameritrade. So JJ, let's just start with what we've seen within the last hour. I guess when we tried to make sense of why the market had sold off in September, what had led to kind of this relative strength in October, a lot of different ideas out there, but clearly some of that had been bullishness around getting a stimulus deal done, which now appears off the table.
Yeah, Miles, first of all, thanks for having me. Appreciate that. What is interesting to me, though, is with the stimulus deal being off the table, I actually thought the reaction might be worse. If you think about the last few rallies we've had, including yesterday, one of the big reasons given for it was, well, we're closer to a stimulus deal. So we've actually enjoyed a lot more upside on this, I think, over the last few weeks than perhaps today's news is showing. Not to say we can't go down further. In fact, the S&P 500 cash trading at about 33.64 when you and I just started talking, it may have some room down to about 33.52. But honestly, I really, obviously it was a quick, violent reaction, but I actually thought we might see a little bit more even because there's been so much sort of bet on this next stimulus deal, particularly around the airline industry, et cetera.
Yeah, and I would tend to agree in the sense that everyone's going to benchmark this to like the TARP failure or whatever, right? That's 4, 5, 6% in the market. But if we think about what has happened today, we're really seeing the biggest reaction from the big cap tech stocks, right? The FANG names are off more than the broader market. So to you, is this kind of one of those situations where right, correlations go to 1? People are just selling winners more aggressively, even though I think, as you know, like the reaction isn't as large in terms of the S&P magnitude as you might expect, given the kind of news we saw.
Yeah, and I love you saying correlations go to 1 on the downside. I think sometimes people miss that. But I think you hit it right on the head. They've been the ones that have led us on the way up. So they're probably the first people, the place many people, especially those who bought in this late spring, early summer, are going to turn to sell. Now, that being said, what I'm very interested in seeing is we've seen this buy the dip mentality how many times? Does that come true now that the news is sort of out there? People have today to deal with. I'm very interested to see as we go a little bit to the close today, and particularly the opening tomorrow, to see if the buy the dip mentality comes true again. If you remember back in early September when we had the sell-off there, that was certainly what people did overall. And it led, at least with our clients, as we saw in our September IMX, with our clients buying primarily the FANG stocks as they sold off when we had the early September sell-off.
Yeah, and I want to ask you about that survey because you mentioned, some of the FANG names, some of the most bought names include Apple. I think we could probably call Tesla a FANG name at this point, even though it doesn't fit the acronym. Meanwhile, Twitter, Ford, Snap, they're getting sold. What does this kind of, this information say to you broadly about investors, or does it speak to any trends that perhaps we're trying to get going in September that just couldn't get off the mat?
Well, a couple of things it speaks to. First of all, we saw our clients take more exposure to the market than they've taken actually in the last 2 years. It's been slowly building. And in September, I think exactly what happened when I was talking about the sell-off, those people who hadn't yet participated finally said, you know what, here is my opportunity. I've missed Apple, or I've missed Microsoft, or I've missed Tesla. What I did find interesting, however, is that we didn't see as much across the board buying, perhaps, as we'd seen in April. We saw people buying a lot of names they know, and a lot less of those names they were sort of, if you will, taking shots on. And in that, I will say Rocket Mortgage, NEO are two of the names that people did buy on sell-offs, but certainly not in the way we'd seen before. And the conversation you were having right before I came out, I found very interesting around what teens are doing, because one of the things I'll tell you that our millennial clients are doing is our millennial clients are actually taking even more exposure than our, I'll use the word, traditional clients. And at first people may be like, oh, crazy millennials. Actually, what it shows to me is a bit of smart money management. Why do I say that? Any financial planner will tell you when you're young is when you should probably take a little bit more risk. So those who are millennials, they are also buying Apple, Microsoft, et cetera. But we saw things like Rocket Mortgage being a little bit higher in what they're buying, DocuSign being a little bit higher. And on the sell side, they were the first ones to buy the cruise lines back in April. So we saw them getting out of RCL, Royal Caribbean Cruises, and we saw them getting out of Delta. So I found that sort of interesting in terms of money movement for that generation also.
And just quickly before we let you go, you mentioned Rocket, which makes me think of just the IPO market this year and also the SPAC market this year, the direct listing market. I mean, we've seen all kinds of new issues hit the market just in the last couple of quarters. Companies are coming to market all kinds of different ways. How are you thinking about this in the context of market sentiment type situation? Everyone likes to say that a big IPO is always going to be the sign of the top, blah, blah, blah. I mean, does this to you speak to animal spirits coming back into the market?
Well, the only reason I would say our clients have been very tempered in the IPO market so far this year. Yeah, there's some attractive ones, but it's not, you don't have that gigantic name like you've had in the past with Facebook, Twitter, et cetera, necessarily an everyday product across the board. You have some interesting ones, Snowflake, et cetera, but it's probably a more specialized group that's using them day to day. So I don't think you've recently seen that across the board attractive IPO. That's when you start to see people really get ramped up overall.
All right, JJ Kinahan with TD Ameritrade. JJ, always great to get your thoughts on the show. All right, coming up on the other side of this break, we'll keep our eye on the market sell-off here as we head towards the closing bell. Plus, we will talk to Justin McLeod. He's the CEO and founder of Hinge about what's happening in the dating market and how the company is trying to help its clients, its users, help their mental health as we get towards National Mental Health Day coming up at the end of this week. We're back with more on that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Othen with you in New York. Let's go over to Jared Blicker now for a look at this sell-off as we head towards the closing bell. Jared.
We are off the lows, Mile, and unless something drastic happens into the close, probably have them in place here, at least for today. Let's just take out the NASDAQ 100 heat map here. We can see Apple, which had been off far more than 3%, off only 2.25% right now. Amazon, Microsoft, and Facebook and Alphabet also pairing their losses. Here's an example, for instance, of Apple's price action today. Got that dramatic sell-off roughly from 2:45 until just after 3. And I did go back and check the sector action from that 2:45 p.m. decline. And we saw well, let me just preface it this way. The biggest losses had already been in tech, consumer discretionary, and also communication services. And those are currently the biggest losers of the day. But since 2:45, we saw the biggest sell-off in energy, financials, industrials, and materials. And that's exactly what you would expect if there was a repricing of that risk, or the fact that we're not going to get a stimulus plan until at least after the election. Well, time to pivot. It's time for Yahoo Finance Premium, and the investment idea of the day, brought to you by Argus Research, is Dick's Sporting Goods, and they are raising their price target to $70 from $63. Let's check out what they're saying here. They're saying for Dick's, on September 16th, the Commerce Department had reported advanced retail sales for August, and sales in sporting goods, hobby, musical instrument, and bookstore category, they were up 11.1% on a year-over-year basis. Strong performance that we believe bodes well for DKS. We believe they have the potential to gain additional market share thanks to their focus on innovative merchandise that improves athletic performance, its unique store environment comprised of specialty shops within the store, and its comprehensive customer service. You can get a free trial of Yahoo Finance Premium for 14 days by signing up at our website. Back to you, Miles.
All right, Jared Blicker, we will talk with you coming up after the closing bell. All right, let's turn our attention now to what's going on in the online dating market. It's been a very interesting time for that space. Everyone went home kind of scared of meeting new people, and things have certainly turned around broadly in the space over the last couple of months. Joining us now to talk more about all of that is Justin McLeod. He's the founder and CEO of Hinge. Justin, thanks for coming back on the show. So let's start with just the state of Hinge, the state of online dating right now, and how your business has really fared through the last couple of quarters, which have been probably the most interesting time in the history of the online dating business.
Definitely. So overall, because people can't meet the way that they usually would, which is in gyms or bars or weddings or parties or whatever, we really are the only way that a lot of people can meet right now. So overall, we've seen really strong traction with the business in terms of user growth, in terms of revenue. It's been a pretty strong period for us.
And of course, Justin, you have some news today. You have a collab with Headspace, the meditation app, which actually is my meditation app of choice. So I already have the library at my fingertips. I am engaged, however, so Hinge is not really useful for me at this point. But when you think about this sort of natural synergy, perhaps, that you saw, what was the reason, right? Why did you feel like this was a necessary sort of partnership, especially during the year 2020?
Yeah, well, we have World Mental Health Day coming up here on Saturday, and it really just seemed like our users, everyone I think is feeling a lot of stress right now for a whole lot of reasons. And dating is stressful generally without, I think, the global backdrop that we have right now in the pandemic, which makes things way more uncertain and makes people way more nervous. And it's also my meditation app of choice. And it just felt like what an opportunity to give our users and really everyone, so everyone can access these meditations at hinge.co/headspace to calm those pre-date jitters that I think so many people generally have and especially have right now.
Justin, I know last year you kind of launched this campaign, and it is pretty catchy, right? Designed to be deleted. That's what you guys want to be known for. But when you think about perhaps the taboo, the stigma that did exist, right, with Tinder, with Hinge, how do you feel like that's evolved, and how do you feel like perhaps that will go away post-pandemic as perhaps FaceTiming as a first date becomes more normalized?
Yeah, I think the stigma has been gone for a while. I don't think that most people view meeting online as any sort of stigma. And the thing that we're seeing go away now, the stigma around, is video dating. That was something that very few people would try before the pandemic started. And out of necessity now, about half of our users have been on a video date with someone. And that is just a really big and very fast change in culture. I think we were headed there eventually anyway, but we are seeing like a very swift move towards that. And people are enjoying it. Most people, like about 90% of people who go on a video date, that they enjoyed it and want to do one again. And about more than half of our users who have gone on a video date say they want to continue to do this after the pandemic because it's just a great vibe check before you actually invest in going out and meeting with someone in person.
And then I guess, Justin, just in thinking about, what you guys have as a dating platform, as a social network, basically, the data you have on your users, is this, the combination with Hinge or with Headspace, is that kind of maybe the future of how you see like your business using the data that you've been sitting on and trying to get more out of that data set?
Well, we just launched Hinge Labs, which is a research organization within Hinge that's really designed to figure out who's succeeding on Hinge, who's not, what are the people who are succeeding doing, and the people who are not, what are they doing or what are they not doing, and giving those learnings to people through the app and through content and things like that. So that's a really big way that we see our data going forward, is just helping our users delete the app even faster.
And Justin, of course, Hinge is part of the Match Group family. In the last quarterly earnings report, Match did cite, of course, Hinge and Tinder as being the main growth drivers, right? Especially here in North America. What's next for you? How do you think about continuing to grow your monthly active users, really helping consumers get more engaged in the platform?
Yeah, well, really, we think about it less in terms of engagement. I think a lot of apps out there and services are focused on more engagement, more retention, and that's the way that they compete in the marketplace. And I think this gets back to the meditation thing, because the way you get people more engaged and more retained is to make them feel more stressed and more panicked and more anger. And at Hinge, we really want people to feel relaxed and connected and to actually go out on dates and to delete our app. And so the way that we will do that is to continue to deliver on our customer promise of researching the best way to get people to delete our app faster so that they will meet their person, tell more friends, and then have those friends come up and sign up for Hinge.
All right, Justin McLeod, Hinge founder and CEO. Thanks so much for joining the show. Talk to you soon.
Thank you.
All right, coming up on the other side of this break, we will talk to Patrick Schaefer of JP Morgan Private Bank about everything going on in the market today, how we're thinking about the election and investing into next year. We'll get into all that coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. All right, let's talk a bit more about what's going on in the market, not just today, but over the last couple of weeks. And of course, the big event just 4 weeks from today, that would be the presidential election. Joining us now for that conversation is Patrick Schaefer. He is a global investment specialist with JP Morgan Private Bank. So Patrick, let's start with the election in the context of maybe this. We've heard from so many folks in the investment business that all their clients want to talk about is politics over the last couple of months. Is that what you have found? And how have you kind of gone through those conversations with your clients who care a lot about politics, but probably don't need to make any drastic portfolio changes based on that?
Yeah, Miles, that's exactly right. I think they're from like what clients want to talk about right now can kind of be distilled into like 4 big buckets of news flow.
the election, COVID, stimulus, and the Fed. On the election, as you just laid out, there is clearly a lot of near-term anxiety about what that could potentially look like. But if you take a step back and you look at the data longer term, who's in power in the White House and the Senate, generally speaking, has, from a statistical perspective at least, little to do with what equity market returns look like. And if you think about where the anxiety sits within the equity markets. When we focus on fundamentals and we look at the fact that the economy, certainly since May, has just been growing faster than people had anticipated in March and in April, and the earnings outlook for next year and into 2022 looks so bright, I think we can make a fundamental case, certainly to stay the course in equities or to move some of that cash off of the sidelines back into the equity market.
Now, certainly the news we've seen just within the last hour that there likely won't be a stimulus bill before the election has dented the markets a bit. I mean, we're off 1.5% in the S&P, but that positive fundamental backdrop that you talk about, second quarter earnings were so strong, revisions to the upside from analysts have been quite strong. Does that still remain in play, I guess, in your view? Like, were you assuming that there wouldn't be stimulus until next year?
No, we're assuming on stimulus, it's a matter of size and when, not if. And so the fact that there's going to be some choppiness around the negotiation, that's not really all that surprising. And if we think about this, like absolutely from a very near-term perspective, there's an issue on it. You look back over the last 3 trading days, and there has been this rotation out of some of the growth momentum areas into some of the more value cyclical areas. That started on Friday. It occurred yesterday. It occurred certainly today into this announcement that the negotiations broke down. But we actually think that markets have been keying off of 2021 earnings estimates since May. And if we fast forward the tape into next year, we can envision an environment where in the middle of next year, we start to think about what 2022 earnings look like. And from what we can tell today, that looks fine.
And thinking about corporate earnings, I mean, really the consensus now has been there's a K-shaped recovery. I mean, Joe Biden is talking about a K-shaped recovery. And on the top of the K is really corporate America. And so I guess our investors still may be doubting the way and the skill of corporate managements to maximize earnings per share and to deliver the kinds of returns that equity investors tend to expect.
Miles, you got it right there. Corporate America has adjusted. You look at the S&P 500 specifically, particularly the companies at the top of the S&P 500, they have adjusted. They are doing business differently. They are monetizing growth trends and durable growth trends that are evident in a COVID or post-COVID world. When we look at S&P 500 earnings next year, we can envision a scenario where we actually see S&P 500 earnings in 2021 at 170. To put that into context, last year, we did about $163 in S&P 500 earnings. And so we actually think at this point in time, next year, we're going to have higher earnings than we had last year before the pandemic. And if we look out to 2022, we can probably see a scenario where we get north of 180. It's through that lens that we can see the S&P 500 eclipsing where we were in the first week of September and getting to new levels of 3,700, 3,800 in about a year from now.
And then, we've talked a lot about the equity market more broadly across asset classes. What are the conversations like regarding, fixed income? We've seen, obviously, we know rates are going to be low from the Fed for some time. We've seen a little bit of steepening in the yield curve, but what are opportunities there for the kind of portfolios that need that kind of income generation? They've struggled for a decade, and it's really not getting any easier.
Yep, fixed income investing in a zero interest rate environment, or a ZRIP forever, as some people like to think about it right now, that can be a little bit challenging. I would not be afraid of taking a moderate amount of duration, so i.e. owning some bonds with a little bit longer maturity and taking some appropriate credit risk. I think appropriate credit risk with credit oversight, as opposed to just taking broad-based ETF sort of bond market investments, is probably the right way to go there.
All right, Patrick Schaefer, Global Investment Specialist with JP Morgan Private Bank. Patrick, always great to get your thoughts. Thanks so much for joining the show today.
Thanks, Miles.
All right, coming up on the other side of this break, we'll keep our eye on a market here, selling off as we head towards the closing bell. We're back with more on that in just 2 minutes. All right, we got about 5 minutes to go in today's trading session. Let's take a look at where things stand as we head towards the closing bell. We've got the Nasdaq right now off about 1.8%. The S&P is off more than 1.5%. Jared Blickery, this looks to me like session lows as we head towards the bell.
Yes, that is the case. I thought we had them in, and we are breaking them right now. And this just tells me, because 3 to 3:15 p.m. is a typical reversal time for the market. If the dip buyers were going to come in, that's when they do it. And they came in a little bit, but now we're getting more selling. So this may have some legs to the downside. So this is the intraday chart. Let's take a look at the last 2 months. And this is a bearish engulfing pattern. You don't want to see this if you are a bull, because one of the more rare patterns, you got to get confirmation the next day, but it is a topping pattern that candlestick traders look at. Also checking out the VIX here, because that spiked higher, but we did not take out the 30 level. That has been in play in this range that we've been in for the last month or so. So nothing too big there. 10-year T-note yield, this has reversed big to the downside. Not the same formation as we saw in the S&P 500, but after this huge multi-day spurt to the upside, to see that is going to attract some attention. US dollar index, not too much change. We had been a little bit lower. Now we're a little bit higher. Short-term trend is down, so we'll have to see how that develops as well. We did see a sell-off in crude, although it's still up 2%, as well as some of the other futures. And the energy sector had been one of the best performing of the day, but it's not anymore. So here's our heat map, and Amazon is getting sold the hardest now. It's off more than 3%, and consumer discretionary is among those sectors that is getting sold off the most. The others are financials, energy, and industrials, and materials. Now, if you look at this, that's a different picture. I'm talking about from 2:45 p.m. But for the day, communication services is the worst performing sector, Miles.
Yeah, I think it's just very interesting, Jared, in this kind of sell-off where it's so news driven, and yet all the selling pressure goes immediately to the big tech names. I mean, if you look at that heat map of the sectors, right? XLC, even discretionary along with XLK, like these sectors are all about the names we talk about all the time. You've got some of the high-flying restaurant names in there. You've got the high-flying tech stocks. There's some SaaS plays. And so it's interesting how, you would imagine if there's not going to be stimulus, like, oh, maybe you should sell materials harder. And granted, materials are off about 1.3%, but that's less than the broader market. And so very interesting just to see how the snap reaction to the news essentially just brings back all the trades, all the trends we talk about all the time here on Yahoo Finance. All right, coming up on the other side of this break, we're going to have the closing bell live from the floor of the New York Stock Exchange. That's coming up here right after this.
Welcome back to the final round here on Yahoo Finance. I'm Shauna Smith. We had stocks reversing course in the final hour or so of trading. This comes after President Trump called off stimulus negotiations with Democrats, quote, until after the election. Now you can see the Dow off just over 300 points right now, the S&P off just over 1%, and the NASDAQ is the big loser of the three major averages, off just around 1.5%. And that does it for the trading day today. Again, a huge reversal that we saw on Wall Street in the final hour or so of trading, with the Dow closing off just around 350 points as we shake out the final last trades. The S&P off just over 1%, and the NASDAQ was a big loser of the three major averages, off just around 1.5%. This, of course, comes after President Trump called off a stimulus talk. So even though we didn't see much progress in the talks for several weeks now, I think investors we're a little bit more hopeful that the two sides would be able to reach some sort of deal before the November 3rd election. But the fact that we won't get that, obviously bringing back or reintroducing some uncertainty here in the markets. When you take a look at the Dow, the biggest decliner in the Dow today was Boeing, the company saying that the pandemic is going to hurt aircraft sales for the next 10 years. So Boeing stock off pretty significantly this afternoon. We're also seeing weakness in Apple and in Microsoft. The S&P closing off just around 1.4%, and the NASDAQ off just over 1.5%. And you can see that reflected in the sector action today. Communication services, consumer discretionary, and technology sectors are the biggest underperformers in the market today. Utilities, the defensive play there, the only sector holding on to gains and closing in the green. I want to bring in my co-host for the next 60 minutes, Miles Udland. We're also joined by Yahoo Finance's Rick Newman, Akiko Fujita, and Jared joining the conversation. Miles, let me kick it over to you first. Just stocks selling off into the close. Obviously, there was a lot of hope out there that we will get some sort of stimulus deal. Now that that's off the table, what do you make of today's
I can never
action?
quite tell what level of irony we're operating on when we discuss the markets caring or not caring, pricing things in, whether politics matter, so on and so forth. But clearly there was some belief in the market that had built up over the last couple of days that there was going to be a stimulus bill. And I think with good reason. You give all the comments from, or you take all the comments from Nancy Pelosi and Steve Mnuchin, you put them together, and it sounds like we're in the ballpark of getting a deal done. I mean, I wouldn't rule out Trump changing his mind after today's tweets, but certainly the market is taking him at his word and saying, great, there won't be any talk on this till we get to the end of the election. We were talking with JJ Kinahan in the last hour, and he said, you know, it's really not that big a deal if we're down 1.5% on this kind of news. Now, peak to trough, it's 2%. But I mean, I think his point is well taken. If this was the main catalyst for the market and we're down 2%, well, we clearly find out that it's not the main catalyst for the market. So I think we have talked ad nauseum about how we are heading towards the election. That will give us clarity on dozens of different market narratives that right now we sort of talk around or guess at. And this is but the latest instance of that. And I guess kind of sure, if we got this headline, we all would have guessed that stocks would be down. We could have thrown a dart at how much. I don't know how close we would have gotten, but that's all we learned today is that stimulus did matter a little bit. It mattered about 2% worth in the S&P.
Well, Jared, taking a look at some of the levels, at least in today's action, Miles was talking about how we didn't really know how big of an impact it would have. So maybe it's right. Maybe it's good news that we're not down more significantly when you take a look at today's declines. But what are some of the levels that you're closely watching as we digest today's sell-off?
Yeah, I mean, we peak to trough. I think Miles got it right on nailed it because it was a greater than 2% move, but a 2% move recently in this market is not out of the ordinary. I was just looking at some of the statistics that I compute at the close. Dow has its worst day in 9 sessions. So does the S&P 500. But this is coming off the best session in 2 months for the Dow. So a bit of a reversal here. But we've been watching this 3,400, 3,410 area right here. This was clearly rejected. We found a catalyst today. If this hadn't happened, what would it have been? Well, maybe we'd be up here and we'd be heading higher, but that's not what happened. So right now, it looks like we may be heading lower. I don't think we take out 3,200. That's emerged as pretty strong potential support, and also 3,320 or so. So that captures this area that has been in play. in here. We could very well hit this tomorrow on the open and simply reverse up, or any number of possibilities there. But that's what I'm looking at. And then you take a look at the VIX. Miles and I were looking at this right before the close, and we closed right under the 30 level. You can see 29.88. It actually still trades until 4:15, and that's because the options market underlying it trade. But we haven't taken that out yet. And you look at NASDAQ volatility. We now have NASDAQ futures, VIX futures that you can trade. That's still clearly in this consolidation pattern. Haven't taken this out to the upside today or the downside. So all in all, I think it was a big day, mainly in the bond market. Bond market is where we've seen the action recently. You look at that big upswing that we've had here. This puts some of that into question. And I've drawn this before. We've basically been in this giant sideways trading range for well over 6 months right now in terms of the yield on the 10-year. So until we meaningfully break out of this, I'm not expecting anything disastrous for equity. Sometimes things can get disorderly when it moves too much, but those are my basic thoughts on this. We have tomorrow's another day, and this kind of confirms that the market was interested in pricing in infrastructure, just not this month.
All right, Jared Blickery, thanks for breaking that down for us. But of course, just to recap what is going on, we had a big sell-off here over the last hour or so, with the Dow closing off just around 375 points, coming after President Trump called to end the fiscal stimulus talks until after the election. Now, I also want to bring up the fact that we heard from Fed Chair Jay Powell earlier today, and he was saying the exact opposite. He was urging policymakers to offer more support to the economy, and he's saying that it is needed in order to keep the economic recovery on track. Brian Chung joins us now with more on this. And Brian, as it stands at this point now, Trump saying that the talks are off. What does this mean for the economy and what we heard in contrast to Jay Powell earlier today?
Well, it seems like I feel like I've aged like 10 years just in this one day. But earlier this morning, we did hear from Fed Chairman Jay Powell in remarks to the National Association of Business Economics. And it seemed like at the time, again, which was just this morning, that there was optimism on Constitution Ave that there could be some fiscal package coming on Capitol Hill. Hence why Fed Chairman Jay Powell was saying, go big if you do make that fiscal package. Here's what he had to say this morning.
The risks of overdoing it seem, for now, to be smaller. Even if policy actions ultimately prove to be greater than needed, they will not go to waste. The recovery will be stronger and move faster if monetary policy and fiscal policy continue to work side by side to provide support to the economy until it is clearly out of the woods.
And in contrast, the Fed chairman said that too little support would lead to a weak recovery, which appears to be the case now that the president has ruled out effectively any sort of stimulus package before the election, which means that obviously it might be not until February of next year, depending on whether or not that would be a President Biden or a President Trump, to get some sort of help. So the Federal Reserve making it very clear that that would not be a very good thing. We've heard that from effectively every member of the 17-member Federal Open Market Committee. There's a compilation that I've got on Yahoo Finance, but the strongest words that we heard were from Chicago Fed President Charlie Evans at the beginning of September. He said, partisan politics threatens to endanger additional fiscal relief. A lack of action or an inadequate one presents a very significant downside risk to the economy today. And it does seem like with the president ruling out that additional stimulus, that does appear to be the case for right now.
All right, Brian Chung, thanks for that. Well, for more on Powell's remarks and, of course, President Trump's decision to suspend those stimulus talks, we want to bring in our first guest. We have Frances Newton-Stacy, Director of Strategy at Optimal Capital. And Frances, just going through the big headlines that we've been talking about for the last 10 minutes, Trump ignoring Powell's calls for more stimulus talks, selling off on the news. In your notes this morning, you said that you think that the market is counting on stimulus. So now that we're not going to get it, I guess, how does this change your view on the market between now and the election?
Well, in the short term, I'm not sure that the market is certain that Trump is not going to change his mind or that this isn't part of the art of the deal. And that was indicative by the fact that, you know, the markets didn't take out my support today, which was at 11,093 on the NASDAQ, which is primarily what I'm watching at the moment. And so the thing is that we have to look going forward into the near-term volatility in the news cycle and then look out into the future to see what is the purpose of fiscal stimulus. Why is Powell suggesting very strongly that we have to have fiscal stimulus to keep the recovery on track? And the simple answer to that is that We have had now trillions of dollars of stimulus since COVID began, and that's the thing that's kept asset prices moving higher in the face of shutdowns and a lagging economy, et cetera, et cetera, et cetera. The thing is, though, we have new debt in the system from all of that stimulus, and so you have to keep enough liquidity in the system to pay off that debt, because when you get new debt, you get new debt service, and you need even more liquidity in the system, and it goes faster. Liquidity doesn't last as long in the system. Is that a risk tomorrow? No, but Powell is not thinking about tomorrow. Powell is not thinking about next month. He's just saying, if we do not get this from Congress soon, you're going to start to see a dip in that. Interestingly, if you look at the asset level on the balance sheet of the Fed, they waned on buying because there was a lot of discussion around fiscal stimulus, and now they have increased their asset purchases because this is a real risk on the table moving forward. And so in the interim, hard to say with the whole Twitter deal and the election coming up, but in the longer term, we definitely need fiscal stimulus.
So, Francis, and the big question is, what do investors do at this point? Because recent volatility obviously is evidence that how quickly market trends can change. You see the news today, the news flow, the headline news here. Is it very indicative just in terms of how quickly things could change inside or down on Capitol Hill? So what should investors do at this point?
Right. So I would add diversification to portfolios. And one of the great ways to diversify basically is the US dollar. And that's because of its historic negative correlations with both the equity markets and also with gold. So put in an asset class diversifier. I like the ETF UUP, whether you're going to buy calls in the options market or you're going to buy shares of that. It's not a volatile trade, but if equity markets head south or gold heads south based on a deflationary trade versus gold winning on an inflationary trade, you just have a lot of diversification in the portfolio. As far as equities go, still watching this NASDAQ. What's the catalyst to compete with the all-time highs that were given to us by SoftBank? We have a lot of money on the sidelines, and if we're going to get another stay-at-home trade or something like that with COVID, but now we have new closures again in New York City and the cases are up, then of course tech was the flight to safety. But even further out than that, we have problems in the credit markets. We just don't know how bad they are yet. We have over 100 million loans in forbearance and an ever increasing percentage of the mortgage market being in forbearance. And so we don't know what percentage of the loans in forbearance are going to be actually default risk. And of course, those big tech companies have great balance sheets. And so we may continue to see assets from the sidelines pour into those as a flight to safety.
Hey, Francis, I wanted to ask you about that credit risk, because when you were on just around a month ago, you were talking about the potential credit risk in the fourth quarter, which we're in right now, more than 100 million, like you just said, loans in forbearance. How much of that risk do you think, if any, is priced into the market at this point?
It's almost impossible to price in. I think what's being priced in is extended volatility throughout the end of the year. Some of those forbearance periods are supposed to end at the end of October, but we don't know if policymakers, and certainly if we can shove a fiscal deal through, if any of that's going to be extended. So there's that there. But I think people are pricing it in with volatility. I don't think that there's any way, and of course we'll continue to watch credit spreads, but I don't think there's any way to tell what percentage of those loans are going to default. But the employment picture being as dire as it is, and furthermore, if we don't get fiscal stimulus, as we found out from Powell's testimony with Mnuchin just recently, Mnuchin said, oh, sure, we can work on loans, around $100,000 for small businesses. And Powell said, no, not so fast. The Fed cannot underwrite those loans. And so that's really why Powell is saying, look, I can continue to buy assets from the monetary policy perspective, but we need fiscal stimulus because at the end of the day, coming out of COVID with the employment picture, the wealth gap should be our largest concern.
All right, Francis Newton-Stacy, Director of Strategy at Optimal Capital. Always great to have you on. We'll talk to you soon.
Thanks, Shauna.
Coming up here on the final round, we'll have more on Piper Sandler's semi-annual teen survey. We'll talk to the firm's senior research analyst, Erin Murphy. She'll break down the most popular lifestyle brands with the teens right now. And of course, some of the economic concerns and spending trends that we're seeing over the last couple of months. We're back with that in just 2 minutes. Welcome back to the final round. Piper Sandler is out with the semi-annual teen survey where it examines teen spending trends and their view on the economy, amongst other things. So for more on that, we want to bring in Erin Murphy, Managing Director and Senior Research Analyst at Piper Sandler. And Erin, it's great to speak with you again. Let's first just get to teen spending and their view on the economy, because one of the first charts in the survey shows that 48% of teens believe that the economy is getting worse. It's the highest reading since the fall of 2011. Just first, give me your sense of the biggest concerns that teens have at this point and what's impacting their spending behavior.
Yeah, well, thanks for having me. I think it's a couple of things. I mean, clearly they are kind of like sponges. They're absorbing what they're hearing from their families and their parents, but their concerns right now are really focused on social justice, the environment. I mean, when you ask them what their top concerns are, it's really not necessarily an economic, even though we did see the economy, you know, from their perspective getting worse. They're very socially aware as a generation. And so those are kind of more of their top concerns. But, you know, clearly spending hit an all-time, or I should say an all-time low in our survey. And the behavior is really shifting. And I think the behavior piece is in part because of the pandemic. So more interest in video games, lower interest from a spending perspective in food at this point, higher interest in, you know, home furnishings or decorating their rooms, a lower interest in or lower pay in even their car. So I think you are starting to see some interesting behavioral trends just emerge within the wallet as a result of what we've seen year to date and the impact of COVID-19.
Well, Erin, one thing that hasn't changed is the fact that in apparel and footwear, Nike has been the #1 brand. It was the #1 brand for this survey. It's the 10th year in a row that it has remained at the top spot. What is Nike doing right? When we talk about retailers failing to connect with the younger generation, obviously Nike has been successful at this. What are they doing that has positioned themselves in this way?
So I think that they have done an excellent job of really being relevant to this generation. I mean, there has been so many controversial, if you will, ways that they even market, whether it's Colin Kaepernick, whether it's some of the ways that they've been marketing through the pandemic, but yet this generation resonates with that. They do stand for change. And so I think, you know, the marketing messages have continued to just be so relevant to this generation. And then from a product perspective, they have been innovating. And it's not just new product. I mean, they have new product coming to the market now that's really focused on, you know, recycled or upcycled products. So it's good for the environment, but they also go back and have a very rich archive of former products. So think about the brand Jordan. It's a substantial business for them. And, you know, that brand has had a major renaissance this year with just the success of ESPN's The Last Dance. So I think that they're hitting it all at once. And then big picture, you're seeing consumers dress a lot more comfortably. They're more focused in just kind of active wear, as most of us are not fully coming back to the office, or you're being schooled from home if you're a teen. And so I think that the category right now for athletic is really red hot.
Erin, you know, one of the things that struck me in the study is just how well Netflix has done. You say 34% of daily video consumption comes from Netflix, which is higher than YouTube. You know, we often talk about how YouTube maybe skews a little younger as well. What do you think Netflix has done right to be able to capture at least this part of the market share with a younger audience?
Sure. So it's not a name that I cover. It's another analyst at Piper, Young Kim. But generally what we've seen on the content side is, you know, both Netflix and YouTube have, you know, kind of conquered or kind of anchor this market. I think it's just been this consistent stream of content that we've seen. But, you know, big picture, as teens have been at home and adjusting to a new normal, a lot of time the virtual schooling, their school hours are a little bit lighter as well. So they have a little bit more time to spend in different avenues. And I think you're not just seeing it on the content consumption side, but you're seeing it in social media. I mean, this year, the teams estimated that they spend 12 hours a week on social media. So I think that will be another big trend to dig into as we see some of those brand rankings shift.
Erin, what do you think it's going to take in order for teens to get their spending back up to those pre-COVID levels? Is it a vaccine, or is it just simply that they're changing their behavior and they're opting for more of those experiential avenues in terms of spending it on clothes or spending it on food, something like that?
a really good question, because I think that's what a lot of people, like I've talked to a number of investors today, they're trying to figure out how much of the spend, deceleration is just the macro that we live in, or is there something more behavioral? And candidly, I think it's a little too soon to tell, but there was a couple interesting nuances I think are relevant. This generation, so Gen Z in particular, they care, we've talked about a little bit already on this segment, that they care on the environment and they're shopping a little bit differently. So while, clothing and footwear are staying relatively stable within the wallet, they care more about secondhand. That's a really interesting channel, I think, to explore. They're comfortable buying or selling, kind of used clothing. And so thrift stores came up substantially throughout this data. And so I think it will be interesting to see if that sticks. Do their wallets shrink in terms of some of the, the things part of the ledger and move more towards experiences or other? Do they just need to own less? I'm not sure, but it is going to be, I think we're at a pretty pivotal point right now where you've got some macro headwinds as well as some behavioral shifts. But we do know that, they are much more socially aware, mindful, and conscientious consumers than generations before them.
All right, Erin Murphy, Managing Director and Senior Research Analyst at Piper Sandler. Always great to talk to you. Thanks for joining us.
Thank you for having me on. I appreciate it.
Coming up, the Wall Street Journal reporting that the White House has dropped its objections and signed off on the FDA's guidelines for approving a COVID-19 vaccine. We'll talk about what this means for a timeline. We're back with that in just 2 minutes. Welcome back to the final round. Let's get to the latest on coronavirus. The Wall Street Journal reporting that the White House has dropped its objections and has signed off on the FDA's guidelines for approving a coronavirus vaccine. For more on this, we want to bring in Dr. Eric Feigl-Ding. He's an epidemiologist and senior fellow at the Federation of American Scientists. And we also have Yahoo Finance's Anjali Kamlani joining the conversation. Doctor, it's great to have you on the show. With the White House signing off on the FDA's 2-month COVID-19 vaccine guideline, I guess my first question to you is, where does this put us on a likely timeline for a vaccine to be approved?
Well, the vaccine actual timeline hasn't changed. It's whether Trump would have previously had the gall and ability to overrule the FDA in approving it without the extra safety data. So if anything, this will actually make the trials reports and confidence more safe, because we will have the extra data to be sure that is efficacy works well enough and safe. And I think this is a good news all around. It just means that Trump would be unlikely to approve it before Election Day.
And Doctor, we talk about the fact that with this vaccine, so many Americans, we've seen survey after survey that they're hesitant about potentially taking a vaccine, that there's a lot of distrust out there. Do you think that this type of headline at least would help improve Americans and their trust for a potential vaccine?
Yeah, I think this is a really good move because 1/3 of Americans say they won't take it outright, 1/3 say they will, and 1/3 said we'll see. And this wait and see, and the huge number of people won't taking it is really worrisome because a vaccine is only as good as how many people take it, right? A 100% effective vaccine is only 50% effective if half the people take it. And so I think this lays the seed that people can trust it, that when the results come out, the scientific community will get behind it, as opposed to panning that was too early and too risky. And that key messaging is one of those things where you will actually win the war in the long term against the coronavirus next year, whenever it rolls out in the general population.
Dr. Angela here. I know that Dr. Peter Marks, who we all know is the FDA's top vaccine expert there, has been at various events and symposiums talking about this 2-month period, but also saying that they wish they had more time, spurring what I think is a letter from multiple health experts pushing for even more time. Not that the White House caved on the 2 months, any chance that we will just continue following science on this one, and is more than 2 months necessary?
Yeah, I think we will probably need longer. It depends. The timeline actually depends. A trial has enough data when actually enough people get sick, and you can actually have a contrast between the vaccine and the placebo group. But I think this is a good first start. Actually, the FDA posted online against the White House wishes in one of their other side websites, which kind of forced their hands, because then the White House would have had to undermine the FDA publicly, very publicly. So in certain ways, what the FDA won this battle, it won it grudgingly. And hopefully there won't be any more of these kneecaps. But technically, Trump can still approve the vaccine over, because as of last month, they assumed all the approval powers from the FDA. So hopefully they will abide by this, and hopefully we'll have good data.
Doctor, I want to get your thoughts just on what we heard from President Trump's campaign today, and that's the fact that he's planning to debate Joe Biden next week. Now, it's scheduled for October 15th, which will put us just 2 weeks after the president had tested positive. Just from your perspective as a doctor, are there any safety concerns that you have about Trump attending the debate and participating in the debate?
Yeah, because Trump, for example, he took his mask off yesterday. He's still infectious. On average, and this is average, people recover and they're no longer infectious after 10 days after they show symptoms. 10 days is very, very close to the 15th. And honestly, Trump is much older and he has risk factors, so he could actually be infectious and sick longer than normal. So 10 days is average. Half the people are longer than that. So he could still be infectious at the debate. So I think at minimum, you should have much better plexiglass, which, by the way, Pence rejected for the debate tomorrow against Kamala Harris, which is very weird and strange. But personally, I think it should be a virtual or rescheduled.
Doctor, looking at the vaccine developments outside of the U.S., we've got China now looking to get some kind of assessment from the WHO to allow for the emergency use of some of their vaccine candidates. And I'm curious how significant you think any kind of assessment or approval from the WHO would be, especially given concerns about the way in which the trials have been conducted in China, the safety and efficacy questions. I mean, ultimately, is this really about trying to get the vaccine to more of the emerging and developing countries that are likely to be left out as some of the big names that we've been talking about?
Mm-hmm. Yeah, I think WHO, their vaccine consortium is the COVAX consortium with Gavi and the Danish group that U.S. as a part of Warp Speed are completely separated from, because U.S. did not want to join them. WHO wants to make sure that the vaccines are safe and get into the hands of developing countries, and hence why they've developed and actually made pharma commit to actually reducing their profits and waiving their profits altogether. Meanwhile, the US warp speed vaccines have not, and that probably limits the availability of all these warp speed vaccines for developing countries in getting in their hands. So WHO cares about global health. Again, Trump cares about America first again. And that's not a good idea, because with all these different vaccines, their vaccines could actually be superior to ours. And now we're basically putting all our eggs in one basket, and that is risky.
All right, Dr. Eric Feigelding, an epidemiologist and also senior fellow at the Federation of American Scientists. Great to have you on the show. Thanks for taking the time. Well, the outbreak inside the White House calling into question the administration's safety protocols, or lack thereof, I guess I should say. The guidelines from the CDC call for businesses to safely protect their employees by social distancing, by wearing a mask, amongst other things. So, Rick, the question here is, if the White House were operating like a business, I mean, how much trouble could it potentially be in, just in terms of the lack of safety protocols or safety measures that they have taken to protect some of the employees inside the White House?
If the White House were a normal business, it could be facing a lot of legal liability related to employees and visitors or third parties both. I mean, in a business, they would be customers. But there have been many third-party visitors to the White House, including some who went to that celebration for the Supreme Court justice on September 26th and did subsequently come down with the COVID infection. So it's worth pointing out, every business around the White House has to abide by rules issued by Washington, D.C. that say you have to wear a mask if you're a worker or a customer inside a business. There has to be a safety plan. You do have to make it possible for people to safely distance inside the business. And all the normal businesses in DC, either they operate like that or they don't operate. And if you flout those rules as a normal business, you're susceptible to lawsuits. The White House does not have to abide by those by local or even state regulations wherever there's a federal agency. The way it works for the White House is they're supposed to abide by rules set by the Occupational Safety and Health Administration, OSHA, but Trump's OSHA has set no rules for what government has to do, or businesses for that matter, to keep people safe from COVID. So because of these wrinkles, if you are an employee of the White House who gets sick, you do not have very much legal recourse the way you would in a normal business.
Rick, going through your piece, I know you mentioned a workers' compensation claim, but it sounds like from what you're saying, just in terms of the employees inside the White House, that wouldn't help much in this situation.
Right. So what usually happens with employees when they either get hurt or they get sick on the job is the first thing they do is file a workers' compensation claim. And it's typical that all businesses pay into what's basically an insurance fund, which then takes care of the worker. The catch with that, and some worker advocates say this is really not fair, because first of all, workers' compensation doesn't pay that much. And in some cases, it actually makes it harder to file a lawsuit. But you can. I mean, again, if we're talking about normal businesses that have to play by the rules, you can file a workers' comp claim. And then if you feel you still have suffered damages that go beyond what that claim reimbursed you for, then you can file a lawsuit. It's a lot harder when it's the government, because there are some rules in place that don't make it impossible to sue the government, but make it a lot harder. So it looks as if the way Trump runs the White House, with really no protections institutionalized at any rate to protect workers, looks like they can get away with it.
Well, it's pretty simple. They should just reinstate the mask wearing and also enforce social distancing.
We all know where Trump stands on that.
I know. And then we wouldn't be in this situation, but we could talk about that.
Trump is the mask shunner in the world.
That's true. All right, Rick Newman, thanks for breaking that down for us. Well, coming up here on the final round, now that his stimulus bill is off the table, at least until after the election, what does that mean for the U.S. economic recovery? We'll have more on that right after the break. Welcome back to the final round. We have some breaking news here after hours. Levi is out with its earnings report. Shares jumping here after hours, up just around 11%. Jared Blickery has more on this for us. Jared?
That's right. Stock had been up as much as 12, and this is on a huge beat on revenue, top the best estimate. So that third quarter revenue came in at 1.1 billion versus estimates of much lower, 822.3 million. And e-commerce revenue, that's up 52% year over year. Investors have liked those kinds of numbers when they come out elsewhere. And they're saying that total digital business has doubled as a share of total net revenue. Now, their adjusted gross margin increased 60 basis points to 53.6%, much higher than the estimate of 51.1%. And their expenses, SG&A, declined 19%. They already had been enacting some cost-saving actions. That's reflecting it. And then they also returned to positive adjusted free cash flow generation in the third quarter, and that was 183 million. Had dipped into the red briefly, but that was only for a quarter. Also, total available liquidity, $2 billion. Cash at the end of the quarter was $1.4 billion. And a quick quote here from the CFO saying, cost and working capital actions have put us on a clear and accelerated path to achieving our adjusted EBIT margin North Star of at least 12% when revenues recover to pre-COVID levels. And they're expecting results of operations will continue to be significantly adversely impacted for at least the balance of 2020. There does remain the possibility of additional COVID-19 related inventory and other charges. Call is starting at 5 p.m. That's just in a few minutes. Just checking out the price action in Levi. Let's look at it. This is over the last month. You can see up 18% year to date. Nice bounce off the March lows. Well, actually, for the most part, at the April lows, I'll say right here, still down 24% year to date.
I'm stock getting a big boost though after hours, so we'll see how it opens tomorrow. Jared Blickery, thanks for breaking that down for us. But taking a look at the broader market action, we had stocks sinking today. This, of course, coming after President Trump called off those stimulus talks until after the election. Now his tweet coming after we heard from Jay Powell earlier today, reiterating the need for more stimulus, warning about an uneven economic recovery. So for more on this, we want to bring in Chris Viveris. He's co-head of U.S. economics at IHS Markit. Chris, great to have you on the show. So we have no stimulus at this point until after the election. I guess my question to you is, how big of a drag do you think this is going to be on economic growth in the fourth quarter?
Yeah, great question. So we have looked at a stimulus package that we thought could have passed that would have been about $1.5 trillion at an annual rate. And that would have added maybe 2 to 3 percentage points to growth. Now, when you're talking about a 31% decline and a 32% rebound in the third quarter, that doesn't sound like much. But anything that would hasten the return to full employment and bring people back to work is certainly helpful. And especially when you think about individual businesses or families that might be right on the brink of going belly up, it's important that we use the ability that we have to provide fiscal stimulus to hasten our return to what we would call full employment.
Hey, Chris, Rick Newman here. Part of the unstated Democratic strategy here is maybe hold out, see if Joe Biden wins and if Democrats can take the Senate, and then in early 21 pass a much larger stimulus plan that might even be similar to that $3.4 trillion plan the House passed in May. So if that were to happen, you'd get more stimulus, but it would come later. So how do you sort of do the equation there and say whether we're better off or worse off under that type of scenario?
Well, certainly more stimulus is better than less stimulus, and earlier better than later. So I think the economy has enough momentum that it can get through the fourth quarter without additional stimulus with a positive growth rate. But we already are looking for growth to slow significantly from the third quarter 30+% pop to something that's 5% or less in the fourth quarter. And then maintaining steady growth rates in the low single digits for the rest of 2021. So having a big stimulus that would come perhaps as soon as the first quarter of next year would certainly accelerate growth after that. Remember, a lot of these things do take some time to gear up. So if it's infrastructure spending, it takes some time. If it's a tax cut, it may take time to adjust withholding schedules to put money in people's pockets. Surely the unemployment benefits, because it replaces lost income, is one of the most effective ways that you can get support to consumer spending as quickly as possible into the economy. The checks that we sent out last year, is another way. Unfortunately, it was a little misguided in that a very large percentage of those checks were sent to people who were not in any kind of financial distress, and they ended up being saved, at least for some amount of time. They did seem to leak out in the economy into increased spending on goods, since people seem to be not wanting to spend it on services, travel, concerts, sporting events, eating out, etc. So, we could design a stimulus plan that supported the incomes of those people who lose their jobs, supported the lost income of small businesses, and tried to get employment back to full employment as quickly as possible without sending checks to people who clearly don't need them.
Chris, you talked about some of these families that are really on the brink, and the stimulus check was a bridge for them. We had a study that came out a few months ago that pointed to how the stimulus and the government help prevented roughly 13 million people from falling into poverty. So I'm wondering, now that we're looking at even more of a delay, what are the ramifications of that for those who are most vulnerable?
Right. So, we saw over 20 million people lose their jobs. About half of those roughly are back. So we still have a very large number of people who are unemployed. In addition, we've got part-time workers whose hours have been significantly cut back, which creates this sort of financial distress. And as you note, has perhaps, even though they're working, has made them part of the working poor. So again, anything that we can do that will replace the lost incomes from those who were working. I mean, we did have a good economy, 3.5% unemployment rate before COVID hit. It was great. And we need to do whatever we can to get back to that point. If we want, I think all of us agree that that's a desirable goal. The question is, exactly which tactics, how big are these packages supposed to be, who gets the income support, is all in the mix. But clearly doing more sooner will prevent those who really are on the edge of whether it's bankruptcy or some foreclosure or being evicted, to give them that to avoid some of these more traumatic financial and life-changing events.
All right, Christopher Veras, great to have you on, co-head of U.S. Economics at IHS Markit. We'll talk to you soon.
Good to be here.
Coming up on the final round, following a 16-month-long investigation, House Democrats are recommending big changes at Facebook, Amazon, Apple, and Google. We'll have more on that when we come back. Welcome back to the final round. Well, the House Judiciary Subcommittee on Antitrust releasing its findings and recommendations. This follows a 16-month-long investigation into competitive practices at 4 of the big tech firms, Apple, Facebook, Amazon, and Google. So for more on this, we want to bring in Bhaskar Chakravarty. He is the Dean of Global Business at Tufts University. And Bhaskar, great to have you on the show. This report that we've just received is 450 pages, and it was largely what we were expecting, just in terms of the Democrats taking the side that they're questioning some of the monopoly power that these big tech giants have. They're pushing for some changes that could potentially result in some of these companies being broken up. And then, of course, we have Republicans that are voicing at least some objections to some of these proposals. Just in terms of what you think is the biggest challenges of big tech right now and the best ways to address them, where do you stand on those issues?
Yeah, so there is obviously a lot to process, with this new report that has just come out. But this report is, and the action that the House is recommending is happening in parallel with a number of other actions. There is action in the Senate. The Department of Justice has indicated that it plans to launch its own antitrust lawsuit against Google. You have the FTC, you have the state's attorneys general, so there is a lot going on. And in terms of the complaints against big tech, there are several. In addition to the fact that they are big, people are worried about misinformation, about what's happening to our data. And there's so many different complaints against these companies. So obviously, this is a challenging time for technology. And at the same time, this is one of the best periods for technology overall, because guess what? Thanks to all of us being under some form of shelter at home or lockdown, the primary tether that we have to the rest of the world is through their products. So this is the worst of times. It's also the best of times.
Bhaskar, one of the key policies that Congressman David Cicilline, who chairs the Antitrust Committee, has put forward is this Glass-Steagall, as he calls it, of tech, essentially preventing these tech companies from selling products on their own platforms. So that would limit Amazon, that would limit Google, that would limit Apple. How realistic is that option? And how much do these companies, you think, stand to lose if they have to unwind the structure, the business structure they have right now?
So the companies would obviously have a lot to lose if a version of Glass-Steagall were to be passed for the technology companies and the platforms were to be separated from the applications. They have a lot to lose, not only because they lose business, but they also lose the data and the ability to utilize the data that they gather on their platforms to then sell products to the same users. The consumers potentially could also lose because sometimes that data leads to tailored services. So unpacking these companies, breaking them apart, is going to be a long and complex process. And the history of antitrust, the history of trying to break up tech companies is not very encouraging. In 1956, the Bell System monopoly was left intact after a 7-year legal saga to try to break them up. IBM, the action lasted for 13 years, and IBM was left unbroken. The 1998 action against Microsoft, again, left unbroken. It all ended with a settlement. So, history suggests that it is not easy to break these companies up, and now these companies are even more complicated than IBM, Microsoft, or the Bell System was in the past.
Hey, Bhaskar, Rick Newman here, and you could possibly argue more powerful. So as you point out, antitrust litigation takes years and often doesn't work. There could also be some kind of legislation, which seems to be what the House Democrats are hinting at by putting out this report. But is there a legislative way to address this? And what is your best guess 10 years from now, whether these companies will look like they more or less like they do today, or will they look different?
So just working backwards from your question, Rick, I never try to predict what these companies are going to look like 10 years from now, because
That's
guess
why
what?
I have to ask.
I'm sorry?
That's why it's my job to ask.
Right. In 10 years, so much happens, right, in the technology business. But here is one prediction I would make, that any antitrust action to try to break them up, that's not going to happen. That's not going to happen for so many reasons, because there's too many complaints against too many companies. We're not going after one Microsoft. You're going after Google or Alphabet, you're going after Facebook, you're going after Amazon and potentially Apple. They're all different companies. They're all in tech, but they do very different things. The complaints against them are different. The set of complaints against Facebook is very different from the set of complaints against Amazon. So the legislative action is complicated by the fact that legislative actions themselves are slow-moving processes. Our legislators primarily don't talk to each other across the aisle. They would have to come together as Republicans and Democrats to somehow craft some kind of a united front against these companies. This is going to take a while. So one thing that I would expect to happen would be a series of settlements with these companies. And here is a recommendation. Go after the biggest technology problem that we face as a country. The biggest technology problem has been laid bare by the pandemic. About 160 million Americans, roughly half the population of this country, does not have reliable access to broadband internet. Half this country does not have access to the internet, which could allow them to get on a video call just like what we are doing, which means they can't get their children to attend schools that are being done remotely. They can't do telehealth consultations. They can't work from home. This is a problem that could be potentially solved through a settlement with these big tech companies, because guess what? All four of them, the big ones that they're after, Apple, Google, Facebook, and Amazon, they are all in the internet access business. They have invested in internet access in other parts of the world. They can direct that to this country and try and solve that problem. That will be one piece of a settlement, and then there are several other pieces that would happen. 10 years from now, I expect there are going to be some rules and regulations in place and a deal that will be struck across the legislators and these different companies.
Bhaskar Chakravorty, great to get your perspective. We hope to have you back soon because we have a lot more to talk with you about. So Bhaskar Chakravorty, Dean of Global Business at Tufts University. We'll talk to you soon.
Thank you for having me.
Coming up here on the final round, we're going to take one more look at this afternoon's sell-off, plus what we're watching for the rest of the week. We're back with that in just a minute. Welcome back to the final round here on Yahoo Finance. With stocks selling off into the close today, with the Dow closing off 375 points after President Trump called off those stimulus negotiations until after the election. But as we turn our attention to tomorrow and to the remainder of the week, now this is where we usually go around the horn and give our 2 cents on what we're going to be watching over the next couple of days. But today we have a very special edition of our look ahead, because there's a very special and a very important event coming up this weekend for a very important member of the final round, Miles Udland. He's going to be leaving us for a couple of weeks because he is getting married on Saturday. And Miles, we just want to celebrate with you. We're so happy and so excited for you and Pam, and we wish you a stress-free and a COVID-free celebration in a couple of days.
Thank you. Thanks, everybody. We'll definitely take the COVID-free part if we can get it. The stress-free is not happening, has not been happening, will not be happening. Yeah, look, you can get 20 people together, so we're going to give it a shot, and we'll see what happens.
Well, it's very exciting, and we wish you all the best, and we can't wait to see all of the pictures and everything that you guys have in store over the next couple of weeks. So we'll be thinking about you, we'll miss you, and we'll see you when you get back from your—
I probably won't be thinking of the show very much, so.
I know. You won't be thinking of us at all. All right, well, that does it for us today on the final round. Thanks so much for tuning in. We'll see you back here again tomorrow. Have a great night.